Hello, good morning to all of you. Welcome to the marathon or revision series of corporate accounting. Very happy to see you all. Very happy to take marathon classes for all of you. Now, corporate accounting, you all know it's paper number 10, one of the part. In paper number 10, corporate accounting, auditing, together 100 marks. In that, corporate accounting is one part, auditing is another part. Now I am going to revise corporate accounting. I will provide marathon for corporate accounting. First, your paper is for 128 marks, sir, including the choice. I am telling, including the choice, the paper is for 128 marks. In that 128 marks, 66 marks will come from corporate accounting, 62 marks will come from auditing. 50-50 we can say. And if you see the corporate accounting, what are the topics? If you see the past 3 examination question papers, you will observe that financial statements of company, one chapter, they're asking 114 marks question. Cash flow statement, they're asking 7 marks question. Banking 7, insurance 7. Of course, banking, insurance, electricity. These 3 chapters, 2 chapters will be asked for 14 marks, 7 marks, 7 marks. But mostly if you observe the trend, banking, insurance, they're testing. It is not that electricity companies, they won't test. We don't know. Out of these 3, 2 chapters will be tested. 7 marks question will come. And there is accounting for shares. In the 2 questions will be asked 7 marks, 14 marks. In accounting for shares, we have accounting for basic issue of shares, forfeiture of shares, bonus issue, right issue, redemption of preference shares, redemption of debentures, underwriting concept. There are so many topics they packed, and they're asking 14 marks out of it. And MCQs also possible. 2 MCQs will also come. And Indian accounting standards, usually they're asking a 7 marks question from Indian accounting standard. You have some beautiful Indian accounting standards, 4 or 5 Indian accounting standards are there, solid accounting standard. In that 2 accounting standard that quite frequently testing, that is employee benefits, EPS, earning per share. And I'm going to cover both of them. So total, if you see problematic wise, 56 marks will come. MCQs, you will find 4 or 5 MCQs. Each MCQ carry 2 marks. So 10 marks MCQs. So total 66 marks. So I will try to cover all these chapters in my marathon, sir, to the extent possible. Financial statements, cash flow statement, banking, insurance, accounting for shares. I will try to cover the important areas. Like for example, right shares. They're asking bonus issue sometimes. Sometimes they're asking redemption of debentures. Actually, redemption of debentures they won't ask, but last attempt or previous attempt they have asked. In one attempt they have asked redemption of debentures. So we don't know. Any topic can be asked anytime. There is no such thing that this topic cannot be asked, this topic can be asked. But in CMA, the advantage is what? We know the structure of the paper very well. They won't change. Second question, A, generally come from accounting for shares. B also accounting for shares. Third question, financial statements of company. Like that we can fix. So, financial statements of company, cash flow statement, banking, insurance, some accounting standards if you learn, definitely you are going to score 35 to 40 marks quite comfortably. These are the chapters you need to focus. And accordingly, I am going to make a discussion. Okay. So this is a brief idea about the, if you see the index also, see first 9 chapters in my material, you see the first 9 chapters. If you see the study material of ICMA, 10% of the weightage is given to 9 chapters. Actually, these 9 chapters together is what? Accounting for shares. Accounting for shares is one chapter. In that chapter, I have divided into small chapters for discussion purpose. All these together, 10% of the weightage. That means, I told you now, 14 marks may come from this. Preparation of financial statements, 10%. Cash flow statement, 10%. Banking, electricity, insurance, 10%. Accounting standards, 10%. So total, 50% of the weightage. Okay, let's start our discussion. Okay guys, let's start our first chapter for discussion, preparation of financial statements of companies according to Schedule 3 of Companies Act 2013. See, the paper name is corporate accounting. Corporate accounting means it is relating to companies. When you're learning something relating to companies, obviously you need to follow the Companies Act and also accounting standards. So it is not like general accounting practices I will apply for companies. It is not possible. Whatever provisions which is already there in the Companies Act, you need to learn and you need to apply in accounting for companies. That is the specialty of this corporate accounting. Now the first chapter is preparation of financial statements of company. See, when you want to prepare the financial statements of a company, you need to follow Schedule 3. In Companies Act, there is one Schedule 3. In that Schedule 3, they have given the format. And also they have given some general instructions how you are going to prepare the balance sheet, P&L account of a company. You need to learn it and you need to prepare financial statements according to that. So in this chapter, basically we are going to cover that format and also general instructions in which head what items will come, how items will be presented. So this chapter will give you holistic idea about preparation of financial statements of company, and this is very, very important, not only from examination point of view, but practically also this chapter is very, very important. First of all, in this chapter, what is financial statements of a company? What is financial statements? See, if you see the Companies Act, sir, section 2 clause 40 of Companies Act says financial statements includes the following. One is balance sheet, P&L account, cash flow statement, changes in equity if required, and notes to accounts forming part of the above. These 5 things will be called as what? Financial statements. If you are a non-profit organization, instead of P&L account, we are going to prepare income and expenditure account. So in this chapter, we are going to learn how to prepare the balance sheet and P&L account of a company. Cash flow statement is also one of the component of financial statements, but we are going to learn it as a separate chapter. And statement showing changes in equity, obviously it is there in your syllabus, but it is very dangerous to learn financial statements for companies which are subject to Indian accounting standards. So mostly they are testing in exams the balance sheet, the P&L account. Of course, cash flow statement they are going to ask a separate question. Notes to accounts is something which is part of financial statements only. When you prepare balance sheet and P&L account of the company, you have to prepare notes to accounts also. Okay. Now see, sir, when you want to prepare financial statements of a company, what are the things I need to keep in mind? Suppose when you are preparing financial statements of a sole proprietor, or when you are preparing financial statements of a partnership, do you think anything should be kept in mind? No, just a T shape, assets one side, liabilities one side, we will write. But it is not so in case of companies. When you are preparing financial statements of a company, you should keep in mind certain things. The first thing you should keep in mind is Schedule 3 requirements. Schedule 3 requirements is the first thing. Second thing is accounting standards. Whatever is prescribed in accounting standards, whatever the disclosures, whatever the principles which is prescribed in accounting standards, they will be applied in preparation of financial statements. And also provisions as per Companies Act or provisions as per law. Any provisions which is applicable will also be followed in preparation of financial statements, and also any guidance note given by Institute of Chartered Accountants of India. So in preparing financial statements, you should keep in first thing is what? Schedule 3. That's why we need to learn Schedule 3 requirements. And if you see the Companies Act, sir, there is one section 129, which says when you are preparing financial statements, your financial statement should give what? True and fair view. And also when you are preparing financial statements, you should comply with accounting standards. And frequency of financial statements, annually, once in every year we are going to prepare financial statements, but sometimes maybe quarterly also financial statements is required to be prepared. Like for example, if I am a listed company, as per SEBI requirements, I need to prepare financial statements every quarter. Okay. Now, Schedule 3, sir, when it comes to Schedule 3, there are 3 divisions in Schedule 3. I am starting Schedule 3 discussion, important. There are 3 divisions in Schedule 3. Division 1 is applicable to companies who has to comply with normal accounting standards. Division 2 is applicable to companies who is need to comply with Indian accounting standards. See, in India right now we have Indian accounting standards. Before Indian accounting standards we have normal accounting standards. It is not that all companies need to comply with Indian accounting standards. There are normal accounting standards are also applicable to the companies. So if you are a company who is required to follow normal accounting standards, for you division 1 is applicable. If you are a company who is following Indian accounting standard, for you division 2 is applicable. If you are a NBFC, non-banking company who is listed NBFCs, for you division 3 is applicable. Sir, division 1 they have given the format for balance sheet P&L. Division 2 they have given the format. Which division we need to learn, sir? Actually, frankly speaking, for you both divisions are there. Even the companies who is required to follow Indian accounting standards, how they are going to prepare financial statements is also there in the study material. But without learning all Indian accounting standards, how can you prepare financial statements of a company who is following Indian accounting standards? So that's why you can leave this. And if you see the past examination questions, they are not asking this. They are asking only division 1. That means the companies who is required to follow normal accounting standards. How they are going to prepare financial statements, that is what we are going to cover. Okay. Next. Let's start, sir. First we are going to start with the balance sheet. Division 1. We have two parts in division 1, sir. Two parts. Division 1, part 1 talks about balance sheet. Part 2 talks about P&L account. Now, say this. Division 1, part 1. This format everybody should know, and you need to prepare balance sheet of a company in accordance with this format, sir. So, see, the balance sheet of a company is divided into two parts. One part is equity and liabilities. Okay. Second part is assets. And you need to present like this in a statement manner, one after another. Equity and liabilities and then assets. Equity and liabilities will have four heads. One is shareholders funds. Second, share application money pending allotment. Third, non-current liabilities. Fourth, current liabilities. Asset side only two heads. Non-current assets, current assets. So total 6 heads will be there in the entire balance sheet. First part, equity and liabilities. In equity and liabilities, first shareholders funds. Second head, share application money pending allotment. Third, non-current liabilities. Fourth, current liabilities. Asset side, we have non-current assets, current assets. So schedule 3 has classified the assets and liabilities into current and non-current. Okay. Now first to come to shareholders funds. Shareholders funds, we have share capital, reserves and surplus, money received against share warrants. 3 items are there. Share capital, reserves and surplus, money received against share warrants. Share application money pending allotment does not have any breakup. Next, when it comes to non-current liabilities, four items are there. Long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Long-term borrowings, deferred tax liabilities net, other long-term liabilities, long-term provisions. Current liabilities, we have 4 items. Short-term borrowings, trade payables, other current liabilities, short-term provisions. When it comes to assets, I told you non-current assets, current assets. In non-current assets, we have 5. One is property, plant, equipment and intangible assets. Second, non-current investments. Third, deferred tax assets. Fourth, long-term loans and advances. Last one, other non-current assets. Property, plant, equipment and intangible assets, non-current investments, deferred tax assets, long-term loans and advances, other non-current assets. When it comes to current assets, there are 6 items. First one, current investments. Second, trade inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. So if you look at the entire format of a balance sheet, how you are going to start? Balance sheet as on. Company name you write, balance sheet as on. First part, equity and liabilities. In equity and liabilities, remember like this. First, shareholders funds. A, share capital. B, reserves and surplus. 3, money received against share warrant. Second head, share application money pending allotment. Third, non-current liabilities. A, long-term borrowings. B, deferred tax liabilities net. C, other long-term liabilities. D, long-term provisions. Then current liabilities. A, short-term borrowings. B, trade payables. C, other current liabilities. Last one, short-term provisions. Total. Then asset side, non-current assets, we have 5 heads. A, PP and intangible items, intangible assets. Next, non-current investments. Next, deferred tax assets. Fourth, long-term loans and advances. And last one, other non-current assets. Come to current assets. Current assets, we have 6. First, current investments. Second, trade inventories. Next, trade receivables. Next, cash and cash equivalents. Then short-term loans and advances. And last one, other current assets. If you observe, in liabilities and asset side, every head will have what? Others. Every head will have what? Others. So see this. For example, non-current liabilities, we have other. Current liabilities, we have other current liabilities. Assets, we have other non-current assets. Current assets, we have other current assets. This is the basic format, sir. And this format you will remember only by repetition. When you are solving the question also, you need to repeat it number of times. Only by repetition you remember it. Okay, it is not logic, just you need to remember. You have to remember and you have to write it. It's all about the memory game when it comes to these kind of formats. Now, okay, now important point, sir, schedule 3 has classified loans and advances, assets and liabilities into 2 categories, right? What are those? Current assets, non-current assets, right? Now, on what basis they are doing this? They have given. Important, they are asking a question from it. First, liabilities we see. See, schedule 3 says a liability is classified as current liability if it satisfies any of the following conditions. Any of the following condition is satisfied, then that liability is classified as current liability. Any one, 4 criteria they said. Out of these 4, if any one is satisfied, then we say it's a current liability. What are those, sir? First thing, any liability expected to be settled within the normal operating cycle is a current liability. Any liability expected to be settled within the company's normal operating cycle. Sir, what is normal operating cycle? How much time it has taken to convert the raw material into finished goods is called normal operating cycle. For example, raw material will become work in progress, then finished goods, then cash and cash equivalents. To complete this cycle, how much time a company will take? That is called normal operating cycle. See, within this normal operating cycle, whatever you are expecting to settle, they are all your current liabilities. They are all your current liabilities. Okay, suppose, sir, I am unable to determine the normal operating cycle, then assume 12 months. Assume 12 months. So your NOC is 12 months, normal operating cycle. So within this cycle, what you are expecting to settle? For example, within this cycle, what you are expecting to settle, for example, you make the payment to the supplier. So supplier is a current liability. Within this cycle, see, they must belongs to operations. Conversion of raw material into cash and cash equivalents means it is part of your production operations. So within this operations, any liability you are expecting to settle, that is called normal operating cycle. Normal operating cycle can be more than 12 months also. It can be 15 months also. Suppose if anything I am expecting to settle within 15 months, then it will become current liability. It is not that normal operating cycle is always 12 months or less. It can be more than 12 also. Suppose for my company normal operating cycle is 15 months. Then any liability I am expecting to settle in this normal operating cycle within 15 months, then it becomes a current liability. There is a question also in the study material, so we'll solve it. So the first thing is what? Any liability which is expected to settle within the normal operating cycle is what? Current liability. Second, any liability held primarily for the purpose of being traded. Primarily for the purpose of being traded. Sir, when you held any liability primarily for the purpose of trade means, like for example, derivatives, options, swaps, these things will be there, na? Financial assets they call it as. So anything relating to them, trading purpose. Anything held for the purpose of trading, primarily held for the purpose of trading, they are also considered as always current liabilities. And next one, anything due to be settled within 12 months after the reporting date. See, from this reporting date to next reporting date, if you are settling anything due in the next 12 months, from this balance sheet date to next balance sheet date, that is also comes under current liabilities. Generally, when you are solving the questions, we will apply this one mostly. Any liability expecting to or any due to be settled within the next 12 months is what? Current liability. And last one, the company does not have an unconditional right to defer the settlement of liability for at least 12 months. Suppose the company on its own cannot postpone a liability settlement beyond 12 months. Then that liability obviously classified as what? Current liability. And equity settlement do not affect the classification. Sir, sometimes some liabilities we will settle not by cash but by issue shares. That doesn't affect the classification. Whether you settle a liability by cash or shares or doesn't matter. If on your own, if company does not have the right to defer, see this, the word is what? Company does not have unconditional right to defer settlement for at least 12 months. Deferring means postponement. If I can't postpone settlement of a liability beyond 12 months, definitely it has to be classified as current liabilities. Best example is any loan repayable on demand. When I take in any loan from a bank which is repayable on demand, whenever bank demands, I need to pay it. That means, can I postpone the liability beyond 12 months? No. Therefore, it has to be classified as current liability. So, to become a current liability, any one of these criteria must be satisfied. First criteria, expected to be settled within the normal operating cycle. Normal operating cycle is how much time it has taken to convert the raw material into cash and cash equivalents. Second, any liability held primarily for the purpose of trading, like for example derivatives, so futures, so options, so these are all always current liabilities. And the next one is anything due to be settled in the next 12 months is also current liability. And company does not have unconditional right to defer the settlement of liability for at least 12 months after the reporting date. And equity settlement does not affect the classification. Like for example, convertible debentures, convertible bonds. Suppose a company issued convertible debentures. Due date is approaching. It is next 12 months. Can I postpone on my own without consulting debenture holders? No. That means there is no unconditional right on the part of the company to defer the settlement of this liability beyond 12 months. Therefore, it has to be classified as what? Current liability. Current liability. And even if I settle a liability by equity shares, it doesn't affect the classification. All other liabilities are which liabilities? Non-current liabilities. All other liabilities are non-current liability. Similarly, current assets. Sir, which assets are current assets, sir? Same. Like current liabilities, current assets also they said 4 criteria. Out of these 4, if any one is satisfied, that asset is called current asset. What are those? See the first one. Anything expected to be realized, intended for sale or consumed in the company's normal operating cycle. Within the normal operating cycle, what you are expecting to realize, what you are expected to consume, what you are expected to sale, intended for sale, they are all your current assets. Tell me here in this cycle, raw material to cash and cash equivalents, in this cycle, what you are expected to realize? What you are expected to realize? Realization from debtors. When you sell the goods, definitely you are going to collect the amount from debtors. So raw material becoming cash and cash equivalents. How raw material will become cash and cash equivalents? First you make the production. Once you finished goods are ready, you sell on credit basis. Debtors will come. Debtors will give the cash. That means realization of amount from debtors is also part of NOC. It is expected to be realized within this NOC. So therefore, trade receivables is always which asset? Current asset, which is expected to be realized and expected to be consumed. What we consume in production? Raw material, work in progress. Intended for sale. What you intended for sale? Finished goods. That's why inventories are always current assets, because they are consumed. They are intended for sale within the normal operating cycle. Next, held primarily for the purpose of being traded. See there, this point is also there in the current liabilities. That means what? If you held any investments for the purpose of trading, because of that any liabilities arising, they are current liabilities. If you held any investments for the purpose of trading, because of that any assets arises, they are called current assets. Derivatives, futures, options, sometimes they can become an obligation for us. Then they will be classified as current liabilities. If they become assets, they will be classified as current assets. Next, anything expected to be realized within 12 months after the reporting date. Anything expected to be settled, anything due for settlement in the next 12 months, current liability. Anything expected to be realized within 12 months after the reporting date, current asset. And last one, cash and cash equivalent. Always cash and cash equivalent is which asset? Current asset. Unless there is a restriction that this cash and bank balance cannot be utilized. For example, there is a court order. That court order has freezed our bank account. In our bank account, 10 lakhs is there. Now, the court order said that this bank account cannot be utilized. Now, when court judgment will come, we don't know. Maybe beyond 12 months. So, in that case, that cash and bank balance we don't consider as a current asset. So, that's it, current asset. So, can you tell me what is current asset? Any of the following criteria. First one, expected to be realized or consumed or sale in the normal operating cycle. Second, held primarily for trading. Last one, next one, expected to realize it within 12 months from the reporting date. And next one, cash and cash equivalents. Basically, this is current assets and current liabilities. Now, see, relating to balance sheet, sir, first head I told what, sir? Shareholders funds, correct? In shareholders funds, what is the first one? Share capital. See, relating to share capital, how we are going to present it? Schedule 3 has given disclosures also. How each item will be disclosed when you are preparing notes to accounts. For example, if you are presenting share capital, always make sure that first you write authorized share capital of the company. And when you are writing authorized capital, total number and value of shares you need to mention. Then issued, how much is subscribed, fully paid, subscribed but not fully paid, you need to mention. And every time when you write about shares, you need to write face value, nominal value. See, when you are preparing notes to accounts, sir, clearly write down 10,000 equity shares of rupees 10 each, because it's a schedule 3 requirement. And also, sir, every company has to present a summary of shares outstanding at the end and at the beginning of the period. At the beginning, how many shares are there? At the end, how many shares are there? We need to clearly prepare one statement. And also we need to mention in the notes to accounts the rights, the preferences and restrictions in respect of each class of shares. And also any shares held by parent company, ultimate holding company, their subsidiaries, we need to mention. And the 7th point, if in our company shareholders owning more than 5% shares, we need to clearly mention. This can be asked as an MCQ. Shareholders holding more than 5% shares in a company, we need to clearly mention in the notes to accounts. And also any shares company reserved for issue under any options, contract and other commitments, we need to mention the terms and amounts. And the 9th point is most important point, sir. Sir, if any company has issued shares for consideration other than cash, fully paid bonus shares, buyback. If any one of these 3 things happened in the company need to mention about how many number, aggregate number, class of shares. Aggregate number, class of shares. Aggregate number, class of shares. In the notes to accounts, we need to mention for a period of 5 years. For a period of 5 years. So what are the things? What are the situations? First, when shares are issued for consideration other than cash. Second, fully paid bonus shares. Fully paid bonus shares. Last one, buyback. If any one of these 3 things happen, company need to mention in notes to accounts. Clearly they need to mention a note. What is that note? Aggregate number, class of shares. They need to mention. So when you are preparing financial statements, you make sure that in the question, if company issued any shares for consideration other than cash, definitely you need to give a note. If company issued any bonus shares fully paid, you need to give a note in the notes to accounts. And any unpaid calls on shares are there, you mention. And any amount paid on forfeited shares. Sometimes we will forfeit the shares, company will forfeit the shares. In respect of these forfeited shares, how much amount already paid by the shareholders also you need to mention. Sir, out of these points, which points I need to remember, sir? See this. Obviously, the first point, the second point, the third point, shareholders holding more than 5% point, and this point. I think these are the points you need to remember. So when it comes to share capital, please understand, in the notes to accounts, you mention clearly first authorized capital, then issued, subscribed, paid up capital, and always make sure that you write face value of the share. Face value of the share. Okay, number of shares, face value, clearly write down. I am observing some students, they are not, how they are presenting na, SC means share capital, ESC, directly they are writing the amounts. If you write like that, they won't allot marks. Suppose for example, you need to write like authorized share capital, 10 lakhs equity shares of 10 each, 1 crore, like that. Next, issued, subscribed, paid up capital. I will show you how we are going to present the financial statements. And in the shareholders funds, once share capital is written, what is the next one? Reserves and surplus. Sir, therefore, first thing you need to remember, sir, when you are preparing the balance sheet, sir, this share capital is which share capital, sir? This is always paid up share capital. In balance sheet, you need to write what? Paid up share capital. Authorized capital is only for presentation purpose. Authorized capital is only for presentation. Only paid up share capital will come in balance sheet. Next, to reserves and surplus, second head. Reserves and surplus includes what? All types of reserves like capital reserve, CRR, securities premium, debenture redemption reserve, revaluation reserve, share option outstanding account. Some people, some students, the moment they see outstanding account, they think it's a liability. But look at this, sir. This is what, sir? Share options outstanding account. It will come at the time of employee stock option, ESOP. So therefore, this share option outstanding account is also part of reserves and surplus. And now one more important point, sir. Suppose if a company had any P&L account, if the P&L account is having a debit balance, where will you present? Same in reserves and surplus only, within brackets. You cannot write it on the opposite side. So if there is a debit balance in the statement of P&L account which indicates loss, it has to be shown as a negative figure. Okay, even because of this P&L account debit balance, the total reserves may become negative, no problem. Still it has to be presented under head reserves and surplus only with a negative figure. That is second item, sir. What is the third item, sir? Money received against share warrant. Sir, first of all, what is the share warrant? Share warrant is basically a instrument which represents the value of certain number of shares. Suppose if you purchase share warrant, your name will not be entered in the register of members, but you have this warrant, share warrant, this certificate. What you can do is, if you want to transfer this to anybody, you can transfer. Ultimately, the person who wants to become shareholder, he will surrender that share warrant to the company, and company will enter his name. Now, company point of view, sir, when company received any money from you relating to the purchase of the share warrant, they don't put this in share capital, but they will write separately. It is shareholders funds only, but they have not included in share capital. They will write separately. That's why A, share capital, B, reserves and surplus, C, money received against share warrant. When the share warrant holder surrendered the warrant and company entered his name in the register of members, then this will become share capital. Till that point of time, it has to be shown as a separate item. Next, what is the second head, sir? Share application money, pending allotment. See, important. Share application money, pending allotment means what? Suppose a company issued shares, application money received, allotment not yet done. Meanwhile, 31st March came. So on 31st March, company already received application money, but allotment not yet done. Without allotment, that money cannot be transferred to share capital. So therefore, that money cannot be included in shareholders fund. That's why there is a separate heading, second head, share application money, pending allotment. But important, sir. Suppose company went for public issue, public applied for shares, application money received, allotment also done, but your application is rejected. Therefore, your application money has to be refunded. So at the end of the year, application money pending allotment will come here. Share application money pending allotment. Application money pending refund, where it will come? It will come in other current liabilities. There is a difference. It will come in other current liability. It will become a liability for the company. Here, this is pending what, sir? Allotment. And any calls paid in advance, where it will come? Other current liabilities. One more interesting. Suppose for example, you applied for shares. You applied for shares. Company received your money. Your application is rejected. That means your application money has to be refunded. On 31st March, any money pending for refund, it will be shown in other current liability. If any interest accrued, that is also other current liability. Sometimes if the refund become late, we need to pay interest also, right? That interest will also comes under other current liabilities. So that's it, pa. So I think we have completed these things in shareholders funds. We have completed share capital, reserves and surplus, money received against share warrants, and also share application money pending allotment. And then non-current liabilities. In non-current liabilities, what is the first one? Long-term borrowings. So what items will come in long-term borrowings? Long-term borrowings like debentures, bonds, term loans from banks, from others, deferred payment liabilities, any deposits taken from public, any loans and advances from related parties, any long-term maturities of finance lease obligations, these items will come. So whenever in the trial balance you see any bonds and debentures, always classify under long-term borrowings. Term loans, generally loans which is taken whose repayment period is greater than 36 months. Greater than 36 months, that means greater than 3 years. They are called term loans. So from banks, from other parties, if any term loans is taken, that will be shown in long-term borrowings. And also deferred payment liability. Sir, what is deferred payment liability? 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 See, deferred payment liability means a liability which is to be paid over a period of time in installments. The word defer means postponement. If a liability can be paid over a period of time in the form of installments, that can be called as what? Deferred payment liabilities. Deferred payment liabilities. Okay, see this, sir. Deferred payment liability. For example, X Limited company is there, Mr. Z is there. From Mr. Z, the company is purchasing plant and machinery. Cost is 25 lakhs, sir. And they said there is an agreement that this 25 lakhs will be paid over a period of 5 years. That means every year we will pay 5 lakh rupees. So this can be called as what? Deferred payment liabilities. Similarly, for example, another example I can give, sir. Suppose there is a company XYZ Limited. There is a GST department. Suppose this company is not paying GST, sir, thinking that their products are not subject to GST. But GST department has sent a notice that GST liability is how much? 50 crores. Now company requested GST department that, sir, we cannot pay 50 crores at a time. Give us some time. Then department said, you pay this 50 crores over a period of next 10 years. So this can be called as what? Deferred payment liabilities. So any deferred payment liabilities the company had, that can be classified under long-term borrowings. And also any deposits from public, long-term nature. Any loans and advances from related parties like parent, subsidiary companies, associates. And also the most important one is this one, sir. Any long-term maturities of finance lease obligation. When a company entered any lease, if that lease is finance lease, in accordance with that lease, what is the amount we are going to pay? Liability. That will also be classified under long-term borrowings. Actually, there is a standard called AS 19, which is there in financial accounting paper for you. That standard says leases are basically two types: operating, finance lease. If you enter any lease under finance lease, in accordance with that lease, whatever the amount you are required to pay, that is comes under long-term maturities of finance lease obligations. And similarly other loans and advances. And now important thing, when you are presenting any loans and advances, sir, you present in two categories like secured, unsecured. How much is the secured, how much is the unsecured? If the loan is secured, suppose that means if you given any asset as a security, you need to mention nature of security also. Nature of security will be mentioned in the notes to accounts. Okay, next in non-current liabilities, long-term borrowings. Okay, what is the next one? Deferred tax liabilities. Deferred tax liabilities will be discussed in AS 22. There is a separate standard. No need to learn what is deferred tax. It's a very difficult task. Okay, I mean there is a separate standard is there to understand deferred tax concept. Simple. If it is a deferred tax liability, show it in non-current liability. If it is a deferred tax asset, non-current assets. That's it. And other long-term liabilities, long-term provisions. Come to long-term provisions. Long-term provisions. What items will come in long-term provisions? Basically, what is provision? Provision is a liability which can be measured with a substantial degree of estimation. Okay, basically provision is a liability. which can be measured by substantial degree of estimation. See this. What is provision, sir? Provision is a liability with estimation. What is liability? Liability is a present obligation from past events, the settlement of which requires what? Outflow of resources. So to become a liability, there must be present obligation, and to settle that obligation, there must be outflow of resources. Best example is provision for warranty. For example, company is selling products, 2 years warranty given. That means within these 2 years, if any damage happened to the products, customer will come and he asks for repairs or replacement, right? Now company will incur some cost now. Company will have to incur some cost. That means the moment company sold the goods, there is an obligation for the company. And how this obligation will be settled? Only by outflow of resources. Company have to incur some expenditure. Therefore, it becomes a liability. And but I can't say how much exactly company is going to incur for this repairs replacement. Based on the past experience, we will estimate. So that's why liability with estimation will become provision. So the combination to become a provision is liability with estimation. And one important thing, sir, when you create a provision for liability, then you need to show in long-term provisions or short-term provisions, depending upon the period. But if you create any provision in respect of asset, then where will you present? You will show by way of deduction from that particular asset, like provision for doubtful debts. Provision for doubtful debts will be shown by way of deduction from debtors. Correct? Any provision for doubtful debts, any provision for depreciation, any provision for diminution in value of investments, these are all provisions created against assets. They are not liabilities. They are created against assets. So therefore, they will be shown by way of deduction from the concerned asset. That's why when you are preparing balance sheet of a company, debtors minus provision for doubtful debts, you are reducing from debtors, but you are not showing it on the liability side. That's the logic here. So in long-term provisions, provision for employee benefits. Provision for employee benefits means gratuity, pension, PF, we are going to pay to the employees, right? For that we create a provision. Or else we can write provision for warranty. Can be one provision. Like this, different provisions. But guys, remember one point here. Short-term provisions. Provision for tax. Remember, provision for tax is always short-term provision, because we are going to meet the tax liability in the next 12 months. So basically, you create a provision for liability. Depending upon the liability when you are going to meet, you classify whether it is short-term or long-term. If it is long-term, it will come in non-current liabilities, long-term provisions. If it is short-term, it will come in current liabilities, short-term provisions. Provision for tax is usually will come in our problems. So provision for tax is which provision? Short-term provisions. Next, other long-term liabilities. You will be surprised, in other long-term liabilities, what items there? Trade payables. Trade payables generally where it will come? Current liabilities, trade payables. Then why it is came here? Because if trade payables is not fit into the definition of current liability, I told you current liability means it must satisfy any of the following. Suppose if it is not satisfying any of the following, it is, suppose for example, it is expected to be settled within the normal operating cycle. We are not settling. It is due to be settled in the next 12 months. No. So therefore, it is not fit into the definition of current liability. If it is not fit into the definition of current liability, then it has to be shown under other long-term liabilities. Trade payables, say this. Some students will get a doubt. Sir, why trade payables? Already there in current liabilities, why you are writing on the other current liabilities? Okay. So please understand, sir. So this is long-term, non-current liabilities. So in non-current liabilities, tell me what items will come? Long-term borrowings. Second, deferred tax liabilities. Next, other long-term liabilities. Next, provisions, long-term provisions. Can you give me 2 examples of long-term borrowings? Debentures, bonds, deposits, term loan from banks, from other parties, deferred payment liabilities, long-term maturities of finance lease obligation. Finance lease obligation. These are all. And I told you borrowings are generally classified into 2. Secured, unsecured. If they are secured, we need to mention the nature of security also. Next, come to current liabilities. In current liabilities, what is the first one? Short-term borrowings. So short-term borrowings, what items will come? Say this. Loans repayable on demand. See this. Whenever you taken any loan from banks, from other parties, which is repayable on demand, obviously it's a short-term borrowings. And also loans and advances from related parties, deposits. That means deposits taken from public beyond 12 months will comes under short-term borrowings. Beyond 12 months will comes under long-term borrowings. 12 months or below will comes under short-term borrowings. Same manner, loans and advances from related parties. If you take any loans and advances from related parties for a long period of time, long-term borrowings. Otherwise, they will come in short-term borrowings. Like long-term loans and long-term borrowings, short-term borrowings also divided into secured, unsecured. Secured, unsecured, and if they are secured, we need to mention the nature of security. And the most important point is this, everybody important, say this one. Current maturities of long-term borrowings will also comes under short-term borrowings. What is that? Current maturities of long-term borrowings. That means basically it's a long-term borrowings. Basically it's a long-term borrowings. But if it is due to be settled in the next 12 months, then it has to be classified as short-term borrowings. For example, debentures. Debentures is which borrowings? Long-term. But suppose if the due date is in the next 12 months, from this balance sheet date, if the due date is within the next 12 months, it is due to be settled in the next 12 months, then where it will become short-term borrowings. That is called current maturities of long-term borrowings. Basically, it's a long-term borrowings, but it is due to be settled in the next 12 months, then it will become a current maturities of long-term borrowings. It will comes under short-term borrowings. This is an amendment actually. The old thing is that current maturities of long-term borrowings is other current liabilities, but they have changed it to short-term borrowings. You have to be very careful when solving the question. Okay. Next, sir. In current liabilities, next trade payables, right? Guys, regarding trade payables, you need to remember two things. Trade payables are classified into two categories. One is trade payables to micro and small enterprises, and other than micro and small enterprises. So any trade payables, any creditors, we are purchasing goods from the supplier. If the supplier is micro and small enterprises, that has to be shown separately. What is the total amount due to creditor who is belongs to micro and small enterprise? Other than micro and small enterprises, we need to show separately. Okay. Next, other current liabilities also very, very important. So in current liabilities, sir, current liabilities, what is the first one? Short-term borrowings. Second, trade payables. Trade payables are classified into two: micro, small, other than micro and small. Next, other current liabilities. Now see what items will come in other current liabilities. Current maturities of finance lease obligations. Say this. Finance lease obligation. Long-term maturities of finance lease obligations. Long-term borrowings. But current maturities of finance lease obligation will come in other current liabilities. And any interest accrued but not due. Interest accrued and due. Interest accrued but not due. Interest accrued and due. For example, debentures. Interest accrued and due date also there at the end of the year. Due date also came. Interest accrued and due but not yet paid. It comes in other current liability. Interest accrued but not due will also comes under other current liabilities. Any income received in advance. For example, from customer we received advance. That is not income for us. So it's a liability. Which liability? Other current liability. Next, unpaid dividends. Any dividend declared but not paid by the company will comes under other current liabilities. And this point I already told. What is that? Application money received for allotment securities and due for refund, and interest accrued thereon. Any application money received, but your application was rejected, so we need to refund the amount back to you. So any application money due for refund at the end of the year, including interest accrued thereon, will also comes under other current liabilities. And also unpaid mature deposits and interest accrued, unpaid mature debentures and interest accrued will also comes under other current liabilities. So in other current liabilities, you need to remember interest accrued but not due, interest accrued and due, unpaid dividends, and also application money due for refund. Okay, that's it. I think we have completed all the liability side. Sorry, I mean equity and liability side. So in equity and liability side, what is the first head? Shareholders funds. In that, share capital, reserves and surplus, money received against share warrants. Next, share application money pending allotment we done. Next, non-current liabilities. In that, long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Next, current liabilities, first one, short-term borrowings, trade payables, not receivables. Next, other current liabilities, short-term provisions. Next, asset side, you see PP and intangible assets. PP and intangible assets are divided into 4. First, property, plant, equipment. Property, plant, equipment means basically tangible assets. Next, intangible assets. Next, capital work in progress. Capital work in progress means tangible assets under development stage, construction stage. Next, intangible assets under development stage. That means under R&D, research and development stage. Next, non-current investments. Sir, basically investments are 2 types, sir. Current investments, non-current investment. If it is a current investment, where it will come? Current assets. Current assets. If it is long-term investments, generally we call it as non-current investments. And deferred tax assets will come here. Deferred tax assets. Next, long-term loans and advances, other non-current assets. Now, relating to PP, sir, the schedule 3 says you need to classify land, buildings, plant and equipment, furniture and fittings, vehicles, office equipment, like this. And one important point, sir, any assets taken under lease will be disclosed separately. Separate disclosure. Sometimes some assets are acquired under lease basis, na, sir. That has to be disclosed separately. And every year you need to prepare one reconciliation statement, sir, relation to assets. What is the opening gross value, net carrying amount, how much additions happen, disposals happen, business combination acquisitions. Business combination means through amalgamations, mergers, how much assets we acquired, any revaluation changes, any other adjustments we need to show completely. And also any depreciation, impairment losses. Showing all these things in respect of each class of assets, we need to prepare one reconciliation statement. Similarly, intangible assets like goodwill, brands, trademarks, computer software, mastheads and publishing titles. What is masthead? Masthead means title of the newspaper. Title of the newspaper. That itself is an intangible asset for them. Correct? For example, Inadu. Inadu is the intangible assets, masthead. Publishing titles, nothing but mining rights, copyrights, patents. These are all intangible assets. Same like tangible assets, for intangible assets also you need to prepare a reconciliation statement. Next, investments. I told you investments are 2 types. Current investments comes in current assets. Non-current investments comes in non-current assets. So non-current investments like trade investments, other investments. Trade investments, other investments like investment property. Important. Investment property. Equity, preference, government trust securities, bonds, debentures, mutual funds, partnership firms. Investment property means investment in land or building, not for the purpose of use in business, but for the purpose of earning income, revenue. If you invest in any land or building for the purpose of earning revenue from it, that is called investment property. Investment property will be shown under non-current investments. And if you invest in any corporate body, like companies, you need to mention the name of the company where you invested, relationship type, what is the relationship you had with that company, whether it is your subsidiary, associate or joint venture, and you need to mention what is the nature and amount of investment in each company, and also you need to give a separate details of partly paid investments. See, in this chapter, sir, if you observe the previous exam questions, they are asking disclosure requirements. One time they asked what na? Explain disclosure requirements of trade receivables. One time they have asked explain disclosure requirements of stock inventory. So most of the students, they are thinking that from this chapter only a big 14 marks question will coming. No, sometimes they are asking a theory question also. For example, relating to investments, they can ask if a company makes investment in body companies, what are the details we need to mention? Then you need to write these 4 points: name of the company, nature of relationship, amount and nature of investment, and also details about partly paid investment. Suppose if we invest in any partnership firms, suppose a company invested in partnership firm, they need to mention the name of the firm, name of all the partners, total capital of the firm, and also each partner share in the capital. And suppose sometimes investments are carried other than at cost. Sometimes investments are valued other than at cost. What is the basis of valuation we need to mention. And also we need to mention aggregate quoted investments, market value. Quoted investments means, quoted means listed company securities, how much we invested, what is the market value. Unquoted investments, provision for diminution in the value of investments. All these details we need to mention, sir, in respect of non-current investments. Now this one is important, long-term loans and advances. Sir, long-term loans and advances, we are talking in assets. Assets means we are giving loans and advances. The schedule 3 says long-term loans and advances are classified into capital advances, first one, then loans and advances given to related parties. What is that? Capital advances. Sir, what is capital advances? Any advances given to acquire any asset. Any advance given to acquire any assets. See, capital advance. Any advance given for acquisition of capital assets like fixed assets. For example, there is a company, sir, they are purchasing a plant and machinery. Advance paid 10 lakhs. At the end of the year, if any advance is paid for acquisition of this plant and machinery, where will you show? Where will you show? Non-current assets, long-term loans and advances. You need to show capital advances. Hello? And relating to assets, sir, long-term loans and advances, other non-current assets, and then short-term loans and advances. For these items, there is the same sub-classification, sir. Trade receivables also. Trade receivables, debtors, nothing but. See, in the asset side, see this carefully, important pointer. They may test this in examination. You see, asset side, first this one, remember this one, other non-current assets. Next, long-term loans and advances. This one, other current assets. And then short-term loans and advances. Next, trade receivables. These are all our assets, right? Now schedule 3 says in respect of all these items, there is same subclassification. See this, long-term loans and advances 1, short-term loans and advances, other non-current assets, trade receivables. Same subclassification is applicable. When you are presenting them in the notes to accounts, you need to divide them into 3 categories. One is secured considered good. Second, unsecured but considered good. Third, doubtful. Secured considered good. That means we have taken asset as a security. Okay, and we are expecting payment properly. That is called secured considered good. Second one, unsecured considered good. Unsecured, and we are expecting still the payment. And the last one is doubtful. Like this, we need to classify, sir, in respect of these items. What are the items? Long-term loans and advances, short-term loans and advances, trade receivables, other non-current assets. And see, in respect of, see this one, subclassification, secured considered good, unsecured considered good, doubtful. Same is applicable for other non-current assets also, you see. And other non-current assets, what items will come? Trade receivables. You see, generally trade receivables will come in current assets. But if the trade receivables not fit into the definition of current asset, then where it will be classified? Other non-current assets. Similar to trade payables. Trade payables, either it will come in current liabilities, trade payables, or other non-current liabilities, other long-term liabilities, like that. Current investments, same like non-current investments, breakup will be given. Inventory is important, sir. They have asked this in examination once. See, inventories generally where it will come? Current assets. Current assets, obviously. Inventories, how they will be classified? Like this, like raw material, work in progress, finished goods. If you are a trader, then you have stock in trade. Stores and spares, loose tools, others. See, you can be a manufacturer, you can be a trader. For a manufacturer, raw material, work in progress, finished goods. Suppose if you are a trader, the inventory you are dealing with is called stock in trade. Stock in trade. That is your inventory. Stores and spares, which is used in the production. Loose tools, small equipment which we use in production. They are also inventories. And any goods in transit at the end of the year, we need to give a separate disclosure. And we need to mention the valuation method, how inventories are valued. What is the basis of valuation of inventory also we need to mention in the notes to accounts. Now, trade receivables, debtors is also important, sir. Sir, generally when you are presenting trade receivables, sir, debtors outstanding for a period exceeding 6 months, we need to show separately. Debtors outstanding for a period exceeding 6 months, we need to show separately. Relating to debtors, sir, actually we need to prepare aging schedule. What is that? Aging schedule. In that aging schedule, we need to classify the debtors. But when you are solving a question, the most important thing you need to remember is, whenever you are presenting debtors, in the additional information sometimes they will say debtors outstanding for a period exceeding 6 months, this much amount is there, they will say. Then in the notes to accounts you need to show separately. Debtors outstanding for a period exceeding 6 months separately, remaining amount you need to show separately. And this point I already told you, like trade receivables, long-term loans and advances, short-term loans and advances, other non-current assets, same subclassification, that is secured considered good, unsecured considered good, doubtful. This subclassification is applicable for trade receivables also. Next, cash and cash equivalents. Cash and cash equivalents is always current asset. Like balance with banks, checks, drafts, cash on hand, all these things will show. Short-term loans and advances, same subclassification, everything is same. That's it. So therefore, if you overall look at the balance sheet, even if you know some of the items very well, you can solve the entire question. Some of the items. So what are the items you need to remember? So out of all the balance sheet, sir, I will put some star mark, sir. You revise these items, sir. First, share capital you cover, sir. Reserves and surplus you cover. Long-term borrowings you cover. Okay. Long-term provisions. Short-term borrowings, other current liabilities, short-term provisions. Assets, PPE, intangible assets. Current assets, mostly inventories, trade receivables. Short-term loans and advances. That's it, sir. If you know these items, I think you can easily prepare balance sheet. This is balance sheet, sir. Now come to P&L account, sir. P&L account. Sir, schedule 3 division 1 will give you format of what? Balance sheet. We completed. Next, P&L account division schedule 3. No, division 1 only. Schedule 3 division 1 part 2. Yeah, part 2. Yeah, this one. See this. This is the pro forma of balance sheet, division 1 of schedule 3 part 2, sir. This is. Look at the P&L account. You know, P&L account is generally prepared for the financial performance. Financial position we will prepare balance sheet. Okay. So generally in P&L account, what will come? Incomes and expenses. So see this. First, incomes. Revenue from operations. Revenue from operations means all sales, sale of goods, sale of services, and any, depending upon the nature of company, sir. Revenue from operations means what is your nature of business. Depending upon that, revenue from operations will come. Suppose if you are a finance company, bank, then interest is your revenue from operations. And bank will provide different financial services. For that they will receive commission discount. That is revenue from operations. Suppose if you are not a finance company, like for example you are a normal manufacturing company, then sale of goods, sale of services, or if you are a section 8 company, any grants or donations received, any other operating revenues, these things will come here. So first one, revenue from operations. Next, other income. Other income means, for example, if you are not a finance company, other income can be interest income, dividend income, rental income, all these incomes will come. Then total income. Then expenses. See, expenses, first 3 items are relating to inventory. Cost of materials consumed, purchase of stock in trade, change in inventories of finished good, work in progress, stock in trade. See, most of the students are not having proper grip over it. Important, see this. When you are preparing P&L account, sir, see this. When you are preparing P&L account, Yeah. See, P&L account expenses side. First three items are relating to what? Inventories. Suppose if you are a manufacturer, for you raw material will be there, work in progress will be there, finished goods will be there. For raw material, sir, you need to show consumption in P&L account. How much worth of raw material you consume during the year, that will come in P&L account. How to find out consumption? Opening stock plus purchases minus closing stock. This we will show in the P&L account. See, this cost of material consumed. So this cost of material consumed is relating to raw material. Next, purchase of stock in trade. Next, change in inventories of finished goods, work in progress. Suppose, see, relating to work in progress, finished goods, we need to show what? Change. Change means what? Opening minus closing. The difference between opening and closing. Because, sir, work in progress, finished goods will not have any purchases, sir. Only raw material will have purchases. So opening plus purchases minus closing. Relating to work in progress and finished goods, we have opening minus closing. The difference between opening and closing is change in inventories of work in progress, change in inventories of finished goods. Suppose your opening is 10 lakhs, sir. Closing is 20. What is the change? Minus 10 lakhs. You put this minus 10 lakhs in P&L account. Minus 10 lakhs. What happens if it is minus? Revenue minus expenses. Minus minus plus. That means this 10 lakhs will be included in the profit. Because when your closing stock is more than opening stock, to that excess, that will be obviously included in your profits. That's the logic. Please understand. Opening minus closing. So opening 10, closing 20. Minus 10 lakhs will be presented here. Minus 10 lakhs. So change in inventories of finished goods, work in progress. This is when you are a manufacturer. Suppose if you are a trader, for you stock in trade will be there. Now they say you have opening stock in trade, closing stock in trade. Opening and closing difference, change in inventories of stock in trade, you show separately. Purchase of stock in trade show separately. Purchase of stock in trade separately. That's why you see the schedule 3. Purchase of stock in trade separately, change in inventories of stock in trade separately. So tell me, P&L account expenses side. If you are a manufacturer, relating to inventory, what items you will present? Relating to raw material, consumption. Relating to work in progress, finished goods, change. If you are a trader, you have stock in trade. Relating to stock in trade, two things will show. One, purchases. Purchases you show separately. Next, change in inventories of stock in trade you show separately. Overall, you cover all the items. Next, employee benefit expenses. Employee benefit, all employment related salaries, contribution to gratuity, pension, staff welfare expenses, everything. Next, finance cost. Finance cost means interest. Any borrowing cost at the time of borrowings, all these things. Next, depreciation and amortization expenses. Then other expenses. Remaining and all comes under other expenses like manufacturing expenses, factory expenses, administrative expenses, selling expenses, everything will comes under other. Then total expenses. Total revenue minus total expenses. You will get profit before exceptional, extraordinary items and tax. Then exceptional items, extraordinary items you will adjust. You will get profit before tax. Then tax expenses you will adjust. Then finally you will get the profit or loss for the period. And at the end you are going to show what? EPS. Earning per share. Basic as well as diluted EPS you are going to present. So can you tell me what is the format of P&L? Revenue from operations, other income, total. Then expenses, first one, cost of material consumed. That is relating to raw material consumption. How you are going to get it? Opening plus purchases minus closing. Second, purchase of stock in trade. Next, change in inventories of finished goods, work in progress, stock in trade. Next, employee benefit expenses. Next, finance cost. Next, depreciation and amortization. Next, other expenses. Then total expenses. And you know, when you are presenting a P&L account, sir, one important point you need to remember this one, sir. Any item of income or expenditure which exceeds 1% of revenue from operations or 1 lakh, whichever is higher, need to be presented separately, sir. Remember this point. Any item of income or expenditure, it should exceed 1% of revenue or 1 lakh, whichever is higher. If that income and expenditure above this level, make sure that it has to be presented separately. So that's it. These are the important points relating to P&L accounts. And in our CMA material, sir, we have one concept relating to tax, sir. Tax concept is there. Relating to that question is also there. That concept also I will explain, sir. This one. Provision for income tax, advance tax and assessed tax of prior year. And also, sir, contingent liabilities and commitments. What is contingent liability? See, contingent liability means it can be defined in two ways. Basically, I told you liability means what? Present obligation from past events, the settlement of which requires outflow. Suppose if there is no present obligation, there is a possible obligation, then it becomes a contingent liability. Second, there is a present obligation, but there is no probable outflow of resources as of now. That is also contingent liability. Because to become a liability, present obligation with probable outflow of resources, two things must be there. If any one of them missing, then it is contingent liability. For example, any claims against the company not acknowledged as debt. Suppose some third party filed a case on the company in the court, but company not accepted. That means the case is pending in the court. So if I lose the case, I have to make the payment. If I don't lose the case, I need not required to make the payment. Whether I will make the payment or not, only future decides. As of now, we don't know. So it's a contingent liability. Similarly, guarantee given. Suppose a company has given a guarantee. For example, parent company has given a guarantee on behalf of subsidiary company for bank loan. Now, the moment guarantee given, there is an obligation. But as of now, there is no probable outflow of resources. Because as long as my subsidiary company is financially stable, it is making the payment, I am not liable. When I am liable, when my subsidiary company fails, I need to pay the amount because I have given a guarantee. That means even though there is an obligation, there is no outflow of resources as of now. That's why guarantees given is also which liability? Contingent liability. So if there is a contingent liability, don't take it in balance sheet. Show in notes to accounts. Similarly, there is one more concept called commitment. What is commitment? Commitment means company has committed something. The future things company has committed something is called commitment. So any kind of commitments we had, they are also not assets now. They have to be shown in the notes to accounts only. Best example is estimated amount of contracts on capital account. Any contracts we need to execute, and also any uncalled liability on partly paid shares and other shares, for shares and other investments partly paid up. See, this is important. Uncalled liability on partly paid shares. Suppose they are talking about our investments. Suppose if you invest in any company, your company invested in any other company. Suppose you invested in 1 lakh shares. Each share 10 rupees. They called 7 rupees. So that means till now you paid 7 lakhs. How much they called, sir? 7 rupees. 1 lakh shares. How much you paid? 7 lakhs. Still how much they have to call? 3 lakhs. 3 rupees, sir. This is called commitment. When they call, I will pay. When they call, I will pay. This is called uncalled liability on partly paid up shares and other shares. So if there is any commitment, anything to be done by the company for the contracts already entered, that is called commitment. In future, when that activity happened, when that commitment fulfilled, then it may become a asset. As of now, it is not an asset. Therefore, it has to be shown separately in the notes to accounts, like how we are presenting contingent liabilities. Hello. See, there is one concept called provision for income tax, advance tax and assessed tax of assessed tax. I will discuss about it. So now I am going to solve some questions relating to financial statements of company. We have discussed all the theory. So let's discuss some questions, sir. Okay, now let us see the questions relating to financial statements of company, sir. Illustration number 2, you see. See, there is a company, sir. They are preparing balance sheet on 31st March 2023. The accountant of ABC Limited is confused regarding classification of the following: trade payables into current, non-current. So we need to classify when it will be classified as current, when it is classified as non-current. You know, the normal operating cycle of the company is given how much? Advise the accountant on classification with reason. First, you see, amount 3,10,000, which is due from 1st April 2022, which is settled on 18/5/2023. You are preparing balance sheet on 31st March 2023, correct? See, First one liability you take, sir. Suppose I am taking this 3,10,000. Say this. It is due from 1/4/2022. What is the normal operating cycle? 15. So add 15 months to it. Because we need to see whether it is going to be settled within 15 months. Any liability which is settled within the normal operating cycle is a current liability. Suppose if I add 15 months from 1/4/2022 to 15 months, it is 1st July 2023. Correct? But when they are settling the liability, they are settling on 18/5/2023. That means they are not settling within the normal operating cycle. They are settling. Correct? The moment you see they are settling within the normal operating cycle, it is which liability? Current liability. That's it. Current liability. Hello. This one. See the second one also. 1,80,000. It is due from 1/6/2022. Add 15 months to it. So if I add 1,80,000, correct? Hello? 15 months means from here to 15 months, sir. 15 months means see this, actually 1/6/2022 is the due date, sir. Due from 15 months. If I add, it will be 1/9/2023. That means, am I settling within 15 months? No. Or second thing you need to see. What is that second thing? Is it required to be due to be settled within 12 months from the reporting date? Suppose you are preparing financial statements on 31st March 2023. You are preparing financial statements on 31st March 2023, na sir. From here to 12 months means 31st March 2024. You are not settling within this 12 months also. It is not due to be settled within this 12 months. It is not due to settle within the normal operating cycle. Therefore, definitely it is which liability? Non-current liability. Non-current liability. So like that you need to check. Suppose, because they said to become a current liability, any one criteria satisfied sufficient. Either it has to be settled within the normal operating cycle or within 12 months from the reporting date. Here both failed. Therefore, it is not a current liability. Hello? Suppose you take this 2,30,000 amount, sir. 2,30,000. This fifth one you see. 2,30,000. It is due from 6/3/2023. From here to 15 months, if I add it, it will be 6th June 2024. When they are settling it? 5/7/2024. That means they are not settling within the normal operating cycle. Okay. Next, what is the year end? 31st March 2023. 12 months means 31st March 2024. They are not settling within 12 months also. It is not due to be settled within the 12 months also. Therefore, it is which liability? Non-current liability. Like that you check whether it is expected to settle within the normal operating cycle or at least due to be settled in the next 12 months. If both fail, non-current liability. If any one satisfies, current liability. Next, illustration number 3, you see just now this concept I have explained. Suppose there is a manufacturer and trader. Manufacturer come trader. He is provide you the following details. You are required to draft an extract of the statement of P&L and also show the relevant notes to accounts. Sir, if you are a manufacturer, for you raw material is there. I told you relating to raw material what we need to show? Consumption. How to get consumption? Opening plus purchases minus closing. See this, opening plus purchases minus closing. So 2 lakhs plus 5 lakhs, 7 lakhs, 7 lakhs minus 2 lakh 50. 4 lakh 50. See this, consumption in P&L account. 4 lakh 50. Correct? So relating to work in progress, opening, closing, see. Raw material consumption is this. Opening plus purchases minus closing. Relating to work in progress, change. Opening minus closing. 1,20,400 minus 1,50,200. How much? 29,800 minus 29,800. Minus 29,000. Next, finished goods also we need to show. Opening minus closing. 5,10,000 minus 3,50,000. How much? 1,60,000. Positive or negative? Positive. Sir, you need to compare opening minus closing. Opening 5 lakh 10, closing 3 lakh 50. So same as it is figure you take. Next, relating to stock in trade, sir. Purchases we need to show separately, change we need to show separately, but purchases not available. So therefore directly we need to show changes. So 59 minus 1,25,000. Negative 66,000. Overall 64,200. That they have presented here. Hello. Next. So next come to illustration number 7, sir. This is 14 marks question, sir. Illustration number 7, which is there in the study material. Important question, sir. This question, if you see, they have tested already 2 times in examination. December 2023 examination question 3 and 5, same only. Okay. Same question. If you solve this question, automatically those 2 questions will automatically get solved. Now see this question, everybody. See, whenever first year they have given what? Trial balance, right? They have given the trial balance. Sir, basically trial balance, debit balances, credit balances. Debit balance indicates what? See, debit balance always assets and expenses. See this, debit balance indicates assets and expenses. Credit items indicates liabilities and incomes. You keep that in mind. Suppose, see this question, sir. There is a company PQR Limited. They have registered with a nominal capital of 20 lakhs. That means authorized capital. Divided into shares of 100 each. The following trial balance is extracted from the books on 31st March 2023. Look at the items they have given, sir. PP, buildings. Where it will come, buildings? PP, correct? PP. That means non-current assets. Machinery, PP. Closing stock, inventories, current assets. Loose tools, generally inventories, if nothing specified. Sometimes if it is satisfied the definition of PP, then they will be classified as PP. Next, purchases adjusted, P&L account, purchases. Salaries, P&L account, employee benefit expenses. Directors fees, other expenses. Rent, other expenses. Depreciation, P&L account, depreciation and amortization. Bad debts, other expenses in P&L. Investments, assets, either it can be current or non-current. I assume non-current. Hello. Next, interest accrued on investment. Interest accrued on investment. That means investment is my asset, na sir. On that investment, if any interest accrued, that is my other current asset. Interest accrued, but and receivable. So this is my other current asset. Other current asset. Next, debenture interest. Finance cost, P&L account. Advance tax. Advance tax. Advance tax is current asset. In current asset, short-term loans and advances. Short-term loans and advances. Next, sundry expenses, other expenses. Debtors, trade receivables. Bank, cash and cash equivalents. Next, sales, revenue from operations. Outstanding expenses, other current liability. Provision for doubtful debts, opening this is. Generally, provision for doubtful debts is deducted from debtors. Next, equity share capital, shareholders fund, share capital. General reserve, reserves and surplus. P&L account, 31st March 2022, that means opening balance. Reserves and surplus. Creditors, trade payables. Provision for depreciation on building, on machinery. Provision for depreciation is reduced from the cost of the asset. Here asset is given, machinery, buildings. See, provision for depreciation separately given means building and machinery is at what value? Cost. Next, debentures. Long-term borrowings. Next, interest on debentures accrued but not due. Other current liabilities. Interest accrued but not due, I told you. Next, interest on investments. Other income. Other income. Interest on investment. Incomes. Next, unclaimed dividend. Other current liabilities. Other current liabilities. Next, you are required to prepare statement of P&L for their ending and balance sheet as on the date after considering the following information. Closing stock is more than opening stock by 3,20,000. Sir, important. Closing stock is more than opening stock by how much, sir? 3,20,000. Already closing stock given, sir. How much? 3,60,000. That means closing 3,60,000, which is more than opening stock by 3,20,000. That means opening stock is 40,000. 40,000 is the opening stock, closing stock is 3,60,000. Now you know here purchase is adjusted given. What is the meaning? In the trial balance already closing stock is there. In the trial balance already closing stock is there. How to find out COGS? Cost of goods sold is equal to opening stock plus purchases minus closing stock. See, already generally, sir, in the trial balance closing stock will not appear. But they have given closing stock, means by the time closing stock valuation is already done. Correct? It is adjusted. Therefore, I want purchases, but they have given adjusted purchases. So, what I need to do? See this. COGS is equal to opening stock plus purchases minus closing stock. If I want purchases, what I will do? COGS minus opening stock plus closing stock. COGS already available. What is that? Adjusted purchases 8,40,000. So 8,40,000 plus closing stock 3,60,000 minus opening stock 40. That means 8,40,000 plus 3,20,000. Correct? How much, sir? 11,60,000. This is purchases we need to consider. 8,40,000 plus 3,60,000 minus 40. How much? 11,60,000. Correct only, na? This is what we need to take. Next, provide doubtful debts at 4% on debtors. Debtors we need to create a 4% provision. See, important adjustment, see this. Sir, already debtors how much is there? 5 lakhs. On that I need to provide 4%. I need to maintain. So 5 lakhs into 4%. How much, sir? 20,000. Provision I need to make. Correct? Already my opening provision is how much? 12. That means 8,000 during the year I will create. So P&L account debit to provision. So in P&L account other expenses I will write 8,000. And in the balance sheet, current assets, trade receivables, debtors minus provision for doubtful debts 20,000 I will do. That means my opening 12, my closing I need to maintain 20. Bad debts already there in the trial balance, adjusted. Please understand how much provision I need to maintain. 4% on debtors. Debtors is how much? 5 lakhs into 4% means 20,000. 20,000. This is the closing provision I need to maintain. Already my opening provision is how much? 12. Therefore, current year provision I need to create 8,000, which is debited to P&L account other expenses. And in the balance sheet from debtors you need to reduce closing provision 20,000. Next, depreciation expenses included depreciation 32,000 on billing and that of 48,000 on the machinery. P&L account, depreciation and amortization. I will show depreciation 32,000, 48,000. Sir, depreciation is already there in the trial balance. See this, 80,000. That 80,000 breakup they have given 32, 48. See here they have given provision for depreciation. Provision for depreciation means total depreciation. So in this total depreciation already current year depreciation is also included. Next, transfer to general reserve how much? 10%. That means from current year profits I need to transfer 10%. Next, directors proposed a dividend of 25%. Sir, remember sir, any proposed dividend is not a liability. Because once board of directors propose a dividend, later on it should be approved by shareholders. So just proposal happened. Therefore it cannot be considered as liability. Last one, bills discounted but not yet matured 40,000. Sir, any bills of exchange discounted with bank but maturity date not came. This is current liability. Sorry, contingent liability. This is which liability? Contingent liability. Because maturity date, due date not came, no sir. So as of now it's not a liability for us. Suppose on the due date the party has not paid, then I am liable. Company liable. As of now it is which liability? Contingent liability. Now see this. Sir, how I am going to solve the questions relating to this financial statements of company? First, you start with the format. Don't write entire format. While reading the question itself, you identify which items will come. Accordingly, you first write down the format. Which format you will start with? Balance sheet, then P&L, then notes to accounts. Okay. Suppose, see here. First, I will start with the balance sheet, equity and liabilities, shareholders funds, share capital, note 1, reserves and surplus, note 2. Money received against share warrant, not there. Share application money pending allotment, not there. Next, non-current liabilities, long-term borrowings is there. Long term borrowings, debentures is there. Next, any deferred tax liabilities, not there. Other long term liabilities, not there. Long term provisions, not there. Then current liabilities, short term borrowings is there. Any short term borrowings? No. Next, trade payables is there. Next, other current liabilities there. Short term provisions there. Short term provisions, sir. Short term provision for tax is there na. That's it. Now liability asset side, non current assets, PP is there. Yes. Intangible assets not there. Investments, yes. Non current investments. Next, deferred tax assets, no. Long term loans and advances, no. Next, other non current assets, no. Next, current assets. In current assets, first one, short term current investments, not there. Next, inventories there. Then trade receivables. Then cash and cash equivalents. Short term loans and advances, yes. Advance tax is there. Then other current assets is there, yes. Interest accrued on investment. Then come to P&L account. P&L account, revenue from operations. Sales is there. Other income, there. Other income is there. Yes. Interest on investments, there. Then total. Expenses, cost of material consumed, not there. Purchases is there. Change in inventories, there. Closing opening stock difference. Next, employee benefits, there. Finance cost, there. Debenture interest. Hello. Depreciation and amortization. Other expenses remaining. Over. Now first balance sheet presentation, then P&L presentation, then notes to accounts. But when it comes to completion, first complete P&L account. Why? Because only if you complete P&L account, you know the current year profit. From that current year profit, you need to create provision for tax. It will go to balance sheet, reserves and surplus. Only when you prepare P&L account first, you can complete reserves and surplus. See how I am going to approach this question. See this. This is how I will solve in the class. Say this. Particulars. Equity and liabilities. Shareholders funds. Share capital note 1. Reserves and surplus note 2. Long term borrowings note 3. Current liabilities trade payables. Directly I have written 3,68,000. OCL other current liabilities note number 4. Short term provisions note number 5. Asset side you see non current assets PPE and intangible assets. In that PP is there note number 6. Non current investments. Investments are assumed as non current. Current assets inventories note 7. Trade receivables note 8. Cash and cash equivalents is there. Short term loans and advances advance tax is there. Other current assets interest accrued on investments is there. Now P&L account I started. Revenue from operations sales I have taken 20,80,000. Other income interest investment income 48,000. Expenses you take important sir. Cost of purchases. See adjusted purchases they have given in the question. I have find out the actual purchases 11,60,000. Change in inventories means the difference between opening and closing stock. Opening stock 20, closing stock 3,60,000. Opening 40, closing 3,60,000. Total minus 3,20,000. Employee benefit expenses already given in the question. How much given employee benefit expenses? Hello, salaries 2,40,000. Next, finance cost, debenture interest is there. Depreciation amortization is there. Other expenses remaining. What items will come in other expenses? Important sir. Note number 9. See this. Directors fees, rent, bad debts, sundry expenses. Look at provision for doubtful debts. Provision for doubtful debts 5 lakhs into 4% minus opening provision 8,000 I created during the year. So therefore it will be part of my other expenses. So my other expenses is 2,48,000. So then I got my total expenses. So total revenue 21,28,000. Total expenses 15,20,000. So therefore 6,08,000 is what sir? Profit before tax. On the tax expenses 30%. 1,82,400. This is my profit for the period, which will go to balance sheet, reserves and surplus. Now once I complete P&L account, then I will go to balance sheet. First share capital. Look at how I am presenting share capital. In the question, first authorized capital given 20,000 equity shares of 100 each, 20 lakhs. Then issued, subscribed and paid up capital. How much share capital is issued, subscribed and paid sir? See this. Equity share capital 8 lakhs is there. Face value 100. 8 lakhs divided by 100 means 8,000. So see this 8,000 equity shares of 100 each fully paid up 8 lakhs. This is how you need to present in the examination. So 8 lakhs is your paid up share capital. Write this 8 lakhs in the balance sheet. Next reserves and surplus. Go to reserves and surplus. In reserves and surplus, what will be the general reserve given? 1,60,000. And in the additional information they said that from the current year profits how much you transfer to general reserve? 10%. So current year profit is how much sir? 425,600. From this 425,600, 10% will go to general reserve. So general reserve closing balance is 2,02,560. Come to P&L account. Opening balance given in the question is how much? 1 lakh. See this. And what is the current year profit? 4,25,600. From this, how much we transfer to general reserve? 42,560. So 3,83,040 is the P&L current year, and opening balance 4 lakhs. So 1 lakh. So total 4,83,40. So total 6,85,600 is the reserves and surplus which will go to balance sheet. And then long term borrowings, they have given what? Debentures taken. Next, trade payables directly taken. Other current liabilities. What items are there in other current liabilities? Unclaimed dividend is there now. Interest on debentures accrued but not due. Outstanding expenses. 3 other current liabilities are there. If you want, you can check it. Whenever you want to check liabilities, go to the credit balance directly. See this. Outstanding expenses, interest on debentures accrued but not due, unclaimed dividend. These 3 items. And then short term provisions, I will take what? Provision for tax, which I created. Then PP. How I am presenting PP? Everybody check this. Building less provision for depreciation. This is how you need to present. Cost of the asset minus accumulated depreciation. Plant and machinery. And then inventories. Loose tools, closing stock. Trade receivables. See, balance. Trade receivables given 5 lakhs minus closing provision for doubtful debts 20. 4 lakh 80. Other expenses remaining and all I will show. So automatically balance sheet get tallied. Okay. And then advance tax, where it will come, sir? Short term loans and advances. So that's it, sir. This is one question they have tested in examination also, sir. December 2023, I think one examination question. This the same question they have tested. Okay. Next, sir, question number 2, sir, in our question bank, which is June 24 attempt question, sir. June 2024 attempt question, 14 marks question. Similar question to December 22. June 2023 also same question asked, sir. Same question repeated in 2024, June 2024 attempt, same question repeated. You see, this is the question they have given. Okay. Now, very good question actually. See this question. See, they have given the trial balance of a company Star Limited, sir. Okay. Trial balance given, sir. Same debit balances, credit balances, sir. Stock in trade on 1/4/2023. That means opening stock 3 lakhs. Purchases 9 lakh 80 will go to P&L account. Salaries, P&L account, other employee benefit expenses. Freight and carriage, P&L account, other expenses. Furniture, PP. Contribution to PF, employee benefit expenses. Rent and rates, other expenses. Stationery, other expenses. Repairs, other expenses. Insurance, miscellaneous expenses, other expenses. Interim dividend paid. Interim dividend paid. See, any dividend paid is an appropriation from profits. It is not an expense. What you need to do is you need to deduct from the P&L, in P&L, from profits you need to deduct it. Don't show it as an expenses. Dividend, provision for tax, transfer to general reserve, these are all appropriations. So here interim dividend paid. Paid means it is not a liability, but it is paid. Sir, generally dividend is paid from current year profits. So therefore this 36,000 will be deducted from reserves and surplus P&L account balance. Okay. Next, staff welfare expenses, employee benefit expenses. Plant and machinery, PP. Cash at bank, cash and cash equivalents. Patents, intangible assets, PP. PP and intangible assets. Trade receivables. Stationery. I think wrongly printed, sir, because already stationery came here. Next, credit balances, purchase returns. Deduct from purchases. Sales, revenue from operations. Discount received, other income. Discount received. Discount received, sir. See this. Revenue from dividend, discount received, dividend received, that is discount. Yeah, see this. They have presented this as a part of revenue from operations. So discount is related to sales. Discount is related to sales. So here discount received. Yeah, sorry. Yeah, when you make a purchase, you receive, na, sir. So generally in sir, other operating revenue includes discount received and bad debts recovery, which this point is there in the study material, sir. So therefore here they are given discount received, na, sir. This discount received can be considered as what? other operating revenue. Therefore, it is part of revenue from operations. Hello. Actually, this point is there in the study material. If you want, you can check it, sir. Other operating revenue includes discount received and bad debt recovery. Both points are there. Okay. Next, balance of P&L account 60,000. Reserves and surplus. Share capital, shareholders funds. Share capital. Trade payables, current liability. General reserve, reserves and surplus. Now, next what happened, you see. You are required to prepare the P&L account and balance sheet after taking into account the following information. Closing stock given, sir, 3,52,000. Opening stock is there here. The difference between opening and closing is change in inventories, which will go to P&L account. Make a provision for income tax, 30%, short-term provisions. Depreciate plant and machinery 15%, furniture 10%, patents 5%. P&L account. Depreciation and amortization. Outstanding rent to outstanding salaries. What you are going to do outstanding rent and outstanding salaries? Outstanding means expenses incurred but not yet paid, which will come in other current liabilities and also will be added to the corresponding expenses in P&L account. Next, directors recommended a dividend of 15% for the year, including interim dividend. After transfer to general reserve 8,000. Sir, any dividend recommended, proposed is not a liability. So therefore, don't consider this as a liability. But interim dividend already paid. So that we need to consider. And we need to transfer to general reserve how much? 8,000. Next, provide 2040 for doubtful debts. That means we need to create a provision for doubtful debts 2040. Hello. The authorized capital given, and out of which 40,000 shares have been issued and fully paid. Okay. Notes to accounts should form part of your answer. So this question they have tested in June 2024 attempt, sir. Now how you are going to approach? Same. First balance sheet, then P&L. Balance sheet, equity and liabilities, shareholders funds, share capital, reserves and surplus. Then non-current liabilities, long-term borrowings. Any long-term borrowings? No. No borrowings at all. Hello. So non-current liabilities will not come. Current liabilities. In current liabilities, short-term borrowings not there, but trade payables is there. Trade payables is there. Other current liabilities is there? Huh? Yes. This outstanding rent, outstanding salaries. Then short-term provisions is there? Huh? Yes. Provision for tax. You see this here. So shareholders fund, share capital, reserves and surplus. Current liabilities is there. Trade payables, OCL, short-term provisions. Asset side, you see, what are the assets we had? PP. We had PP. Plant and machinery is there. Intangible assets also there. Intangible assets. Patents, nothing but. Furniture is also there in PP. So PP is there, intangible asset is there. Now come to current assets. Current assets we have investments not there. Inventories is there, right? Closing inventory. Trade receivables is there, debtors. Trade receivables is there, right? Yes. 1,30,000. And cash and cash equivalents is there. This is the balance sheet. Then P&L account, revenue from operations is there. Sales, sir, nothing but how much? 13 lakhs? 60,000. See this. Here 13 lakhs 60, 12,000. Total 13 lakhs 72,000. Next, other income is not there. Total revenue. Then expenses. Expenses, purchases is there. Huh? Yes. See this. 9,80,000 minus purchase returns. 9,80,000 minus 40. 9,40,000. Change in inventories is there, right? The difference between opening and closing. Opening 3 lakhs. Closing 3,52,000. Difference minus 52. Then employee benefit expenses is there, right? What items are there in employee benefit expenses? Salaries is there, 1,20,000. Contribution to PF 20,000 is there. And also staff welfare expenses 10,000 is there. You see note number 9 I have prepared. So salaries, outstanding salaries also I should add. In the additional information, outstanding salaries is there. That is added. Contribution to PF, staff welfare expenses. Then depreciation. Depreciation they have given us, sir, rates 15%, plant and machinery, furniture 10%, patents 5%. So note number 10 I have given. So look at this. Plant and machinery, furniture, patents apply. Depreciation rate, you will get total depreciation 25,160. Remaining and all comes under other expenses. So other expenses, what items will be there? Freight to salaries, rent rates, stationery, repairs, insurance, miscellaneous expenses. This one, provision, provide 20/40 for doubtful debts. This one, doubtful debts we need to provide. That is also forms part of other expenses. See this, other expenses. So freight, rent rates, stationery, repairs, insurance, miscellaneous expenses, rent, outstanding rent, because rent basically will comes in other expenses only. Outstanding rent should also comes in other expense. And provision for doubtful debts. Sir, in the last problem already 12,000 provision is there. Closing we need to maintain 20,000. Therefore current year we created 8,000, that is debited to P&L. But in this question there is no provision for doubtful debts. We created total. Therefore it is entirely will come in P&L account current year. Okay. So first we close the P&L account, sir. Sir, when you are giving numbering also, see sir, first you start with balance sheet, sir. 7. From 8 onwards you need to give it to P&L account. Okay. Continuation. Now once you got the profit, create a provision 30%. 35,000, 75,600 is provision for tax. This is the profit. Now come to balance sheet. First share capital, authorized share capital. Then issued subscribed capital. Reserves and surplus, you see general reserve, add current year transfer. P&L account given how much? 60. Current year profit how much? 176,400. Look at interim dividend paid, I deducted. Dividend paid, interim dividend paid is reducing my profits, deduct. And also transfer to reserve, deduct. So you will get 1,92,400. Other current liabilities, outstanding rent, salaries you take. Short term provisions, provision for tax. PP, how I am presenting, say this. Given minus depreciation for the current year. This is how you need to present. Intangible assets, patent is there. Relating to intangible assets, depreciation is there, na? Minus. Trade receivables, balance, minus provision you created, 20/40. This is how you need to present the things. So what is the new point you learned in this question? Tell me. The new point you are learning in this problem is, first thing is discount point. Easily you will show it in other income, but you have to consider it as other operating revenue. First point. Second point, interim dividend paid. Interim dividend paid is deducted from reserves and surplus. Paid means it is not a liability yet. So therefore don't consider in other current liabilities. Deduct only from the profits. I told you any dividends, provision for tax, these are all appropriations. Don't show them as expenses. Hello. This is one question, sir. Sir, after this question you solve question number 9, sir. December 2022. Question number 7, June 2023. Same questions they have given, sir. Same questions they have given. One more question I will solve, sir. Question number 6. Yeah, this question. Question number 6. You see this question, June 2023 question, sir. They have given NM Limited particulars. They are asking only balance sheet. Okay. Debit balance, credit balance is given, sir. Equity share capital 50 lakhs given, which will go to share capital. Building PPE, plant and machinery PPE, furniture PPE, general reserve. Loan from State Financial Corporation, long-term borrowings. Inventories, raw material, finished goods, both are part of current assets inventory. Provision for tax, short-term provisions. Trade receivables, short-term advances, current assets, short-term loans and advances, because it is having a debit balance. P&L account, reserves and surplus. Cash in hand, cash at bank, cash and cash equivalents. Unsecured loan, long-term borrowings. Trade payables. Now, additional information you see, important. 10,000 equity shares are issued for consideration other than cash. Just now I told in schedule 3. If shares are issued for consideration other than cash, we need to mention notes to accounts. That two things we need to mention: aggregate number, class of shares. See, that's why when I'm preparing this question, you see this. When I presented share capital, 50,000 equity shares of 100 each, fully paid, 50 lakhs. Out of the above, 10,000 equity shares are issued for consideration other than cash. I mentioned it because of schedule 3. This is the difference between normal proprietorship financial statements, partnership financial statements and company financial statements. Because in case of company financial statements, we need to follow schedule 3. Schedule 3 says when you issued any shares for consideration other than cash, you need to mention in the notes to accounts. And also trade receivable 2,60,000 are due for more than 6 months. This point also I told. Debtors outstanding for a period exceeding 6 months we need to show separately. Therefore, when I am preparing a balance sheet, you see, I will show you trade receivables. Outstanding for a period exceeding 6 months I shown separately, others I show separately. This is one point, sir. And also cost of the assets given, sir. They have given cost and they have given here depreciation. Here they have given WDV of the assets. These are WDV of the assets. This is the cost of the assets. The difference is what? Depreciation. So when you are presenting in the balance sheet, sir, cost WDV, difference is depreciation. Like that you need to present like this. See this. Cost WDV they given. The difference is nothing but depreciation. Sir, whenever you are presenting relating to PPE, present like this. PPE, cost, depreciation, net amount. Cost, WDV they given, net amount is depreciation. Like this you need to present. It is mandatory as per schedule 3. And the balance of 7,50,000 in the loan account with State Financial Corporation is secured by what? Hypothecation of plant and machinery. Actually, see, the loan from State Financial Corporation is how much? 7,50,000. In this 7,50,000, they are saying that, okay, the balance of 7 lakh is okay, secured by hypothecation of plant and machinery. Okay, secured by hypothecation of plant and machinery, I told you. Whenever any borrowings are secured, we need to mention the nature of security. So that's why, see, when I'm presenting in long-term borrowings, I will show you. See this, loan from SFC 7,50,000 secured by hypothecation of plant and machinery, I shown note. This is also as per schedule 3. Balance of bank includes 10,000 with Galaxy Bank, which is not a scheduled bank. That means our bank balance is how much? 12,35,000. Correct? See this. Our bank balance 12,35,000. In this clearly said, balance with scheduled Galaxy Bank is how much? 10,000, which is not a scheduled bank. So therefore, I need to present with the scheduled bank. I have 12,25,000. With others 10,000. This is how I need to present, sir. Transfer of 20,000 to general reserve as proposed by board directors. I need to deduct. General reserve, I need to add to general reserve, I need to deduct from the current year profits. So this is how the presentation will be done, sir. So this is how the balance sheet will be prepared. See this. Share capital, reserves and surplus. Now when it comes to reserves and surplus, you see general reserve 10,50,000. How much is transferred? 20. This transfer to general reserve is deducted from the profits. Sir, generally to general reserve profits will be transferred from, amount will be transferred from profits only, na, sir. So you need to deduct from P&L, you need to add to general reserve. That's it, sir. This is one question, sir. So here they have not given answer, sir, but I solved in the classroom. 94,78,500. So these are the questions, sir. Generally they will ask you in the examination. So main important questions I solved. You see these questions once. And one more concept I told, na, sir. What is that? Advanced tax, provision for tax concept. That concept I will explain, sir. Just 5 minutes I will explain. And there is a question also I will, so that we can complete this chapter. Yeah. See this concept, sir. Listen to me carefully. Income tax, advance tax, assessed tax. Sir, every company in India, they need to pay advance tax. See, when you pay advance tax, what is the entry? Advance tax to bank. Advance tax is what? I told you, asset, current asset, where short-term loans and advances. It is an asset for us. So during the year 24-25, suppose you paid advance tax, company paid advance tax. What is the entry? Advance tax to bank. Now, advance tax means what? Even without completion of year, based on the past, based on the previous year's income, I am estimating my current year income and I am deciding the tax liability and I am paying amount to government in advance. Now, once the year completed at the end, I will know the correct profit of the year. So, once I know the correct profit, I will determine the tax liability of the current year. For that, I will write an entry called P&L account debit to provision for tax. When I pay advance tax, what is the entry? Advance tax to bank. At the end, I decided the tax liability. What is the entry for that? P&L to provision for tax. Now, there is something called assessed tax. Once year completed, na sir, generally what happens is we will file return of income. Generally this year return of income will be filed in the next year. Now once you filed the return of income, department will assess the tax liability, correct? Here three situations will come. One situation is department assessed tax, your provision for tax, both are same. Second, department assessed tax may be more than the provision you created. Third situation, department assessed tax is less than the provision for tax. Three situations will come. So first advance tax, then at the end you create a provision for tax, then assessed tax. Assessed tax, three situations. What are those? Assessed tax is equal to provision for tax. Assessed tax more than provision. Assessed tax. First, suppose assessed tax is equal to provision for tax. When assessed tax or provision for tax both are same, no further provision is required. No further provision is required. Whatever the tax liability you calculated, whatever department decided, both are same only. Then what you need to do is, you need to compare your provision for tax with advance tax. Here, advance tax, assessed tax, both are same. Advance tax, assessed tax or provision for tax, both are same. Then both will be set off. That means the entry is what? Provision for tax to advance tax. Already advance tax is your asset. Provision for tax is a liability. Both will be set off. So the entry is provision to advance tax. Suppose sometimes advance tax you paid is less than the assessed tax. Less than the assessed tax. That means provision you created. Then what is the entry? Provision for tax 10 lakhs, to advance tax 8 lakhs. Remaining balance you pay now 2 lakhs to the government, to bank. Sometimes advance tax is more than the assessed provision you created. Then in that situation you will get tax refund. So therefore provision for tax to advance tax, the amount difference is IT refund. So you understanding the situation? Sir, first situation number 1, you pay advance tax to cash or bank. At the end you create a provision, P&L to provision. Now assessed tax, provision, both are same. I am discussing this situation. Situation number 1, same. That means no further provision is required. Then you need to compare advance tax with your assessed determined tax. Both are same. Adjust them. Advanced provision for tax to advance tax. Suppose advance tax is more, you will get refund. Advance tax is less, you need to pay the balance now. Hello? Now sometimes what happens now? Your assessed tax is greater than the provision for tax. Suppose you create a provision for 10 lakhs, but department says your liability is 12. Therefore, for 2 lakhs you need to create a provision now. Additional provision is required. What is the entry for that? P&L to provision for tax. But this 2 lakhs belongs to which year? Last year. But you are creating provision in the current year. That's why this is called prior period item in the current year financial statements. So, prior period. So, this is. Now, once this is done, you need to do the same treatment again. Like advance tax, provision for tax, you compare. If advance tax to provision for tax is equal, set off. If it is more, refund you will get. If it is less, you need to pay the amount. The treatment is same. Suppose your assessed tax, provision for tax, your assessed tax is less than the provision for tax. Suppose department, you created a tax liability of 10 lakhs, but assessed tax is only 8 lakhs. That means you created excess tax liability, right? So excess provision will be written off. In your books, excess provision will be written back. What is the entry for creation of provision? P&L to provision. Same entry will be reversed. Provision to P&L. Now once you adjust, then compare with advance tax, provision for tax, and accordingly 3 cases will come. So you understanding what I am saying? So tell me, what is the situation? First you pay advance tax, what is the entry? Advance tax to cash or bank. At the end of the year, what do you do? Provision. What is the entry? P&L to provision. Next, assessed tax. 3 situations will come. What are those? Assessed tax equal to provision. When assessed tax equal to provision, any further provision required? No. When assessed tax is greater than provision? When assessed tax is greater than the provision created, we need to create a provision for further tax liability. Correct? When assessed tax is less than provision, excess provision created will be written off. Written off, not refunded. Refund question will arise Only when you compare advance tax with assessed tax. First you need to decide what is my assessed tax. What is the assessed tax? What is the provision I created? Both equal. Assessed tax is greater than this, less than this. Once you decide this, next come to compare with advance tax. If your advance tax provision both are same, then you adjust. If there is balance you need to pay, you pay it. Excess you pay, you will get refund. That's it. Hello? And how the presentation will be done? Tell me. Advance tax will come in current assets, where short-term loans and advances. Provision for tax, short-term provisions. And in P&L account, current tax, tax expenses will come in current tax, deferred tax. Like that, two things will be there in tax expenses. In P&L account, once you got revenue minus expenses, you will get profit before tax. After that, we need to present tax expenses. Hello? See, one question is there. I will show you that. See, relating to tax, this question is there. Illustration number 4. Important question. See this question once. The following are the extracts of trial balance of Y Limited. When, sir? 31st March 2023. So, current year 22-23. See this. Provision for tax 21-22. Last year 4 lakhs. Last year advance tax paid 3 lakh 60. Current year TDS 20. Current year advance tax paid 2 lakhs. That means even TDS is also nothing but advance tax only we paid. Hello? So that means current year advance tax is 2 lakh 40. 2 lakh 40. Current year 2 lakh 40. 2 lakh 20. 20 plus 2 lakhs. Correct? Next. Assessment for the year 21-22 were finalized during the year 22-23. Last year assessment was done in the current year generally. The total tax liability for the year is fixed at how much? 4 lakh 40. Last year how much provision you created? 4 lakhs. How much is the tax liability? 4 lakh 40. That means assessed tax 4 lakh 40. Provision you created 4 lakhs. That means assessed tax is more than provision you created. So excess provision required. 40,000 you create in the current year. Hello? Next. And the net amount payable for the year 21-22 has not yet been paid. Okay. The net profit before tax for the year 22-23 amounted to 8 lakhs current year. Balance of P&L account at the end of 21-22 was 4 lakhs. Last year opening balance. Assume corporate income tax 35%. You are required to draft P&L account for the year ending 31st March 2023 along with the relevant notes and also extract of balance sheet. So two things they are asking, sir. They are asking P&L account as well as balance sheet. See, first to see the P&L account, sir. What is the current year? 22-23. When you prepare P&L account of the current year, what is the current year profit? 8 lakhs. Correct? See this. Current year profit. 8 lakhs. Profit before tax. After that, we need to show what? Tax expenses. From profits, we need to deduct tax. Tax. How much is the current tax? 35%. Everybody? So 35%. Apply 35% current tax. See this. 8 lakhs into 35%. How much? 2,80,000. So this is the one current year tax. At the same time, last year tax liability was fixed in the current year at 4 lakh 40. Therefore, balance how much we need to create? 40,000. Say this. 40,000 we created in the current year. This is prior period tax. Actually, 21-22 related year tax provision we are creating in the current year. So that's why we call it as what? Prior period tax, 40,000. But we are creating from current year profits only. 22-23 profits. So therefore your tax liability is how much? 3 lakh 20. You understand this 3 lakh 20? 2,80,000 is current year tax. 40,000 belongs to last year but created from the current year profits. So total 3 lakh 20. See this, 3 lakh 20. So profit for the period 4 lakh 80. P&L presentation done na? So in P&L account what we show? Tax expenses. Current tax plus provision required for the last year also created. Now balance sheet extract, how they will show? See this balance sheet. In balance sheet, sir, current liabilities. What is that? Current liabilities. In that short term provisions is there na? In that short term provision we will show provision for tax. What is the current year provision for tax, sir? Current year provision for tax given. Hello? 35%. How much we got? 2 lakh 20. 80. 2,80,000. Current year tax will be current year provision for tax. Last year you check 3,60,000 is the advance tax last year, correct? Provision how much? 4 lakhs. And later it was increased to another 40,000. So it is 4,40,000. How much you paid? 3,60,000. How much is the balance? See this, IT payable 80,000 is part of other current liability, which is relating to which year? Last year. So last year your tax liability, your provision 4 lakhs, later it is increased to 4,40,000, but you paid advance tax in the last year only 3,60,000. What is the balance, sir? 80,000. That will come where? Other current liability. It is no more a provision. It is other current liability. Provision is created only for current year tax. This is last year's. That means already liability created. Fixed 4,40,000. In that 4,40,000 in the form of advance tax we paid 3,60,000. So therefore remaining 80,000 will show here. Hello. So this is how the presentation will be done. You understand this, sir? This is the treatment, sir. So therefore the final conclusion is when you pay advance tax to bank, at the end you create a provision, P&L to provision. Then assessed tax, you done. Assessed equal to provision. No further provision is required. Assessed more than provision. Provision create a provision in the current year. Assessed less than provision. Excess provision you return back. And once you determine the assessed tax, compare with advance tax. Adjust both of them. If advance tax is less, you pay the balance now. If it is more, you will get refund. That's it. This is the concept, illustration number 4, sir. Okay. Next topic we are going to discuss is accounting for right shares, sir. Very small topic, but sometimes they are asking a question from this. First of all, what is right shares? Whenever company wants funds, further funds, one of the option available to the company is what? Issuing shares. If these shares are offered to the existing shareholders, and obviously when company exclusively offering shares to the existing shareholders, they will become their rights. That's why these shares are called what? Right shares. So basically what is right share? Right shares are the shares which are offered by the company to its existing shareholders at what price? Concessional price in proportion to the existing shares. Now when company offered shares to the existing shareholders, the existing shareholder will have a right. Either he can subscribe or he can renounce his right. That means he can transfer his right to some other person. He can transfer his right to subscribe the shares of the company to another person. Now, see in case of right shares, sir, right shares, what is the accounting treatment? The accounting treatment is similar to that of issue of shares, sir. Like generally when a company issues shares, what is the entry? Bank to share capital, right? Here also same. When company issued right shares, when application money is received from the shareholders, bank account debit to share application to share capital. And if shares are issued at premium, we will transfer the amount to a separate account called securities premium account. But in right shares chapter, sir, one of the important topic is calculation of value of right. This is what they are testing in the examinations. Calculation of value of the right. Suppose I am an existing shareholder, company offered me right shares and I want to transfer this right to another person. Then I need to calculate the value of right. What is the value of this right which is given by the company to me? How to calculate the value of right? There is a formula. Value of right is equal to market price minus average price of the share. Before right issue, what is the market price? We need to see. From that market price, we need to deduct the average price of the share. Average price of the share means after right issue, what is the average price of the share? Before right issue, what is the market price of the share? The difference is nothing but value of right. This is according to ICMA study material, sir. If you see the ICMA study material, they have given like that. So the value of right is equal to market price minus average price. Now market price they will give you. You need to find out average price. Sir, how to find out average price? Average price is also known as TERP, theoretical exercise price per share. Average price is equal to market value of the existing shares. Existing shares market value plus proceeds from right issue. How much amount is received by issuing right shares divided by number of existing shares plus right shares. So this is the formula. Market price of the existing shares plus proceeds from right issue divided by number of existing shares plus right shares. Then you will get the average price. The difference is nothing but value of right. Market price, average price. First you need to find out average price because market price is given in the question itself. For example, there is a company A Limited. Number of equity shares 2. Suppose there is a shareholder who is having 2 shares. Now company offered him 1:1 basis. 1:1. That means for every 1 share you are going to get 1 share as a right share. Suppose the market price of the share is 20 rupees. Company offered him at 15 rupees. Now I need to find out the value of right. How to find out value of right? Market price 20 minus average price I need to find out. How to find out average price? Market price of the existing shares. Existing how many shares? 2 into market price 20. So 2 into 20, 40 plus how much company received by issuing of these right shares? 1:1 basis they are issuing now. 2 shares into each share 15 rupees. 2 into 15 divided by existing shares 2 plus right shares 2. So therefore it will be 17.5. This is the average price per share. Nothing but the book value per share. Book value price per share. 17.5. So the difference is 2.5 per share. This is value of right. What is the meaning of this? The meaning is I am already having 2 shares, right? 2 shares. The value of each share is 2.5. That means 2 into 2.5 is how much? 5 rupees. So therefore I can sell my right for 5 rupees. If I sell my right for 5 rupees, say this, what happens? Before right issue, I am having how many shares? 2. What is the market price? So what is my wealth? 40. After right issue, how many shares I will have? 2. Because I am not subscribing, I am transferring my rights to some other person. So my shares will be 2. But what is the average price per share? 17.5. That means it is 35 only. That means how much is the shortage? 5. This I will recover through sale of rights. This I will recover through sale of rights. So 5 rupees. So that means, that's why I said value of right is 2.5 per share. Per share. That means like that I have 2 shares. So 2 into 2.5, 5 rupees I am going to get. Therefore my position will remains unchanged before right issue, after right issue. Okay. This is how you calculate the value of right. You see, come to see this question which is there in the study material, illustration number 1. A company is planning to raise funds by making rights issue of equity shares to finance its expansion. The existing equity share capital of the company is how much? 50 lakhs. They want to raise the funds. The market value of the share is how much? 42. The company offers to its shareholders the right to buy 2 shares at 11 each for every 5 shares held. So for every 5 we will give you 2 shares. Okay. And what is the market price of the share? 42. You are required to calculate theoretical market price after right issue. This is nothing but what? Average price per share is called theoretical price per share. This is. And the value of right they are asking. Value of right is nothing but market price minus average price. Correct? And they are also asking percentage increase in share capital. Okay. Now see. I want to calculate the value of right. How to calculate value of right? Value of right is equal to market price minus average price. Market price already know 42. So I want what? Average price. How to find out average price? Average price is equal to market value of the existing shares. How many shares? 5. 5 into 42 plus proceeds from right issue. For every 5 shares they are giving 2 shares. At 1 share is given at what value? 11. 11 each. 11 divided by existing shares 5 plus right shares 2. So can you tell me? 5 into 42, 2 into 11, 232 divided by 7. How much, sir? 33.14. 33.14. What is this? Average price per share. So therefore the value of right is equal to, say this, market price minus theoretical market price, that is 8.86. 42 minus 33.14, 8.86. 8.86. This is the answer, 8.86. Sir, this 8.86 is per share. 8.86 into 5. Because I am having 5. How much I will get? 44.3. 44.3 rupees by sale of this rights. And they are asking theoretical market price after right issue. Just now I calculated 33.14. What is the percentage of increase in share capital? Percentage of increase in share capital? Sir, already existing share capital how much, sir? 50 lakhs. Now company offering 2 shares for every 5 shares, right? That means 50 lakhs into 2 divided by 5. That means 20 lakhs. They are increasing. Correct? Increase 20 lakhs. So therefore find out percentage. 20 lakhs divided by 50 lakhs into 100. 20 divided by 50. So 40% increase in the capital, share capital. Here most of the students, what they are not understanding is this one. This 8.86 relevance is what? This 8.86 indicates that if I am having 5 shares, each share is contributing a value of 8.86. That means if I transfer my right to you, what is the right I had? Because I am having 5 shares, company is offering me 2 shares to purchase. That right, if I want to transfer, how much amount I will collect from you? 8.86 into 5, 44.3 rupees I will collect. Hello? If you want, you can check. See, before right issue, number of shares how many? 5. What is the market price? 42. What is my value? 210. After right issue, how many shares? 5 only, because I am not subscribing, right? What is the average price? 33.1. Therefore, 165.7. So what is the shortage? 44.3. This I am going to collect through issue of rights. Okay. So percentage of increase also they have given. Existing 50 lakhs, sir, and we are increasing 20 lakhs. So 20 divided by 50, 40% increase. So this question they have asked it, sir. Okay. And you know, the same question they given in examination also. I will show you examination question also. So this June 2024 attempt. See this question, June 2024. Same. There is a company and the existing capital is 40 lakhs. They want to raise funds by issuing of right shares. Market value is how much? 45. And they are offering 2 shares at 12 each for every 5 shares. You are required to calculate theoretical market price per share, value of right, percentage increase. Come on, tell me. I want average price per share, correct? Also known as what? Theoretical market price per share. Both are same only. So average price per share, how I am going to find out? Average price. Average price is equal to existing shares 5. 5 into market price 45 plus 2 into 12 rupees divided by existing shares 5 plus 2. Correct? So 5 into 45, 2 into 12. It will be 249 divided by 7. It will be 35.57. What is this? Average price. So theoretical market price per share 35.57. Value of right is nothing but market price minus this one. Market price how much, sir? 45 minus 35.57. How much, sir? 9.43. Percentage of increase? Existing 40, right? For every 5 shares they are giving 2. So 40 lakhs into 2 by 5, it was 16 lakhs. 16 lakhs divided by 40 lakhs. 40% increase. So this is the question. Simple question, they asked it for 7 marks. So this is how easy it is. Okay. And the same question, I think, see this question also. December 2023, same question repeated. Same question, 50 lakhs, every 5 shares, 2 shares. That's why I am repeating. Questions are just repetitions. One more question, sir. Say this. NT Limited has issued capital of 20,000 equity shares of 10 each fully called up. The following decisions are taken by the company: to forfeit 100 shares on which 5 per share has been paid up, and to issue 15 per share as fully paid up. To issue right shares in the ratio of 1 fully paid share for every 4 existing shares held at 15 per share. Assuming that the company has sufficient general reserve, so the above through journal entries. So they are asking journal entries, sir. See here in this case what is happening? First in the company there are 20,000 equity shares, sir. 10 rupees share they called fully, but 100 shares they have not paid the amount. 100 shares of which 5 per share has been paid up, only 5 paid. Remaining 5 they have not paid, and to issue at 15 per share. So company what they have done, they have forfeited the shares, and those forfeited shares have been reissued. And company also decided to issue what? Right shares. 1 fully paid share for every 4 existing shares at 15 per share. Now in this case, first we need to write the entry for forfeiture, right? Hello. What is the entry for forfeiture? Whenever forfeiture happens, share capital account will be debited to the extent of called up capital. How many shares here forfeiting? 100 into what is the called up capital? 10 rupees. So 100 into 10, 1000. 2, we will open one account called share forfeiture account. To the share forfeiture account, we will transfer to the extent of the amount paid till now. How much he paid? 5 rupees. So 100 into 5, 500 rupees. And remaining will be treated as calls in arrears. Company called but not paid. So this is the entry for forfeiture. Next, once forfeiture happened, what company is doing, sir? Reissuing. So when you reissue, what is the entry? Bank account debit. Here 100 shares are reissued at 15 rupees. So 1500. 2, share capital is created with face value always. Share capital is created with face value. Face value is 10. Remaining balance will go to securities premium. Now the most important thing is, on forfeiture and reissue, we will get a profit. We will get a profit. Here see, the shares forfeited, how much amount already received? 500. And at the time of reissue also there is no loss. We reissued for 15. Therefore, entire this share forfeiture account is what, sir? Profit. Which profit? Capital profit. So that's why share forfeiture account debit to capital reserve. Capital reserve. We know share forfeiture account. We need to find out the law. What is the profit we earned? So when shares are forfeited, in respect of the forfeited shares, already we collected 500. And at the time of reissue, if there is any discount we given, first that discount will be adjusted, remaining profit will transfer to capital reserve. But in this case, there is no discount. Even reissue is also happened at above face value. So therefore, entire forfeiture account will be transferred to capital reserve. And now company is offering what? Right shares. What is the ratio? 1 fully paid up share for 4 existing shares. How many existing shares are there? 20,000. Because we cancelled and reissued. Therefore, your existing shares will be 20,000. For every 4, 1 share. At rupees 15. Each share is issued at 15. See this. So therefore, what is the entry, sir? Bank account debit to share application. 75,000, 75,000. And share application to share capital to securities premium account. So because whenever shares are issued at premium, the amount will be transferred to premium accounts. So this is the question. And this is the value of issue of right shares chapter, sir. Very small topic, sir. But I told you which is the question they are frequently testing in exams. Value of right. How to find out value of right, sir? Market price minus average price. How to find out average price, sir? Market value of the existing shares plus proceeds from right issue divided by existing shares plus right shares. A kind of an average price. Compare both. The difference is value of right. I explained the significance of that value of right also. That indicates what is the value of right per each share. So it will give me information relating to at what price I can sell my rights. Okay, sir. The next chapter we are going to revise is banking companies, sir. Banking companies, sir, definite 7 marks question will come, sir. If you see the banking companies, sir, we can divide this chapter into 2 parts, sir. First part is special areas, sir. Second part is format of financial statements of banking companies. But if you observe what they are asking in exams is only special areas they are asking. Because if at all they want to ask, of course, in financial statements of banking companies, they may test, P&L account. Balance sheet, it is not possible. Why? Because if at all they want to test a balance sheet, they should, P&L account balance sheet they want to test, they have to test it for 14 marks. Very difficult. So only 7 marks they can accommodate. So the important areas are what? special areas. So what are the special areas in banking companies? If you learn these special areas, definitely you are going to get one question out of it. Okay. What are the special areas? Rebate on bills discounted concept, prudential norms in respect of banking companies like income recognition, asset classification, provisioning norms, interest on doubtful debts, one concept is there. There is one small problem like in acceptances, endorsements and obligations, secured, unsecured portion of loans. These are the 5 topics are there in special areas. Let us start one by one, sir. First, rebate on bills discounted. See, I'm going examination point of view, sir. Examination point of view, the first area you need to focus is what, sir? Rebate on bills discounted. Sir, what is this rebate on bills discounted? Very simple, sir. Think from bank point of view. We are discussing banking company, right? See, one of the major functions bank will do, major services bank will offer is discounting of a bill. Whenever a customer had any bill, before maturity date, if you want funds, what he can do? He can discount the bill with bank. What bank will do? After deducting some discounting charges, bank will give the money to the customer. And on the due date, on the maturity date, the party who accepted the bill will make the payment to bank. Now think from bank point of view, this discount, what bank is deducting, bank point of view, it is a income. But the problem is whether the total discount amount will be income of the current year, because every bill will have a period, right? Out of that period, some period may fall into the next year, but discounting has happened in the current year. So therefore, discount relating to the period which falls after 31st March, which falls after this year, will be not income of the current year. Therefore, that discount, what we need to do? We need to reverse it. We need to transfer to an account called rebate on bills discounted. Next year, that will become our income. Suppose, for example, you see. Suppose, sir, there is a customer, there is a bill, sir. He discounted this with bank on 1st February 2025. Okay. And the bill period is 3 months. 3 months bill, sir. Date of discounting is 1st February 2025. That means when this bill is going to expire? When 3 months means February, March, April. April, 30th April 2025. That means 1 month falls after 31st March. See this. Suppose bill discounted, sir. When bill discounted, what is the entry bank will write is bills purchased and discounted account will debit bank, customer account will be created, and discount account will be created, because this is my income. So it is created, all incomes. Total bill 10,000, 9,700 will be given to customer, 300 will be discount. But this discount is for 3 months, right? So if I apportion this discount, 200 belongs to current year, 100 belongs to next year. But discounting is happened in the current year itself, and you have already recognized 300. In this 300, 100 is not income of the current year. So therefore, what they will do is at the end of the year, they will reverse 100. That means discount account they will debit 100, and they will transfer this amount to an account called rebate on bills discounted. It is like a income received in advance. Income received in advance is a liability for us. So therefore, this rebate on bills discount will have a credit balance which will come on the liability side of the balance sheet in the bank. So discount account debit to rebate on bills discounted. Next year, the same entry will be reversed. Next year on 1st April 2025, rebate on bills discounted account debit to discount account. Because this 100, what I have reversed and transferred to rebate on bills discounted, it is my income for the next year. So next year, this will be cancelled and credited to discount account. Now you tell me, in the current year 24-25, how much I will transfer to P&L account? See this. 300 is my discount minus rebate on bills discount and 100. 200 I will transfer to P&L account. 200 I will transfer to P&L account. This is the concept of discounting on rebate on bills discounted. So whenever discounting happened, what is the entry? Bills discounted purchased and discounted account debit to customer account to discount account. And at the end, in this discount, whatever discount belongs to the next year, we will reverse it. What is the entry for that? Discount to rebate on bills discounted. Next year, the same entry will be reversed. Rebate on bills discounted to discount account. Correct? Now see, sir, generally how this discount will be calculated? How this discount will be calculated? There is a methodology. Discount is calculated like this. Take bill amount into rate of interest into number of days after 31st March divided by 365 or 366. If it is a leap year, 366. If it is a non-leap year, 365. Then you will get the discount amount. Okay. So this is the concept of rebate on bills discounted. Suppose, see this question. I will show you one question, sir. Important question. See this question. This question asked in June 2024. Same type of question. You see, calculate rebate on bills discounted on 31st December 2023 from the following data and show journal entries for adjustment. Date of bill 15/10/2023. Amount 50,000. Period how many? 5 months. Rate of discount 8%. See, on which date you are calculating, sir? 31st December 2023. That means they are following calendar year. 31st December 2023. So next year 2024. Correct? Now I am going to calculate discount, rebate on bills discounted. First bill you take 50,000. Due date is, see, from here to 15 months. Correct? So that means October. 15th October, November, December, January, February, March. March 15th plus 3 days. March 18th. So this due date. March 18, 2024. Correct? Now from 31st December 2023 is over. Next year, January 1st, 2024. How many days will fall after 31st December? Days after 31st December. So January 31 days, February 29 because it's a leap year. Yes, 2024 leap year. 29 days plus 18 days. Total 78 days. That means discount relating to 78 days belongs to next year. So therefore 8%. See this, 50,000 into 8% into 78 divided by 366. So 852.46 is the rebate on bills discounted in respect of bill number 1. Correct? Now come to second bill. 10/11/2023. 30,000 bill. 10/11/2023 expiry date, due date 4 months. Now that means December, January, February, March. March 10 plus 3 days. 13th March. How many days will come after 31st December 2023? January 31, February 29, March 13. Total 73 days. 7% discount. So therefore 30,000 into 7% into 73 divided by 366. How much, sir? 418.85. Similarly, you need to calculate for each bill how many days will fall after 31st December. Proportionate discount relating to that will be rebate on bills discount. Then you add everything, you will get 3169.12. 3169.12. Now this is rebate on bills discounted. That means this is income of current year or next year? Next year. So what is the entry you will write? Discount account debit to rebate on bills discounted. So this discount to rebate on bills discounted. This is one question, sir. Question number 4, illustration number 4, very good question actually. See this question. On 31st March 2022, Victory Bank Limited had a balance of 18 crores in rebate on bills discounted account. So on 31st March 2022, sir, Victory Bank Limited had a balance of how much, sir? 18 crores in rebate on bills discounted. Already it is there. That means last year rebate means current year income. Next, during the year ending 31st March 2023, Victory Bank Limited discounted bills of exchange of how much? 8,000 crores, charging interest at 18% per annum. The average period of discount being for how many days? 73 days. Of these, bills of exchange of 1,200 crores were due for realization from acceptor or customer after 31st March 2023. That means, sir, tell me, current year this bank has discounted how much worth of bills? 8,000. So if you find out the discount on this 8,000, see this. Total discount of the bank is 8,000 crores, 18% rate of interest for 73 days divided by 365. So total 288 is the discount for the year. Correct? In this 8,000, 1,200 crores will due for realization from customers after 31st March 2023, and the average period outstanding after 31st March is 36.5. So calculate discount relating to this 1,200 crores. 1,200 crores, 18%, 36.5 days will fall after 31st March. So the proportionate discount is how much? 21.6. This is rebate on bills discounted at the end. Correct? That means my current year income, current year discount 288 minus 21.6. The balance will go to P&L account. And also opening is there, sorry. Opening how much is there? 18. So therefore my current year income is opening plus current year discount minus closing rebate. Opening rebate plus current year discount minus closing rebate. 284.4 will go to P&L account of the current year. So if I write the entries, how will I write first entry? Closing rebate, now I will recognize as discount of the current year. So therefore what is the entry? Rebate on bills discounted to discount. 18. That means I created to discount. Next current year there was a discounting happened. Bills purchased and discounted 8,000. Discount 288. Customer account 7712. And at the end rebate how much we created? 21.6 relating to 1,200 crores. 36.5 days average period falls after 31st March. So therefore finally how much will get transferred to P&L account, sir? 284.4. So they will ask this rebate on bills discounted and discounting on bills account also. So based on the entries you have to pass them. Okay, this is the first concept they will ask, sir, relating to banking companies. Next, prudential norms, sir. Next one is what? Prudential norms. What is this prudential norms? See, every bank is governed by RBI. RBI is the apex institute which is controlling the functions of banking. Time to time, RBI will give so many rules. Those are called prudential norms, which is to be followed by banks. Now, in the prudential norms, the first one we need to focus is what? Income recognition. This is important. Very simple. Sir, what is the major income for the bank? Interest. Because bank will give loans and advances. Bank will give loans and advances and charge interest. So interest is the major income for the bank. And loans and advances. Bank will give loans and advances. From these loans and advances, they will receive interest. How this interest will be recognized? Now the RBI guideline says you need to classify the loans and advances into two categories. Performing, non-performing asset. NPA, non-NPA. Sorry, PA, NPA. PA means performing asset. NPA means non-performing asset. If it is performing asset, income is recognized on accrual basis. Accrual basis or due basis we need to follow. If it is a non-performing asset, cash basis or receipt basis we need to follow. Sir, when we say loans and advance is a performing asset, when we say it's a non-performing asset, they have given a guidelines. We'll see them. Okay. See, to your surprise, I will show you. See this question. To your surprise, in June 2023, sir, they have asked one question. See this question for 4 marks. In this question, what they have given? They have given advances of a commercial bank. Performing asset, non-performing asset, given separately. Interest earned, interest received, given. Just now I told you, they are asking how income will be recognized. What is the basis? Tell me. If it is a performing asset, accrual basis. Non-performing asset, receipt basis. Just that one is asked for 4 marks. Just what you need to do, just that simple principle you should know. So here, in case of performing asset, add these things. How much came? 240 plus 1500 plus 300. 2040. Non-performing asset, add these things. Received. 10 plus 24 plus 40. 74. Add everything. 2114. This you need to write. So for this 4 marks will be given. So what's its simple principle? So therefore in examination, sir, they are not testing Hi-fi questions, simple concepts only they are testing. Only this much if you know, I think you can get through. Okay, this is one concept, sir. Next, sir, in prudential norms, I told you in prudential norms, first income recognition you done. Next one is what? Asset classification. Next, provisioning norms. Asset classification and provisioning norms. Let us discuss asset classification, which is most important, sir. Sir, listen to me carefully. Sir, every bank at the end of the year, what they need to do? They need to create a provision. Why? Because they are doing such a risky business. They are giving loans and advances. There is no guarantee that everybody will repay the amount. Therefore, bank is doing a very risky business. Therefore, RBI wants the bank to create appropriate provision on their loans and advances. Now, to create a provision, first of all, they need to classify the loans and advances, because RBI has given how much provision you need to create. They have given a list. For that, they made some classification. For some standard asset, this is like that. For substandard asset, this much you need to create. For doubtful asset, this much. For loss asset, this much you need to create. Like that, RBI has made a classification. Similarly, at the end of the year, every bank has to classify its loans and advances into these categories. See, basically, sir, loans and advances are classified into two categories: performing asset, non-performing asset. Performing assets are called standard assets. That means he is a good customer, he is making payment continuously. Interest and principal payment regularly he is making. That is called performing asset, standard asset. In case of performing asset, no need, provision is required, but less provision is required. See, there is no such thing as 100% risk eliminated. Risk will obviously there. So he is a performing asset now, he is a standard asset, but we don't know. Anytime he may not pay the amount. Therefore, performing assets are what? Standard assets. Standard asset means what? Yeah, the customer who is making the payment regularly without having any risk. Generally, there is no risk. See this. Performing or standard assets. Performing asset is a standard asset which does not disclose any problem. Next. Non-performing asset. Sir, when we say a loans and advances is NPA, non-performing asset. Sir, when customer is not making the payment, principal or interest, then there is a chance that loans and advance may be classified as NPA. But till what period, sir? If it exceeds, we call it as NPA. Generally, they say if any amount, installment or principal in respect of any loans and advances is outstanding for a period exceeding 90 days, overdue for a period exceeding 90 days, then that will be called as what? NPA. If there is any installment or principal overdue for a period exceeding 90 days in respect of bills purchased and discounted. In respect of term loans also same. If any customer is not making the payment of interest and principal, and if it is overdue either wholly or partly for a period exceeding 90 days. If it is cash credit overdraft, suppose OD is there. OD is also type of loans and advances. In case of OD and cash draft, sir, they said when we call that OD as NPA, means when it becomes out of order. When OD account has become out of order, OD or cash credit. When we say it is out of order, when outstanding balance continuously in excess of the sanction limit or drawing power for a continuous period of 90 days. Sir, when your outstanding balance is more than the sanction limit continuously for a period exceeding 90 days, then we say bank will assume that your account is NPA. NPA, out of order. Out of order means NPA. Or suppose your outstanding balance is less than the sanction limit, but no credits in your account from the past 90 days. More than 90 days, there was no amount is created into your account. Or you created, but that amount is not sufficient even to pay the interest also. Hello? So they may test this in examination. Please understand. What we are discussing, classification of loans and advances. Banks will classify the loans and advances into two categories: performing, non-performing. When we say loans and advances NPA, if it is a bills overdue for a period exceeding 90 days. If it is a term loans, overdue for a period exceeding 90 days. If it is cash credit and overdraft, if it becomes out of order. When we say it becomes out of order, if your outstanding balance is continuously in excess of the sanctioned limit for a continuous period of 90 days, and also suppose your outstanding balance is less than the sanction limit, but there were no credit in your account from the last 90 days, exceeding for a period of 90 days, there was no amount is credited, or you credited but it is not sufficient even to cover the interest, then bank will classify your cash credit or overdraft account as what? NPA. And agriculture advances, sir, sometimes banks will give agriculture loans, na sir. In case of agriculture loans and advances, when the loan is considered as NPA, if it is a short duration crops, we will wait for 2 crop seasons. If it is a long duration crops, 1 crop season we will wait. If it is a short duration crop, 2 crop season. If farmer or customer is not paying, then it is NPA. Otherwise, if it is a long duration crop, 1 crop season. So therefore, you tell me, if, or can I assume like that, if any loans and advances overdue for a period exceeding 90 days, in general 90 days, then that becomes NPA. Now, once it becomes NPA, first 12 months, it is called substandard asset. It is called substandard asset. Look at the journey. I am first performing asset, standard asset. If I started delaying payment, if there is a overdue in interest and installment, then I will become NPA. Once I become NPA, first 12 months, substandard. 12 months exceeds, doubtful. One day I will become loss. So therefore the journey is substandard, doubtful, loss asset. What is standard asset? Do not disclose any problem. What is substandard asset? Easy. Substandard asset is an asset which is classified as NPA. Already it is classified as NPA for a period not exceeding 12 months. That means once it is classified as NPA, first 12 months, substandard. Once it crosses the 12 months, an asset would be classified as doubtful if it has remained in the substandard category for a period at least 12 months. Once any loans and advances is there in the substandard category for at least 12 months, at least means 12 or more, then obviously considered as doubtful. And one fine day it will become loss asset. For example, RBI come to inspection, they have seen your loans and advances and they said this customer is not paying the amount, let's book the loss, identify him. So therefore the internal, external auditors and RBI inspectors says you need to write off this loan amount completely, then it becomes a loss asset. Like this asset will be classified. So tell me, loans and advances are classified as first standard asset. Performing asset is called standard asset. Next, non-performing asset. Non-performing asset is substandard, doubtful, loss. Once it becomes NPA, up to which period it is substandard? 12 months. Once 12 months over, doubtful. After that, loss. Now look at the provision. How much provision I need to create? Important, sir. They may ask a question. You need to remember these rates. They won't give. You need to remember these rates. See this. Standard assets. Standard advances or standard assets? Nothing but performing asset. Correct? See this. In standard assets, direct advances to agriculture and SME, small medium sector, 0.25% is required. Agriculture and SME. Commercial real estate sector, 1%. Others, 0.40. Very less, because these are what? Standard category. So tell me standard category, agriculture to SMEs, 0.40. Real estate, 1. Others. So therefore if there nothing mentioned, you need to take others. Next, come to substandard category. Substandard assets, you need to divide into 2 categories, secured, unsecured. Sometimes customer may give security, sometimes he may not give security for the loan. Suppose secured portion, 15% you create a provision. Unsecured relating to infrastructure loans, 20%. Unsecured others, 25%. So in unsecured you need to say again, is it relating to infrastructure? Then 20%. If it is others, 25% provision bank need to create. Doubtful advances, come to doubtful category. Unsecured portion, 100% provision we require. Doubtful advances, secured portion, important. Once it is there in doubtful, secured, we need to divide into 3 categories. D1, D2, D3. D1 is up to 1 year. D2 is 1 to 3 years. D3 is more than 3 years. So up to 1 year, more than 1, up to 3, more than 3. See this. D1, 25%. D2, 40%. D3, 100%. And loss assets is obviously 100% provision we need to create. So this is what we need to do, sir. This is what we need to do. So there were questions. Simple. So many questions are there relating to this. Okay. See this, sir. Illustration number 7. So they have given the advances of banks, sir. They are asking us to calculate the amount of provision. Tell me. Standard category. 0.4. Correct? Substandard. Substandard we have secured, unsecured. If nothing given means secured, unsecured. Secured. So what is the amount for secured, sir? 15%. Just now we discussed. Hello. Secured category. 15% you take. Next. Doubtful for 1 year. 2 years. 3 years. 100%. More than 3, 100. Loss assets, 100. See this. This is how the provision will be created. Now here in provisions, one important concept, sir. See this. Any provisioning for advances covered by ECGC, DICGC guarantee, Export Credit Guarantee Corporation, Deposit Insurance Credit Guarantee Corporation, ECGC, DICGC guarantee. Sir, sometimes these institutions, ECGC and DICGC, Deposit Insurance Credit Guarantee Corporation, Export Credit Guarantee Corporation, both are government undertaking, public sector undertakings. So these undertakings will give guarantee to the banks for the loans and advances they have given. So in case of advances guaranteed by ECGC or Deposit Insurance Credit Guarantee Corporation, provision is required only for the balance amount of advance outstanding in excess of the amount guaranteed by corporation. Suppose, see how we are going to calculate provision in this case. First you need to take the amount outstanding. What is the amount outstanding you take? From that, realizable value of the security. Any security is there as a security for the loan. Any asset given as a security for the loan. What is the realizable value? Deduct it. Then ECGC, how much they are giving guarantee? Deduct it. These institutions, how much they have given guarantee? Remaining balance is what? Unsecured portion. And on this unsecured portion, we need to create a provision. Of course, for secured portion also we need to create provision. First we need to find out the unsecured portion. On the unsecured portion we need to create 100%. And for secured portion, depending upon the situation, doubtful 1 na, 2 na, 3 na, we should create a provision. Okay, total provision you will get. So this is how we need to calculate, sir. ECGC, DICGC cover, nothing but. For example, you see this question, illustration number 9. This question tested in June 2025 examination question, sir. See in this question you see, suppose there is a bank, sir. So term loans, export loan, two types of loans are there. Outstanding loan balances 35 lakhs, 30 lakhs. See this DICGC, ECGC cover is there for these loans 40%, 50%. These institutions has given a guarantee. Security is also there 15, 10 in respect of these loans. But what is the realizable value of securities? 10, 8. We need to consider the realizable value of securities. Calculate the provision to be made. How? Tell me how, what I told. First you need to take amount outstanding 35, 30. From that first we need to reduce realizable value of securities. Correct? 10, 8. Then you will get 25, 22. From this I need to reduce ECGC, DICGC cover. ECGC, DICGC cover 40% for term loans. 40% is 10. Correct? So 25 into 40%. And also for export credit 50%. 22 into 50%, 11. So unsecured portion 15, 11. For this unsecured portion, 100% provision will be created. For secured portion, since there is, see, interest was not paid since March 2022. Not paid. So we have not paid any interest since March 2022. I think there is a difference here. Maybe they have not paid from the last 3 years. So therefore, consider this also 100% for secured portion. So 10, 8. So therefore, total provision required is what? 25, 19. You understand this? So see illustration 10, sir. Illustration 10 is a combination of both. In these 2 bits are there in illustration 10. See this. From the following information, find out the amount of provision to be made in P&L account of a commercial bank. Package credit outstanding from food processors 90 lakhs, against which bank holds securities worth of 22.5. 50% of the above advance is covered by ECGC. The above advance was remained doubtful for more than 3 years. So therefore, tell me how you are going to create provision in this case. First 90 lakhs we take. From that, I need to reduce realizable value of securities. We have a securities worth of 22.5. So that is realizable value. Correct? So 90 minus 22.5, 67.5. From this, I need to reduce ECGC cover 50%, 33.75. So unsecured portion 33.75. So therefore, on this unsecured portion, I need to create 100% provision. And for the secured portion, how much provision you need to create? Since it is doubtful for more than 3 years, D3. So obviously 100% provision we need to create for doubtful portion, that is 22.5. So total provision 56.25. Second bit, you know, standard assets 0.4, substandard 15%, doubtful for 1 year 25, 2 years 40%, more than 3 years 40, more than 300, this one. So this is the concept of provisioning norms. So in prudential norms, we have completed everything. Income recognition, how banks will recognize income, we discussed. And asset classification, how banks will classify the assets, and how to create provision for the bank, discussed. Next, interest on doubtful debts. See, there is one question in the study material relating to this. We'll see this question so that you will understand this concept, sir. This question, sir, first question you see. Interest on doubtful debts. See this. They are closing books of accounts on 31st March 2023, sir, bank. And there is a loan ledger, an unsecured balance of how much, sir? 2 lakhs in account of a merchant whose financial condition is reported to as bad and doubtful. So there is a customer from whom we need to receive 2 lakhs is outstanding balance on 31st March 2023. But his financial condition is bad and doubtful. Interest on the same account amounted to 20,000 during the year. Interest on loan is how much? 20,000. How do you deal with this item of interest in 22-23? See, bank, whenever recovery is doubtful, what bank will do is, bank cannot recognize that interest as correct income, straightforward income. They have to transfer this to an account called interest suspense account. See this. Next, what happened? During the year 22-23, the bank accepts 75 paise in rupee on account of total debt due up to 31st March 2023. Okay. Show the entries and necessary accounts showing the ultimate effect of the transactions in 23-24 accounts of the bank account under interest suspense method. See here. First of all, sir, from customer, how much is the loan amount we need to recover? Say this 2 lakhs opening balance, right? What is the interest? 20. That is transferred to interest suspense account. So therefore, merchant to interest suspense 2020, customer account debit to interest suspense account. Now this is the balance at the end, 2,20,000. Now later on, sir, how much bank accepted? 75 paise. That means 2,20,000 into 75. How much? 1,65,000. Cash we received. Correct? So therefore, 1,65,000 we have recovered, sir. And what is the interest suspense account? Amount of interest not covered. Total interest 20,000, right? In that 25% means 5,000. Interest portion not covered. Interest suspense account. What is the total bad debts? 50,000. Hello. See, total amount is 2,20,000, right? In that 20,000 is interest. So see this, interest 20,000 into 25%. Bad debts principal portion into 25%. 20,000 into 25, 5,000 and 50,000. Total 55,000. Correct? So bad debts 50, interest suspense 5, cash we received 1,65,000, 2,20,000. Now come to interest suspense account. What is the total interest? 20. In this 20,000, how much is recovered? 5,000 not recovered. I mean 5,000 is not recovered. So 15,000 will go to P&L account. 75% recovered na. So therefore what banks will do is, whenever any interest doubtful, they will transfer to an account called interest suspense account. So merchant account debit to interest suspense account 2020. Later on they collected the amount, interest not received and balance is transferred to bad debts. What is the interest they not received? 5,000. Interest suspense account is cancelled by 5,000. It is not going to recover. Bad debts I booked 50,000. Bank has to book a bad debts. Merchant account is credited with 55,000. Later on amount received, cash to merchant. How much we received? 75%. 65? 65. That means interest suspense account ultimately how much is transferred to P&L account? 15,000. That means current year my interest is 20. In that not recovered 5,000. So therefore 15,000 is my income which is transferred to P&L account. So therefore merchant to interest suspense to merchant, interest suspense to P&L account. Interest suspense to P&L. I am talking only about interest. So therefore easy. While preparing 22-23 accounts, a sum of 20,000 due from the merchant on account of interest should not be carried to P&L account because its recovery was doubtful. It should therefore be transferred to interest suspense account, which would appear as a liability in the balance sheet on 31st March 2023. So in this case, sir, 20,000 is first transferred to interest suspense account, sir. Later on in this, how much is not recovered? 5,000 we will cancel, sir. Remaining 15,000 we will transfer to P&L account, sir. That is what we have prepared in interest suspense account. If you see, interest suspense account total 20,000. In that 5,000 is cancelled. Remaining 15,000 is our income, which is transferred to P&L account. This is one concept, sir. Next, there is one more concept, sir. Acceptances, endorsement and obligations. See this. What is this? Acceptances, endorsements and obligations. Acceptances, endorsements and obligations. Sir, one of the functions of the banking sector is what, sir? On behalf of customer, they will provide so many services. Like on behalf of customers, they will give guarantees. They will accept bills. All this, they will accept endorsements. They will do endorsement. All these functions banks will do, na, sir? Yes. See, whenever a bank undertakes any liability, on behalf of customer, by way of giving guarantees, acceptances, endorsements, what banks will do is, they will maintain one separate account called acceptances, endorsement, other obligation account. But this account, this is a memorandum account, sir. There is no double entry here. There is no double entry system here. Just this account is maintained by the bank to record what liabilities we accepted on behalf of customer. Out of these liabilities, how much liabilities was settled, seized. And at the end, we will know still how much liability we have accepted on behalf of customer. How much balance is there. See, sometimes what happens, for example, on behalf of customer, we have given a guarantee. If customer doesn't honor the guarantee, we will honor the guarantee. That means it is not a liability now. In future, it becomes a liability. So these are all like contingent liabilities for the bank. These are all what? Contingent liabilities for the bank. So that's why bank will not record them by following double entry system. What banks will do, they will just maintain one account called acceptances, endorsements, other obligations account. Now in this account, what they will do, whenever they undertake any liability, they will credit this account with customer name. On whose customer, on behalf of which customer I accepted it, I will write. Now later on, when the liability ceases or settled, I will debit customer account, this account. This is not a double entry system. This is memorandum account, not part of double entry system. Just for control purpose, record purpose, banks will maintain this account. See, in the study material we have one question relating to it, sir. I will show you. Till now they have not tested, sir, this question. Maybe they will test. But very simple, sir, very simple. See illustration number 2, sir. This illustration number 2 is relating to acceptances, endorsements and other obligations. See this, they are asking, from the following details prepare acceptances, endorsement, other obligation account as would appear in the general ledger. On 1/4/2023, acceptances not yet satisfied stood at 33 lakhs 45, out of which 30 lakhs were subsequently paid off by the client and bank had to honor the rest. On a scrutiny of the acceptance register revealed the following. See this, client P, on behalf of P, how much acceptances by the bank? 15,000. Remarks, bank honor it on 10/6/2023. Next, on behalf of Q, on behalf of R, like that they have given all the details. Now you see, they are asking acceptances, endorsement and other obligation account. Just now I told you, this account is not double entry system. This is just a memorandum account. In this account, whenever bank accepts any liability on behalf of the customer, it will be credited. This account is created with customer name. See this, first we'll start with the opening balance. In this account, how much opening balance is there? 33 lakh 45. See this, 1/4/2023, 3345. It is like liability accounts, sir, contingent liabilities. That way it started with closing, credit side, opening balance. Now you see, in this 33 lakh 45,000, how much is honored? 30 lakhs by the client. So whenever a liability is released or paid, we will debit. See this, two constituents liabilities for acceptances and ours paid by clients, 3,000. 3345 is the opening. In that 3,000 rupees in thousands settled. To constituent liability means customer liability, customer. Next, what is the balance? 345, which is honored by whom? Bank. Because in the question clearly said 30 lakhs is paid by client, remaining is to be honored by bank. So we honor it. Next, during the year, you see, first on behalf of P we accepted 15,000. Hello. So see, what are the acceptances we have done? Whenever we accepted any liability on behalf of customer, we will credit. So with the customer name, see this, constituents liabilities for acceptances and endorsements, 15, 18, 7.5, 12, 7.5, 4.5. You see all these things they have taken. See this, 15, 18, 750, 12, 750, 405. Whenever a bank accepts any liability on behalf of customers, accepts as endorsement, they will credit this. Now out of this, how many are settled? See this, 15 settled. When? 10/6/2023. See this, 10/6/2023 debit. The liability settled, 1500. This was settled. Next, 39/2023, 18 lakhs paid. Hello. Say this, 1800. 18 lakhs. Part paid by party. Whoever pays it, whether banks paid or customer paid it, doesn't matter. Liability accepted or liability honored. So just record that. Next, 7,500. Party failed to pay and bank had to honor. Okay, 7,50,000. Honored by bank. Next. See, last one you see, 12 lakhs, 7.5, 4.5. These three are not honored. Therefore, they will become closing balance. See this. Acceptance is not yet satisfied. So therefore, you understand this acceptance and endorsement account. It is like a memorandum account which we will record what? Liabilities accepted, liabilities honored. Liability accepted, credit side, liabilities paid, debit side. Whatever the liabilities accepted but not yet honored, closing balance at the end. This is one concept, sir. So in the special areas, this is also done. One more area is there, secured, unsecured portion of loan. See, I will show you one question in the study material, sir. This question they tested in examination also. Same question is there in the study mat. Same question they tested in examination. This question, sir. Illustration 5 came in December 2024 attempt. Same question, exact question they have asked. Nothing, no change at all. See this question. See, this question is all about classifying the secured, unsecured portion. See this. The books of a bank include a loan of 5 lakhs, advanced on 31st December 2021. Interest chargeable 16% per annum, compounded quarterly. Every quarter interest will be calculated. Interest on interest, compounded interest. The security for the loan being 7,000 shares of 100 each on public limited company, valued at 90 each. See, for this loan, the customer has given what security? Shares. Shares given. 7,000 shares of a public company, valued at 90 rupees. The value of the share is 90 rupees. There is no repayment till 31st March 2023. And on 31st March 2023, the value of the shares declined to 80. Sir, when we give shares as a security, the value is how much, sir? 90. But at the end of 31st March 2023, the value of the share has become 80, decline. Now, what they're asking, say this, what they're asking, sir, how would you classify the loan as secured, unsecured in the balance sheet? Now, on 31st March 2023, in this, how much is secured, how much is unsecured, they're asking. How much is secured, how much is unsecured, they're asking, sir. How much is the secured portion, how much is the unsecured portion? See this. First of all, tell me, what is the total loan amount? Total loan amount 5 lakhs. Correct? When the loan amount is taken? 31st December 2021. Every quarter, how much interest? 16%. Now, what is the year end? 31st March 2023. Correct? Now you see. First, I will start with 31st March 2022. 31st March 2022. Because loan is taken on December 2021. First quarter means 31st March 2022. First quarter. How much interest? 5 lakhs into 16% into 3 months. How much is the interest? 20,000. So therefore my outstanding loan is 5 lakh 20. Come to next quarter, 30th June 2022. Interest is calculated on 5 lakhs or 5 lakh 20? 5 lakh 20. Compounded interest. Hello. 5 lakh 20 into 16% into 3 by 12. How much? 20,800. This will be added. Now outstanding loan is 5 lakh 40,800. Now same manner, 30th September 2022. 5 lakh 4800, 16%, 3 months, 21,600. So like that, I need to calculate till 31st March 2023. Compounded quarterly. So therefore, what will be my total outstanding? 6 lakhs 8,326. This is my outstanding loan. In this, actual principal 5 lakhs. Interest 1 lakh 8,326. Correct? Now they are asking, this is the outstanding loan, right? How much is secured, how much is unsecured? Secured, how many shares is given? 7,000. What is the realizable value now? 80 rupees you need to take, not at the time of given. Now 80 rupees. Hello. So 7,000 into 80, how much? 5 lakh 60. Therefore, in this 5 lakh 60 is secured portion. Remaining is unsecured portion. 48,326. This question they asked for 7 marks here. Same question they tested for 7 marks. And even, no need to have any knowledge. Just a simple technique, compounded interest. Every interest on interest will be calculated. Outstanding amount will be found out. In that, what is the realizable value of the shares? Now, deduct, you will get the unsecured portion. So you need to tell this is the secured portion, this is the unsecured portion. So the secured portion 5 lakh 60, unsecured portion 48,326. Correct? See this 48,326. So this is special transactions in banking companies, sir. We have completed all the special transactions in banking companies. So these are. Now format of financial statements of banking companies. See, format and all you have to read 2 or 3 times, sir. So I'm not saying completely omit format. At least you see the format once. For example, if you see the formats of a banking company, see this is the balance sheet. Form A is balance sheet. And form B is P&L. Now P&L is much more, comparatively compared to balance sheet, P&L is important, sir. If you see P&L account of a banking company, what items will come? First income, then expenditure. What is the main income of the bank? Interest earned. And then other income. Schedule 13 and 14. See this. Schedule 13 will give you interest earned. See this. Interest and discount on advances and bills. income on investments, interest on balances with Reserve Bank of India and other banking funds, others. Other income means commission, exchange, brokerage, profit on sale of investments. If it is any loss, we need to deduct any profit on revaluation of investments, profit on sale of land and buildings, all these things. And any income earned by way of dividends, etc. from subsidiaries, miscellaneous income, all these things we need to show. Schedule number 13 and 14. And next is, sir, expenses. When it comes to expenses, what are the expenses of the bank, sir? Interest expended. Major expenditure for the bank is interest paid. Interest is paid to whom? Customers. For loans, for deposits accepted. From the customers we are taking deposits, sir. On the deposits we need to pay interest. And similarly, any operating expenses, any provisions and contingencies, we need to deduct. And then you will get profit or loss for the period. And opening, transfer to statute reserves. Remember, sir, if you are a banking company, how much you transfer to statute reserves? 25% you need to transfer to statute reserves. And other reserves, proposed dividend if any given, and balance will be carry forward. And if you see, operating, interest expended, interest paid on deposits from the customers, interest on loans taken from RBI, interbank borrowings, others. Operating expenses, all kinds of expenses of the bank, like payments and employees, salaries, rent, rates, printing, stationery, advertisement, depreciation, directors' fees, all these things will come. Okay. Now balance sheet you have to revise once, sir. You have to give reading once. So in balance sheet, what items will come? Just you see once. That's it. More than sufficient. See, in study material, one illustration called illustration 11 is there, sir. This illustration, they are asking us to prepare P&L account. See, there is a chance that a P&L account may be asked in banking companies. Maybe if he doesn't want to ask the special areas, he can test what? P&L account. Now you see where these items will come. Suppose they have given the extracts in the books of Y Limited. Interest and discount received. Interest and discount received means income, right? So schedule 13, interest earned. Interest paid on deposits, interest expended, schedule 15. Next, issued and subscribed capital will come in balance sheet. Reserves will come in balance sheet. Commission, exchange, brokerage, other incomes, 14. Incomes. Commission, exchange, brokerage. Rent received, 14. Profit on sale of investments, 14. Salaries and allowances, operating expenses, 16. Directors' fees and allowances, 16. Rent and taxes paid, 16. Stationery, postage, other expenses, audit fees, depreciation, all these are what? Operating expenses. Now provision for bad and doubtful debts necessary, how much, sir? 2 lakhs. So we need to create a provision. Rebate on bills discounted at the end, 7,500. What is this rebate? Can you tell me? Rebate on bills discounted at the end, what we need to do? We will deduct it. It is not a current year income, I told na. Next year income. So we need to deduct it from the interest earned. Hello. Next, to provide 3,50,000 for income tax. Provision for income tax. Directors decide to declare how much dividend? 10% dividend. Make necessary assumptions and prepare P&L account. So if I start preparing P&L account of a banking company, you see, first interest earned, schedule 13 I will see. Interest earned. See interest earned. First interest and discount received, 20,30,000. Minus rebate at the end. Because this 7,500 is not current year income. So deduct it. Hello. Next, other income. What items will come in other income? See this commission, exchange, brokerage, rent received, net profit on sale of investments. These things, 2,15,000. Next, total expenditure side, you see interest expended, schedule 15. What is the interest we paid, sir? See this interest on deposits paid given, 12,02,000. Take it. And then operating expenses, 16. All operating expenses, 16 you take. And then provisions and contingencies. 5,50,000 provision we created, na sir? Provision for doubtful debts 2 lakhs, provision for income tax 3,50,000. In the question they clearly given, see this, provision for doubtful debts 2 lakhs, tax provision 3,50,000. Total 5,50,000, provisions and contingencies. So total income minus expenses, you will get profit or loss for the period. Then appropriations. Appropriations are very, very important, sir. we need to transfer to statutory reserves. I told you how much? 25%. 2,49,000 into 25%. 25% we need to transfer. Clearly given. As per provision 17 of the Banking Regulation Act, amount to be transferred to statutory reserves should not be less than 25% of net profit. And transfer to others. Proposed dividend is also there, na? Proposed dividend, how much declared? 10% on capital. What is the capital here? 5 lakhs. So 5 lakhs into 10%. 50,000 proposed dividend. See, it has been assumed that dividend has been proposed as per RBI guidelines, and the remaining balance will be carried forward to balance sheet. In balance sheet, it will be shown under the head reserves and surplus. This is how P&L account will be prepared, sir, in case of banking companies. Okay. So that's it, sir. Banking, relating to banking, you see the balance sheet, sir. Once see the balance sheet format. So just read the balance sheet format. What items will come, just give a plain reading. But special areas what we discussed now, those are important. Problems also I solved. Revise them. It is more than sufficient. Okay, sir. Next chapter we are going to cover is insurance companies, sir. Sir, insurance companies we can divide in two parts, sir. Two parts. Life insurance, general insurance, sir. Life insurance, life assurance fund concept, valuation balance sheet. If you see the past examination question, sir, only these two topics, fund, valuation balance sheet. They are asking these two. Mostly they are asking life assurance fund, valuation balance sheet. And if you are a life insurance company, how you are going to prepare the financial statements, the format. See, if you are an insurance company, sir, you have revenue account, P&L account, balance sheet. Revenue, P&L, balance sheet. Now come to general insurance, sir, other than life, like fire, marine, all this miscellaneous insurance. In this, sir, claims incurred concept, claims incurred calculation, and reserve for unexpired risk reserve. Reserve for unexpired risk, URR, unexpired risk reserve also we can call, or reserve for unexpired risk. One concept is there, that concept. And then format for financial statements. How banking companies will prepare their financial statements, how revenue account will be prepared, P&L account will be prepared, balance sheet will be prepared. And like banking companies, here also you need to focus on the other areas, not on the complete format, like format of balance sheet, format of P&L, not that much important. Maybe up to revenue account they can test. They are testing revenue account, but very rarely they will test balance sheet, P&L account. Just you read them once, that's it, more than sufficient, because anyway 7 marks is coming from the examinations from this chapter. So mostly these are the areas, sir. See, I have divided and I have discussed according to the importance from examination point of view. Now first we will see life insurance concept. Life insurance we will see, then we will go to general insurance. Now first of all, sir, in insurance there are some important terms. Premium. What is premium? Premium is nothing but the amount paid by the person who has taken the insurance to cover the risk. To cover the risk. So insurance company point of view, this is their revenue. Premium is the revenue. Correct? Insurance company point of view, this is what? Revenue. Insurance business is what? Nothing but I am covering your risk. For example, you taken a life insurance policy. So risk you are covering. For that coverage you need to pay some consideration, that is called premium. So for insurance company point of view, premium is the major revenue for them. Next, claims. Another important word is what, sir? Claim. What is claim? Whenever accident happens or the risk actually done happens, the person, the customer will claim the amount. Loss he will claim. He will make the statement of claim, right? He will ask the amount. That amount is called claim. So claims is a major expenditure for the insurance company. For example, Mr. X has taken a life insurance. He died. Now his family members will make the claim. So insurance company will make the payment. So claims. There is one more thing called surrender value. See, if a person who has taken an insurance, he wants to discontinue. He doesn't, he is not want to make the payment. He can go to the insurance company and he can surrender the insurance policy. What insurance company will do is, till now whatever the premiums you paid, minus some amount they will deduct and they will give you the So they will give you the value. That value is called surrender value. And then bonus concept. See, very, very important, sir, bonus. Once in examination also they tested bonus concept, sir. I will show you. In exams, there is a chance that again they may test bonus concept. See this. December 2023, 4 marks, they tested bonus concept. Bonus paid by insurance companies. Sir, what is this bonus in insurance companies? Listen to me carefully. Sir, generally, in any business, normal commercial entities, if at all a company earns profit, who will get dividend? Shareholders. But in case of insurance company, sir, the profits of the insurance company will be get by policy holders in the form of bonus. So bonus is nothing but the profits of the insurance company distributed to its policy holders. Generally, in case of any company, I mean, profits will be distributed to shareholders. But in case of insurance company, policy holders are being. Majority of the profits will be distributed to policy holders only. Okay, that is called bonus. Now see this. Nothing but the share of profit which is payable by the insurance company. To whom? Policy holders. There are 5 basic types of bonuses. They may ask this question, sir. There are 5 types of bonus, sir. First one, simple reversionary bonus. Second one, compound reversionary bonus. Third, interim bonus. Fourth, cash bonus. Fifth, terminal bonus. First you see simple reversionary bonus. Every year, sir, every year some percentage on the policy amount will be added to your policy, sum assured. See, a percentage of sum assured gets added to the policy every year until the maturity or death of a client. For example, 10 lakhs. Every year, suppose maybe 5% of it will be added. That is called simple reversionary bonus. That means your sum assured balance will automatically increases. Next, compound reversionary bonus. Compound reversionary bonus means increase on increase, like interest on interest. So it is a bonus calculated as a percentage of the sum assured and the bonus accrued last year. Whatever the bonus they have given in the last year, on that also they will again give. That is called compound reversionary bonus. Next, interim bonus is important, sir. What is interim bonus, sir? See, death is unexpected, sir. Anytime the policy holder may die, right? If he died, na, sir, insurance company have to make him the payment of claim. Now, when he died, what happens is, whatever the profits earned till that point of time, so the insurance companies will give him some profits distribution. That is called interim bonus. See this. Bonus is accrued in life insurance policy every year. However, there is a chance that a death claim occurs before the next bonus declaration. Hence, the insurance company declared an interim bonus to set the policy holder's family at which position? Advantage and benefit from the bonus amount. So, whenever a death claim occurs, in order to get benefit the policy holders family, what insurance company will do is they will give bonus in the middle of the interim bonus. That is called basically. They don't wait till the declaration of bonus. Generally, every year bonus will declare. But suppose in the middle of the year, if any policy claim occurs, so for that also bonus will be given. That bonus is called interim bonus. Cash bonus, sir. Sometimes they will give cash directly to the policy holder. They won't add it to the policy amount. They will give cash bonus. And terminal bonus means it's a one-time bonus. It will be given at the end. See this. It's a one-time bonus in insurance paid when the policy holders runs to the entire policy term or a period specified by the insurer. Thus, it is not applicable if policy is surrendered before the term ends. For example, the policy term is 15 years. Once 15 years is completed, at the end we will give some bonus to you. That is called terminal bonus. So tell me how many types of bonus are there? 5 types. What are those? Simple reversionary bonus. That means here the bonus is added to policy amount. What is next one? Compounded reversionary bonus. Bonus on bonus. So bonus plus last year accrued bonus also some percentage will be added. Next, interim bonus. If death claim occurs during the year, any bonus given to that is an interim bonus. Next, cash bonus. Cash is available to the policy holder, not added to the policy amount. Next, it will be paid at the end of the policy. Okay na? Okay. Next. So therefore, premium, claims, surrender value, bonus. Next, very, very important topic is reinsurance. Listen to me carefully. What is reinsurance? Suppose, sir, one insurance company got the insurance policy, but the insurance is amount is the sum issued policy amount is so huge. They know that they can't bear this much risk if loss occurs. What they will do is they will share their risk with other insurance companies. Like for example, there is Bajaj life insurance is there. They got a policy for 100 crores. What they can do is, out of this 100 crores, they can take reinsurance from other insurance company. Like for example, Access life insurance. Now you tell me, in this case, there are two insurance companies involved now. One insurance company is giving business to other insurance company. The insurance company which is giving business to other insurance company is called ceding company. The insurance company which accepted reinsurance is called accepting company. Now you tell me, when I accept reinsurance, I will receive premium. When loss occurs, I will pay claim. Correct? So for a reinsurance ceding company, the company which is giving business to other insurance companies, whatever the premium they receive, from customers they will receive premium, that is their income. And they will also reinsured with some other insurance company, they will pay some premium. That will be deducted from the total premium amount. Because this is not their income. Because they have taken a reinsurance. Hello. Similarly, when loss occurs, they will claim the amount from the other insurance company from where we have taken reinsurance. Therefore, out of the total claim amount, some claim amount will be recovered from the other insurance company. So to that extent, our expenses will be reduced. Our liability will be reduced. That is called reinsurance. So reinsurance concept is quite common. If one insurance company cannot able to bear the entire loss, what they can do? They can reinsure with other insurance companies. See, reinsurance. Transfer of risk by an insurer to another insurance company to manage high profile risk policies. So the original company is called which company? Ceding company. Other company is called reinsurer, acceptor, nothing but. An ceding company is an insurance company that transfer the risk to other insurance company. It shares premium with reinsurer. So who pays commission to the ceding company? Now you need to understand, sir. Insurance is a agency business. Insurance is a agency business. Majorly, who is bringing business? Agents. So therefore, for bringing the business, insurance company will pay commission. So commission is one of the major expenditure to insurance company. But in case of reinsurance, one insurance company is giving business to another insurance company. So when I give any insurance to other insurance company, they will give me commission. Then commission will become my income. For them it is expenditure. For me it is income. So you have to be very careful. Okay. So, and commission. I told you about the commission. Generally insurance companies will pay commission to its agents. For them it is expenditure. For them it is expenditure. See, at least you should have idea about these 6 words. Premium, claims, surrender value, bonus, reinsurance, commission. Okay. Now, once you have an idea about them, let us discuss about life insurance fund. Okay. Important pa. What is life assurance fund or life insurance fund? Sir, if you are an insurance company, life insurance company, sir, you need to prepare 3 things as a part of your financial statements. I told you. What are those? Form A, RA, revenue account. Form A, PL, P&L account. Form A, BS, balance sheet. So you need to prepare 3 things. What are those? Revenue account, P&L account, balance sheet. Now, first come to revenue account. Revenue account is called what na? Policy holders account. It is called technical account. P&L account is called shareholders account. It is called non-technical account. For insurance company, main thing is policy holders. For policy holders, they will prepare what? Revenue account. In this revenue account, what they will show? See this, premium earned, net. What is the premium income we collected? Premium on reinsurance ceded, on reinsurance accepted. And income from investments. What is the income we received from investments? Interest, dividend, rent on gross basis. Any profit on sale or redemption of investment, loss on sale of redemption of investments will minus, will other incomes, and then total. And commission we will deduct. Operating expenses relating to insurance we will show in revenue account, and you will get, and benefits paid. Benefits paid means claims. Any interim bonus paid we will deduct, and you will get surplus or deficit. Surplus or deficit. And balance will be transferred to shareholders account. Sir, this is the revenue account of life insurance business. So tell me, in revenue accounts how many schedules are there? 4 schedules. Schedule number 1, earned, premium earned, net. Schedule number 2, commission. Schedule number 3, operating expenses. Schedule number 4, benefits paid. Benefits paid. See this. First, schedule number 1, premium. Our total premiums we will disclose here. Commission expenses, all our commission expenses we paid. See, when we accept reinsurance, we pay commission. When we give reinsurance to others, reinsurance ceded, they will pay commission, so it is deducted from the commission expenses. And then any operating expenses, all expenses relating to insurance we need to show here. Relating to business we will show in P&L account. And then benefits paid means what? Claims. Insurance claims we paid. Okay. Like this we need to show, sir. Now understand. So if insurance company prepares the revenue account, sir, what they will get? Surplus. This surplus will be accumulated. That is called life assurance fund. What is life assurance fund? It is an accumulated reserve fund which is created from excess of income over expenditure every year. Every year we prepare revenue account. Every year we prepare revenue account. Excess of income over expenditure, whatever is there, we will accumulate. That accumulated fund is called what? Life assurance fund. Life assurance fund. Life assurance fund, sir. Now see, first type of questions they will ask is life assurance fund calculation. What they will do is they will give you fund balance, and they told you that some items are missed. Now you need to adjust them and you need to find out the updated life assurance fund. Simple, sir. Whether this particular amount will be added to fund, deducted from the fund, you need to decide. For example, I will tell you some amounts, you need to tell me. When we will add to fund, if there is a positive flow, correct? When we will deduct negative payments, we will deduct, correct? See this. First, interest accrued on investments. Any interest accrued on investment is positive or negative? Generally, fund balance will increase. Hello? Income earned but not received, it should increase the investment income. Any outstanding premium means receivable from the customer. Positive or negative? Fund balance will increase, no? Because revenue account means premiums will also be, first premiums only we will take. Next, bonus utilized in reduction of premium. Sir, important, sir. Bonus means what I told? Bonus is nothing but profits distribution, correct? Correct? Now sometimes bonus, what they will do is they will give bonus to the customer and says to the customer that you reduce this bonus from premium amount. For example, I need to pay premium 20,000. The insurance company sometimes says, in this 20,000 I am giving 5,000 bonus. You pay only 15,000. That means that 5,000 is not receivable by insurance company. So therefore it will decrease my fund. See this, bonus utilized in reduction of premium reduces the premium income, so therefore it will decrease the fund balance. It decreases the fund balance. See, fund balance means accumulated reserve. Accumulated reserve means incomes minus expenses. So if your incomes are increasing, fund balance will increase. If expenses are increasing, fund balance will come down. See, here you are utilizing bonus for adjustment of premium. That means you are not receiving any income to the extent you are adjusting to the premium. Therefore, to that extent, fund balance will come down. Next, claims intimated but not admitted. Claims, because of claims, what happens? Payment decrease. Correct? And sometimes claims covered under reinsurance. Suppose if you take in any reinsurance, the claim amount, certain portion they will give. When you reinsure, sir, when loss happens, some loss will share it by other company. So to that extent, your expenses will decrease, na? So therefore, there is a increase. So logically, you think about only these 5 items. 5. First, interest accrued on investment, increase. Outstanding premium, increase. Bonus utilized in reduction of premium, decrease. Claims intimated but not admitted, claims covered under insurance. So any claims covered under insurance, simple, from the claim amount you reduce it, because they are going to given by other insurance companies. Okay. Now see this, sir. Now I want every one of you to see the first question, illustration number 1 from study material, sir. See this question. See this question, sir. The revenue account of life insurance company shows life insurance fund on 31st March 2023. How much, sir? 62,21,310. Before taking into account following items. Important model, please see. Revenue account of life insurance company shows life insurance fund. How much is the fund balance? 310. This is before taking the following items. These items are not yet adjusted. Tell me. Claims covered under reinsurance. See, I told you. See, what is the total claims? Claims intimated but not admitted, 26,500. Because of the claims, what happens to fund? Decrease. So you do one thing. 26,500 minus covered under reinsurance 12. So net decrease how much? 14,500. You do one thing. Okay? Deduct. Next. Bonus utilized in reduction of life insurance premium. To the extent the bonus is utilized, your premium will decrease. So the fund balance will come down. Interest accrued on investment, increase. Outstanding premium, increase. What is life insurance fund after taking the above admissions? So tell me. So 62,21,310. What are the things we added? Interest on securities, premium outstanding. Less, what we less? Claims outstanding 26,500 minus covered under reinsurance 12. So 14,500. Bonus in reduction of premium 4,500. So 62, 19, 980. This is the answer. This is the life insurance fund. Hello? Next. Valuation balance sheet. Next concept is what, sir? Valuation balance sheet. See, relating to life insurance fund, there are some questions, sir. We'll see. One question I solved. Now see the valuation balance sheet also, because sometimes they are mixing both the questions. Life insurance fund, valuation balance sheet, they are asking. See, what is this valuation balance sheet? Important, sir. Sir, you are a life insurance company. You are a life insurance company. What is the premiums, amount of premium you are expected to receive? What is the premiums you are expected to receive from the customers? What are the claims you are expected to pay, expected to arise in future? So you need to calculate two things. One is, what is the premium I am expecting to receive in future? What is the claims I am expected to arise from the customers? The difference you see between both of them. Claims expected to arise, how much? Premiums, how much expected to receive? The difference is called your liability, net liability. For example, the premium you are expecting to receive is 100 lakhs, but the claims expected to arise 150 lakhs. So therefore the difference is how much? 50 lakhs. That is called net liability. But sir, here how I am deciding this claims? There is a person called actuary who is a professional who will make this valuation. That valuation is called actuarial valuation. So with the help of this person, we will do actuarial valuation and we will decide the claims expected to arise. So the company, the insurance company will calculate the claims expected to arise and will calculate the premiums which are expected to arise. The difference they will call it as what? Net liability. And they will prepare valuation balance sheet. In this valuation balance sheet, see, asset side they will show the life insurance fund. Whatever the fund is there, they will asset side. Whatever the liability is there, they will show liability side. The difference is surplus or deficit. For life insurance company, the difference is surplus or deficit. For example, my life insurance fund is 100 lakhs. My net liability is 50 lakhs. What is the surplus? 50 lakhs. Suppose, for example, life insurance fund 50 lakhs. My net liability is 100 lakhs. What is the deficit? Minus 50 lakhs. This is what. So tell me, valuation balance sheet, how it will prepare? It is like a balance sheet. Asset side, liability side. Asset side will have life insurance fund. On one hand, we have fund. On the other hand, net liability. How to calculate net liability? Claims which are expected to rise minus premiums expected to receive. The difference is net liability. This net liability they will give you, life insurance fund they will give you. Compare both of them. Surplus or deficit will come. Now the interesting point is, suppose if there is a surplus, out of this 95% will be distributed to policy holders. Only 5% will be distributed to shareholders or as per the government decision. 95% they can distribute to whom? Policy holders. So this is called valuation balance sheet. So every life insurance company at the end of the year they will prepare valuation balance sheet. In that valuation balance sheet, asset side they will show you the fund balance, liability side they will show you net liability. Now you see illustration number 2, sir. Life insurance fund of Prakash Life Insurance Company Limited was how much, sir? 34 lakhs on 31st March 2023. Its actual valuation on 31st March 2023 disclosed a net liability of 28,80,000. So net liability 28,80,000. What is the life insurance fund balance? 34 lakhs. Correct? An interim bonus of 40,000 was paid to the policyholders during the previous 2 years. They paid what? Interim bonus. They paid interim bonus to the policyholders. You know what is interim bonus? Death. During the year, if happens, we will pay bonus. Correct? Interim bonus. Any bonus is nothing but distribution of profits only. Last 2 years, how much interim bonus paid? 40. Now, it is now proposed to carry forward how much? 1,10,000 and to divide the balance between policyholders and shareholders. Now, they are asking, see what they are asking. Show first what? Valuation balance sheet. They are asking what? Valuation balance sheet. Second, net profit or loss for the 2-year period and distribution of profits. Important, sir. First valuation balance sheet, sir. Tell me. Just now I told. Asset side, what will you show? Fund. How much? 34 lakhs. Correct? Liability side? Net liability given. How much? 28,08,000. So 34, 28. How much? 5,20,000. Is what? Surplus. Surplus. Okay. First one is done. See this. How much time it is taken? Just hardly 1 second we can complete this valuation balance sheet. Because they will give you everything. Life insurance fund they will give you. Net liability they will give you. Just you show it. Then the difference is surplus or deficit. One thing is over. Second one that they are asking net profit or loss for the period. Simple. 5,20,000 you take. This is the surplus, right? Last 2 years how much interim bonus paid? 40,000. Add back 40. Interim bonus paid. That means profits might have been reduced. I want net profit for the period. Add. How much it will come? 5 lakh? 5,60,000. Correct? So 5,60,000. Take it. Now. That means net profit is also done. Net profit for the 2 years is how much? Surplus plus interim bonus already paid. Now the last one is what? Distribution of profits. Let us distribute it. How you are going to distribute, sir? See this. Your profit is 5,60,000. In this, they decided to carry forward how much to the next year? 1,10,000. Minus it. So therefore, what is the balance? 4,50,000. In this 4,50,000, 95% will go to policy holders. 5% will go to shareholders. See this, 95% to policy holders. That means 4,50,000 into 95%, 4,27,500. But in this 4,27,500, in the form of interim bonus, how much already paid? 40. Therefore, remaining will be given to 3,87,500. Sir, first interim bonus will be added to arrive the net profit. Now, when we are distributing when you are distributing 95% will be the distributed amount is 427,500. In that already given in the form of interim bonus, deduct the remaining balance we need to distribute. Correct? And to shareholders remaining 5%, 22,500. You understand this? This type of questions only they are asking in the examination, sir. I will show you. See this examination question, sir. June 23 8 marks question they tested, sir. See this question, you see, similar to the question we solved. See this question. They are asking in this, there is a company life insurance fund, sir. PQR life insurance company. How much is life insurance fund? 34 lakhs. And its actual valuation disclose a net liability of 28 lakh 80. Hey, same question here. Amounts also same. 40,000 interim bonus proposed to carry forward 1 lakh. Same valuation, balance sheet, net profit, and then distribution. Same question they tested. Exactly same. Wordings also not changed. I mean, company name changed. Even numbers also same. Okay. This question you see. Question number 2. See, there is a company Pixel Life Insurance. Their life insurance fund is how much? 51 lakhs. Its actual valuation disclosed a net liability of 43 lakh 20. Interim bonus of how much paid? 60. It is now proposed to carry forward how much? 1 lakh 65. Okay, and divide the balance. They are asking net profit as well as distribution of profit. They are not asking valuation balance sheet. But first we need to find out valuation balance sheet because we need to arrive surplus or deficit. See here 51 lakhs minus 43.2. How much, sir? 7 lakhs 80,000 plus interim bonus paid 8 lakh 40. Correct? So this is our net profit. Now distribute it. In this 8 lakh 40, 95% carry forward balance is there. First 8 lakh 40 minus carry forward 1 lakh 65. 6 lakhs 75,000 is there. Correct? 6 lakh 75,000 is there. This 6 lakh 75,000, 95% to policy holders, 5% to if I apply 95%, it is 6 lakhs 41,250. But in this I need to reduce interim bonus paid already. Only remaining balance I need to take because it is already distributed now. They have given 6 lakh 40, but total amount due to policy holders is 641,250. And this one is this. So look at this. Same questions they are asking, sir. And also, sir, one question I will show you. This question also they have already tested in exam, sir. That question is this. This question, sir. Illustration 3. Come to illustration number 3, sir. From the following figures of Well Life Assurance Company Limited, prepare valuation balance sheet and profit distribution statement for the year ending 31st March 2023. Also pass necessary journal entries to record the above transactions with narrations. Okay. First, balance of life insurance fund on 1/4/2022. How much, sir? Opening balance 167.15. Interim bonus paid in the valuation period 25. Balance of life insurance, balance of revenue account for the year ending 31st March 2023 240. Net liability as per the valuer certificate is 165. See, balance of revenue account means what, sir? This is life assurance fund, sir. Nothing but. I told you life assurance fund is nothing but accumulated amount which comes from revenue account only. So this balance of revenue account for the year ended 31st March 2023 is 240. It's a life assurance fund. So your life assurance fund is 240. Net liability is 165. So 240 minus 165, 75 is your surplus. So they are asking first what? A valuation balance sheet. See this. Valuation balance sheet. Life insurance fund 240. Net liability 165. So difference is 75. Okay. Next what they are asking? Distribution. See, surplus 75. Interim bonus paid add. How much is the interim bonus paid? 25. Add. You will get 1 crore. In that 95% to policy holders. Minus already paid. You will get the remaining balance to be paid. And shareholders fund is this one. Correct? Very simple. Done. So this is how distribution will be happen. And they are asking entries also, sir. See this. The company declares a revisionary bonus of 185 per thousand and give the policy holders an option to take a bonus in cash rupees 105 per thousand. Total business conducted by the company was how much, sir? 600 lakhs. The company issued profit policy only. Okay. 1/5 of the policy holders in value opted for cash bonus. Sir, here company is giving two types of bonus, sir, at the end. What are the bonus? One is revisionary bonus, another one is cash bonus. I told you, revisionary bonus, cash bonus. 3/5 of the policy holders opted for what? Cash bonus. What is the total business we conducted? So therefore, you see, 600 lakhs business is conducted. In that 3/5 cash bonus they are taken. For every 1000 rupees, 105. 105 divided by 1000. Correct now? Tell me how much came? 600 into 3 by 5 into 105 divided by 1000. How much, sir? 37.8. This is cash bonus. Hello? Remaining 600 into remaining 2/5 into they will take revisionary bonus. For every 1000, 185. 185 divided by 1000. 44.4 lakhs. See this. This is the bonus we are going to give. Now they are asking entries, sir. Simple. First, our surplus is how much? 75. So life assurance funds to P&L account. Correct? Now from this I am giving two bonuses. Bonus payable. 37.8 cash bonus and then this 44.4 P&L to life assurance fund. Because this bonus we don't pay in cash. We will add to the policy amount. You will add to policy amount. That's why life assurance to life assurance fund I created 44.4. Sir, cash bonus you will pay, but revisionary bonus transfer to life assurance fund. So that's it, sir. These are the entries. Same type of question they tested in exam, sir. Exactly same question they tested, sir. Sir, see, look at this question. Same as illustration 3, December 23 question. Same. Numbers changed. That's it. Same question, you practice this, sir. So once you learn these two concepts, I think majority of the examination questions will be covered, sir. So therefore in life assurance fund, life insurance we completed life assurance fund as well as valuation balance sheet. Life assurance fund how to calculate I told you. And then valuation balance sheet also I told you. And in the study material, sir, we have some more questions, sir. Actually, yeah. This question you see, sir, illustration 10, 9, 10, 11. These illustrations same. First we solved these type of questions, right? See these questions. Suppose 9th question you see. Aviva and Access Life Insurance Company prepared revenue account for their ending 31st March 2023. Ascertained life insurance fund. How much they got, sir? 1000. It was found later on that the following had been omitted. I have discussed it now. Interest accrued on investment. What we need to do? Add. Income tax liability to be deducted, estimated to be 21. So whenever income tax any liability will come, that will be deducted. Correct? So interest accrued on investments is how much? 78 minus 21. 78 minus 21. 57 will be added. Because of income tax our fund will reduce. Next, outstanding premium, add. Bonus utilized in reduction of premiums, minus. Claims intimated but not admitted. Because of claims, what happens? Funds decrease. And any claim covered under insurance will deduct. I mean, from 34,800 I will say, I will deduct. Balance I will deduct from the fund. Correct? But here, in the study material you see, premium they done correctly. Bonus utilized in reduction of premium, first they added, then they deducted. In the illustration number 1, with the first illustration, bonus directly deducted. But here they added and deducted. But in examination question, they deducted directly. So therefore we will follow the examination question. We will follow examination question. So therefore here the assumption is bonus is already, bonus whatever we are utilizing in reduction of premium, which will reduce the fund balance, which will reduce the premium income. So therefore we will less it. Okay. Next, interest accrued they have done correctly. Claims covered under reinsurance added they have. That means see, reverse. Claims intimated and not admitted 34,800. From that you can reduce 13,000. Balance you can take directly here. Instead of, they have taken two places. First the claims covered under reinsurance they added, claims intimated they have deducted. Instead what you can do, whatever the claims covered under claims intimated 34,800, in that reinsurance minus it, you can take. So here it is taken like that. So but we will follow the examination pattern, sir. Okay. So these are the first type of things, sir. Life assurance fund and valuation balance sheet, and the format of balance sheet, format of financial statement, revenue account is important. We discuss it, sir. Now come to general insurance, sir. General insurance, if you see, other than life insurance, sir, if I am a general insurance business, same, I will prepare revenue accounts, P&L account, balance sheet. But when I prepare revenue account, sir, I will prepare revenue account for each type of general insurance. Because in general insurance we have fire, marine, accidental, like that. Different types will be there. Fire insurance, marine insurance, other insurance, miscellaneous insurance, like that. For each type I need to prepare. And in case of general insurance, sir, one important point, sir, creation of provision for unexpired risk. They say if you are doing marine insurance business, 100% of net premium you need to create a provision. If you are doing other businesses, 50% of net premium you need to create a provision. So this you need to remember, sir. And you see, revenue account if they prepare, first they will take premiums earned. And next they will take what? Claims incurred. See, premium earned, interest and dividend rent total. Then expenses side, first what they have taken? Claims incurred. So how to calculate claims incurred, they will ask in the examination. Claims incurred. This is important, sir. Listen to me carefully. How to calculate claims incurred? Yeah. See this. Claims incurred can be calculated like this. First you take claims paid during the year. For that add outstanding claims at the end of the year minus outstanding claims at the beginning of the year. Then you will get claims incurred. Current year claims incurred you will get. Claims paid you take first. Add closing minus opening. Now you see, first claims paid. Claims paid. Direct business, how much claim you paid? In respect of reinsurance accepted, how much you paid? Add any expenses on settlement of claims. Important, sir. Sir, when you are settling a claim, you may incur some expenses. Insurance companies will incur some expenses, sir, when they are settling the claim amount. Any legal expenses, survey expenses, all these will be added to claims only. Please, important this is. And from this, any claims received from reinsurance. Suppose when we reinsurance is given to, taken from others, we will receive claim, sir, that will be deducted. And the net amount is nothing but claims paid. So claims paid, direct business, reinsurance business. How much claims we pay? Add any direct expenses minus claims received from reinsurance. Next, claims at the end of the year you need to take. At the end of the year, how much claim we need to take? How to take? From direct business out, how much is outstanding at the end? Reinsurance, how much is outstanding? Minus any claims receivable from reinsurance outstanding at the end you deduct. Then you will get net amount outstanding at the end of the year. Direct business, reinsurance business. And in respect of reinsurance business, we have ceded to other companies, how much is the claim receivable? Deduct. Now similarly, claims at the beginning of the year. At the beginning of the year, what will be the claim amount? What will be direct business? Reinsurance business. How much is claims receivable from reinsurers? Because from reinsurers, whatever the claim receivable, to that extent my liability will decrease. So if you do this, automatically you will get what? Claims incurred. Claims incurred, sir. This is one type of question, sir. See this question, I think illustration number 8, sir. Not illustration 8. Yeah, illustration number 7, sir. This question, you see. This is relating to claims. From the following figures appearing in the books of fire insurance division of General Insurance Company, show the amount of claim it would appear in the revenue account for the year ending 31st March 2023. How much amount you will show in the revenue account? Claims incurred. In revenue account we will show claims incurred, right? See, they have given direct business, reinsurance business. First, claims paid given, claims payable opening given, closing given, claims receivable, claims received given, receivable opening given, closing given, expenses of management given, including 35,000 service fees, 45,000 legal expenses in settlement of claims given. Tell me how much claim we are going to incur during there. How to find out? First we need to take the claims paid. I told you claims paid we need to take. Correct? So here claims paid. Say this. What will be the claims paid during the year, sir? Direct business 46 lakhs 70. Reinsurance business 7 lakhs. Correct? See this 46 70 7 lakhs. And I also told you any direct expenses you incur at the time of settlement of claims will also be added. 35,000 surveyor fees, 45,000 legal expenses. Add 35 45. So total claims paid is 5,450 minus any claims received from reinsurance 2,30,000 will deduct 230. This is the net claims paid during the year. Paid. I want claims incurred. Next I want what? Closing. So closing, how to find out closing outstanding claims? First closing, see 31st March 2023. Direct business 8,12,000. Reinsurance business 53,000 minus closing claim receivable 1,13,000. Deduct it. So 8,12,000 plus 53 minus 1,13,000. See this. So you will get 752. Next, claims outstanding at the beginning of the period. At the beginning of the period, 7,63,87,000 minus opening claim receivable 66. So you will get 784. So that's it. So therefore, claims paid 5,220 plus closing outstanding 752 minus opening outstanding 784. Say this 5188. This is the claims incurred. Where will you show this? Revenue account of the general insurance. This is one type of question, sir. And one more important question, sir. This question, illustration number 9, sir. Illustration number 9, they are talking about not illustration 9, sir. This question, sir. Illustration 6. Illustration 6 is relating to provision for unexpired risk reserve. Just now I told, sir, every general insurance company have to create a provision for unexpired risk reserve. If you are doing marine insurance, 100%, others 50%. Now you see this, there is a company, insurance company, sir, they furnishes you the following information. On 31st March 2022, it had reserve for unexpired reserve to the tune of how much? 100 crores. It comprised of 37.5 in respect of machine insurance business 50 crores in respect of fire insurance, 12.5 crores in respect of miscellaneous insurance. This is not mission, sir. This is marine. Okay. It is the practice of Khusraho Insurance Company Limited to create what? 100% of net premium in respect of marine, 50% of net premium in respect of fire and miscellaneous insurance policies. During the year, marine insurance premium collected 45, other insurance companies in respect of risk taken 17.5, reinsurance. Premium paid or payable to other insurance companies on business C date 16.75. So therefore you see 45 plus 17.5 minus 16.75. So 45.75. This is the premium earned during the year. Correct? Sir, we collected premium from direct business 45. From reinsurance risk undertaken 17.5. We reinsurance ceded. When we shared insurance with other, we share premium also. Na? So this 16.75 we will pay. So deduct. So therefore 45.75. This is relating to what? Marine. So marine insurance premium earned during the year 45.75. How much is the provision? 100%. Therefore 45.75 provision we need to create in respect of marine. How much provision is already there? 37.5 is there. Hello. 45.75 we need to maintain. Already 37.5 is there. So what is the balance? 8.25 we need to create during the year. What is the provision entry? Revenue account debit to unexpired risk reserve account. Marine revenue account debit to unexpired risk reserve account. 8.25, 8.25. Correct? Next come to fire insurance. 107.5 plus 12.5 minus 10.75. What is the net premium earned? 109.25 into 50%. Into 50%. How much? 54.625. Correct? Already how much provision is there? 50. Therefore, how much we need to create now? 4.2625. So they created 4.63. The entry is fire revenue to unexpired risk reserve. Come to the last one, miscellaneous insurance. 30 plus 10, 40, 40 minus 17.5. How much, sir? 22.5 into 50%. How much? 11.25. So already how much is there? 12.5 is there. So excess provision will be written off. Excess provision will be written off. So 12.5, 11.25. So 1.25 reverse it. What is entry? Unexpired risk reserve to revenue account. Not miscellaneous reserve. Miscellaneous revenue. We are preparing revenue account. Please. This provision will be adjusted directly in the revenue account. So this is how we need to calculate, sir. So calculation also given here. So if you prepare unexpired risk reserve account, see this. These are the opening balances. 37.5, 50, 20, 12.5. These are the closing balances we need to maintain. Based on 100% of the net premium, 50% of the net premium. The balance we created during the year. In respect of marine and fire we created. In respect of miscellaneous we reversed it. That's it. So this question is also due for examination, sir, but very simple, sir, very simple. So tell me, sir, if you are a general insurance company, for marine insurance, how much provision you create? 100%. Others? 50% provision you create. So this is another concept, sir, relating to, sir, one question, sir, in insurance, illustration 8, sir. See this question, sir. In this question, they are asking revenue account. Sir, in general insurance, sir, either they can ask provision for unexpired risk reserve. That question we solved, sir, marine, that one. Or claims question. Or one more question they can test is what? Revenue account preparation. I think one time in examination, they asked preparation of revenue account, sir. Revenue account. See this. They are asking revenue account. Which revenue account? Fire insurance revenue account. As per IRDA regulations, claims paid 4,90,000, legal expenses regarding claims 10,000, and premiums received, reinsurance premium paid, commission expense of management, provision against unexpired risk on 1st April 2022, claims unpaid at the beginning, at the end. Create reserve for unexpired risk. How much, sir? 50%. Now you see how you are going to prepare the revenue account of a general insurance company. General insurance company revenue account format. So this is a, say this format, cute little format, very simple. Say this. First we need to show what? Premium earned, note number 1. In this question, what is the premium earned? Premium earned, see this, premium received how much? 13. Minus premium paid, we need to deduct na? 12, correct? And here the important thing is, see this, premium received minus reinsurance premium paid, deduct 12, came net premium. You should not forget to create provision for unexpected risk reserve. See, this is which business? Fire. How much provision? 50%. See this, they created 50%. Now you tell me, what is the net premium earned? 12 lakhs. Correct? On 12 lakhs, 50% premium if I create, how much it will be? 6 lakhs. Already opening, how much premium is there? 5 lakh 50 already there, you see. Opening. That means how much is the excess we need to create now? 50,000. What is the entry? I told you. Entry for creation of provision. Fire revenue account debit to unexpected risk. That means in the revenue account, we need to debit now. Generally, it was adjusted from premium earned. See this, adjustment for change in reserve for unexpected risk 50. So from this 12,000, we need to deduct 50 and we need to show 11 lakh 50. So therefore, you see premium earned how much? 11 lakh 50. Important part. Most of the students, what they do, they forgot to adjust this. Closing provision you need to maintain how much? 6 lakhs. Opening already 5 lakh 50 is there. 50,000 provision you are creating in the current year, that will be adjusted from the premium earned. And this will be shown here. Other income is not there. Interest dividend not there. Claims incurred is there na, note number 2. Claims incurred. What is the claims incurred here? Claims incurred. I told you how to calculate claims incurred. See this. Claims paid how much? Expenses paid will be added. 5 lakhs. Minus opening will be, closing will be added, opening will be deducted. Correct? 5 lakhs plus 80,000 minus 50,000. I told you claims paid plus closing minus opening. How much? 5 lakhs 30,000. See this. Note number 2. See this. Claims paid, closing outstanding, opening outstanding will be deducted. Next, commission. Any commission we paid? 3 lakhs. Take it. 3 lakhs. Note 3. Operation expenses relating to insurance. There are, yes, expense of the management. How much? 2 lakhs. So that's it. We got operating profit of 1 lakh 20. So one time they have tested revenue account of this chapter, sir. Okay. So that's it, sir. We'll give. Wait. Okay, sir. So in relation to life and general insurance, sir, balance sheet and P&L account format, you cover it once, sir. I covered from examination perspective. Okay. That's it, sir. So next, Ind AS 19 we are going to cover, sir. For you in corporate accounting, Ind AS 19 and Ind AS 33. These two standards, they are quite frequently testing, sir. Ind AS 19, more chances that they may ask a question from this. Employee benefits. And I am going to cover this standard from examination perspective. If you go deep into the standard, na, sir, it will take a lot of time and not necessary also for you. Ind AS 19. Examination purpose, what questions they are testing, I will see, I will show you, I will solve also. First of all, what is this standard is all about? Ind AS 19. See this. See, employee. Suppose Mr. X is an employee in an organization, sir. In a company, Trident Limited. He is providing what? Services. For his services, company will give benefits. So these benefits which is given by the company to the employees for their services are called employee benefits. And This standard was introduced to provide the accounting treatment for these employee benefits, which is provided by the company to its employee. And this standard has divided the employee benefits into 4 categories, sir. This standard has divided the employee benefits into 4 categories. First, short-term employee benefits. What is short-term employee benefits? These are the benefits which is payable within 12 months from the balance sheet date. Like for example, salaries, wages, these things. Employees benefits payable within 12 months after the balance sheet date. Next, post-employment benefits. Sir, once employee, after the employment or at the time of retirement, what benefits we are going to pay to the employee? PF, gratuity, pension, all these things. Employee benefits payable after employment, that is on retirement, like PF, gratuity, pension. These are called post-employment benefits. Next, other long-term employee benefits. Any other benefits of long-term nature, which is payable within after 12 months from the balance sheet date. They will be called as other long-term employee benefits. For example, jubilee benefits. That means for the long-term service of the employee, company is giving some benefit to him. And there is one more thing called termination benefit. Termination benefit is which is payable to the employee on termination of him from the services. For example, any employee is terminated from the services, company will pay retrenchment compensation. So like this, employee benefits are divided into 4 categories. Now each one accounting treatment they are explaining. Like short-term employee benefits, what is the accounting treatment? Post-employment benefits, what is the accounting treatment? We need to learn. Okay. Now first to come to short-term employee benefits. See, in short-term employee benefits, we have salaries and wages, bonus, leave compensation. 3 items are there. One is salaries and wages. Second one is bonus. Third one is leave compensation is there. First to come to salaries. Sir, the one point, sir. This standard is the best example for accrual concept. That means the standard main intention is when expenses accrued, you need to recognize. That means when expenses will accrue, when employee provided the service. The moment employee provided the service, relating to that service, the corresponding benefit will be recognized. Suppose this month employee provided the service. The moment service is completed, this month's salary will be recognized. So this standard is the best example for accrual concept. Now short-term employment benefits, sir. First salaries and wages. Salaries and wages will be recognized, na, sir. Suppose for example you tell me, sir, salaries accrued. For example, every month employee provide the services, and once the month is completed, we will recognize salary in our books. Salaries accrued and paid. What is the entry? Salaries and wages to cash or bank. Suppose sometimes salaries accrued but we don't pay. Salaries to outstanding salaries. Salary to outstanding salary. Sometimes we will pay in advance. So salaries paid in advance to cash or bank. So like that. So salaries accrued and paid, salaries and wages to cash or bank. This salaries and wages is an employee benefit which will go to P&L account. Because these are short-term benefits now. They are payable within 12 months after the balance sheet date. Generally salaries and wages. Accrued but not paid, salaries and wages to outstanding salaries. This outstanding salary will be liability. Paid in advance means prepaid expenses to cash or bank. This one is done. Next to bonus. Important, sir. Sir, what is this bonus? See, company sometimes will promise to the employees that we will give you some bonus. We will give you some bonus. For example, if you meet some conditions, we will give you bonus. For example, there is a company, sir, Trident Limited. There is a employees. For the year 24-25, company announced that we will give you bonus, some percentage of profits. Target is what? For example, target is sales should increase by or sales should exceed 10 crores. If this target is achieved, company will recognize the bonus in the books as an expenses. If they don't achieve, we don't recognize. So therefore, for example, 31st March 2025 year end, target achieved. Company will recognize the provision. What is the entry? Bonus to provision for bonus. This bonus will go to P&L account as an employee benefit expenses. When bonus paid, provision for bonus to cash or bank. Now here one important point, sir, one important point. Company promised how much? 5%. Suppose some of the employees may left the organization early. Therefore, what board of directors will think is they will pay only 4%. Pay only 4%. In that situation, we need to consider only 4%, not 5%. So therefore, when you are calculating bonus, consider the expectations of employees given in the question. So actually, as per the plan, 5%. But if it is only 4%, ultimately board of directors decided to pay, we take only 4%. So therefore, you need to understand, sir, bonus is also a short-term employee benefit. When company will recognize the bonus? When the target is met. Hello? And company will make an estimation and will create a provision. This is accounting treatment for bonus, sir. So salaries and wages, bonus. Next, leave compensation. This is very, very important, sir. Leave compensation. Listen to me carefully, sir. Sir, leave compensation means, okay, leave compensation, sir. See, this is also one of the short-term employee benefits. Listen to me carefully. This is nothing but leave salary, sir. Sir, company will give you some leaves to the employees. Casual leave, sick leave, paid leaves, they will give, right? That means even though you don't work for that period, they will give payment. That is called compensated leaves. Hello? Now, actually the leaves are divided into two categories, sir. One is accumulating leaves. Another one is non-accumulating leaves. Accumulating, non-accumulating. Accumulating means what? Suppose they will give you some leaves in a year. Even if you don't utilize, they can be carried forward to the next year and you can use it. If non-accumulating means what? They will give you some leaves. You have to use in the current year itself. They won't be carried forward. Now in accumulating, again we have two categories. Vesting, non-vesting. Vesting, non-vesting. Vesting means you can take cash for the unused leaves. You can take cash. They will get compensated. Non-vesting means no cash. You have to use it. That's it. Next year you can use it. So suppose for example, in a year, suppose there is 24-25, sir. In this year, total working days in a company is 300. 300 days working days, sir. Okay? And in this paid leaves, company has given a paid leaves of 15 days. 15 days paid leaves. Suppose there is one employee, Mr. X. One employee, Mr. X. Now, he worked all 300 days. He worked all 300 days. That means how many leaves is there for him? 15 days. Now you see, these 15 days are accumulated leaves for him. Right? 15 days are accumulated leaves for him. And these are vesting. These are accumulating. Accumulating means these leaves, if he don't utilize, he can carry forward to the next year, he can carry forward. 15 days leave. Now suppose for example, per day salary is, suppose 2000 rupees. Per day salary 2000. You tell me 15 into 2000. How much? 30,000. Now what company will do is, in the year end 31st March 2025, company should create a provision. The moment employee provided his service for the year 24-25, for the completed year he earned leaves. Na? He rendered the service. For that year he earned how many leaves? 15 leaves. These are accumulating. These are accumulating. So therefore, company point of view, this 15 days salary, company will create a provision. At the end of the year, company will create a provision. So what is the entry? Leave salary account debit to provision for leave salary. Company will create a provision for leave salary account. They will write 30,000, 30,000. So therefore you need to understand, sir, in respect of leave compensation, paid leaves, when employee provided his services in the year of service, whatever the leaves he earned, for that company has to create a provision in the year itself. At the end of the year itself, company has to create a provision. Leave salary to provision for leave salary account, 30,000, 30,000. Hello? Next, see this, important. Next year, 31st March 2026, sir. Suppose these are vesting in nature, vesting. Next year, sir, these 15 days he has not used. That means company will pay cash. So the entry is provision for leave salary account debit to cash or bank. That's it. And in the last year, this leave salary will go to P&L account as employee benefit expenses. This is our liability. Correct? This year we paid. How much? 30, 30. If it is vesting. If it is non-vesting, we don't give. No. In non-vesting, we don't give cash. So therefore, ideally what employee will do? He will use 15 days leave. Sir, when you came to know that next year, if I don't use, these will be lapsed. What you will do? Generally you will use. That means next year, how many days you worked? 300 days working days, 15 days normal holidays. So you have to work how many days? 285. But last year carry forward 15 days also you will take leave. That means you worked 260, 285, 270 days you work. Sir, think in a year how many days? 300. Normal leave you used in the year 25, 26. Carry forward leave 15. How much? 270. That means if you work 270 days, per day 2000 salary, company will give you 5,40,000. So this 15 days carry forward leave is there, na sir. Last year carry forward leave. Whatever the provision already created in the last year, this provision first we need to deduct from the entire salary. So therefore, here the entry in case of non-vesting is salary account debit, provision for leave salary account debit to bank account. Provision for leave salary 30. Salary 5 lakh. Salary how much he will get, sir? Generally 300 into 2000. This is the salary, na sir? 6 lakhs. But minus 30 or 60 or 30. He will get 5,70,000 salary he will get. So what is the difference between vesting and non-vesting? In vesting we will pay cash. That means we will write a separate entry. Leave salary to bank. In case of non-vesting, the carry forward leave he has utilized in the current year. So therefore whatever the leave salary is there, it is deducted from the salary and you will pay the remaining. You will transfer this much to salary account. This will be provision. You paid totally how much? 6 lakhs. See, that means, you need to understand, sir, in a year, in order to get full salary, he has to work how many days? 285 days he has to work. Then he will get 300 days salary. Hello? But in the current year, he worked 270. Even though he worked 270, he will get full salary. But you need to understand, 270 days he worked in the current year. Remaining 15 days are belongs to last year. This year he has to take leave. Therefore, this year salary expenses should be only 5,70,000. 30,000 will be provision. So therefore, you need to understand, sir, whenever in respect of leave compensation, the treatment is very simple, sir. You need to see whether the leaves are accumulating or non-accumulating. Accumulating means leaves can be carry forward. Non-accumulating means leaves cannot be carry forward. If the leaves are accumulating, then we need to see vesting or non-vesting. Vesting means he can take cash. Non-vesting means he cannot take cash. So, in the year in which he earned leave, That year only we need to recognize a provision. The entry is leave salary to provision for leave salary. Next year if they are vesting, provision to cash or bank. If they are non-vesting, the provision we deduct from the salary provided he utilized that. Hello. And accordingly we need to calculate. So that is what the treatment, sir. See this, accumulating, non-accumulating. Vested means cash can be taken, non-vesting means cannot be encashed but can avail extra leaves. So in case of vesting, what is the entry? This will be paid separately, correct? Now? In case of non-vesting, provision will be deducted from salary and will be paid. Hello? See, in the ICMA study material, there is one question I will show you. See this, sir. Illustration number 2, you see. Mr. X is a employee of ABC. His annual salary is how much? 15 lakhs. The company follows 300 working days policy. As per policy of the company, Mr. X is entitled to leave of how many days? 10 days. He, however, utilizes 8 days. That means how many unused leave? Unused leaves are not allowed to be carried forward but are settled by way of payment to the employee. That means this year only they will settle. Compute the total employee benefit expenses of ABC Limited in respect of Mr. X. Simple, sir. Sir, regular salary how much, sir? This is one employee benefit. And also salary will be paid. This is one employee benefit. Next, leave salary will be paid now. How much leave salary will be paid? Actually 300 working days, sir. 15 lakhs. 15 lakhs divided by 300. 5,000 per day. Like that how many days? 2 into 5,000. How much, sir? 10,000. So 15 lakhs plus 10,000. 15 lakhs, 10,000 is the total employee benefits, which is to be recognized. Next, come to illustration number 1, sir. A Limited has how many employees, sir? 100. Each employee is entitled to 10 days sick leave each year. Unused sick leave is carry forward for 1 year. The company avails the carry forward leave. The employee avails the carry forward leave only if the current year entitlement falls short of the leave he or she requires. Correct only, na, sir? First, he will utilize the current year leaves. Then only carry forward leaves, if required, he will utilize. Every year he will get how many days sick leave? 10 days. On December 31st, 2022, see this. The average unused sick leave is how many days? 2 days per employee. Average unused day is 2 days per employee. And the management, based on experience, estimates that in the year 2023, next year, only 10% of the employee will use only 1 day from their carry forward leave, and the rest of the employees will not require more than 10 days of leave. Average payment per employee per day is how much? 100. How will you treat this? Very simple. You tell me. Suppose total how many employees? 100. In this, 10% of the employees will use how many days? 1 day next year. Correct? Unused leaves are 2. But we are expecting 1 day he will use. That to how many employees? 10%. 100 into 10% into 1. 10 into each day salary? 100. Tell me. 1000. For this, company has to create a provision. Company will create a provision. What is the entry? Leave salary to provision for leave salary. 1000. Correct? See this. In 2023, the firm will pay in total additional, see this one, additional, this one, 100 employees, 10%, 1 day, or 10 days of pay as a result of unused entitlement calculated as of December 31st, 2023. If the average payment per employee is 100, if the firm should provide for a liability of how much? 1000. Therefore, expenses on salaries and wages to be recognized in P&L account for the current year is the total amount paid or payable for the current year? 1000. Correct? This 1000 is the provision for additional amount to be paid in 2023 as a result of unused entitlement accumulated as of December 31st, 2022. So therefore, sir, you need to see in respect of the paid leaves, what are the paid leaves available, and as a management, how much I am expecting that employees is going to use in the next year. Based on that, I need to create a provision. In this case, 100 employees are there, but in that only 10% of the employees will use only 1 day. Therefore, next year, 10 days salary I need to pay to them, either in the form of cash or in the form of, adjustment as a salary in case of non-vesting. For that, I need to create a provision. Hello? And also, sir, you see this question, consider the following information. Number of employees, 150, sir. Employee turnover rate, 6%. Bonus paid to each employee last year. Increase in bonus due to inflation, 7%. Determine the liability and expenses to be recognized. Simple, sir. How many employees? 150. Last year bonus paid 1 lakh. But this year is how much? 7%. So that means increase 1 lakh into 7%. Increase in bonus due to inflation 7%. So add 7% on 1 lakh, 7,000. Correct? So bonus payable for the current year is 1 lakh 7,000 into 150 employees, but turnover rate is 6%. That means 6% you deduct, you will get 141. So 141 into 1 lakh 7,000. How much? 1 crore 50 lakhs 87,000. This is the total bonus. What is the entry? Bonus to provision for bonus. This bonus will go to employee benefit expenses. So bonus payable is equal to amount of bonus per employee into number of employees expected to meet the condition. Number of employees expected to meet the condition, 140. What is the bonus per employee? 1 lakh 7,000. For that we need to create a provision. And also relating to bonus, one point I told, sir. Suppose there is a company, sir. This company announced profit sharing plan, nothing but bonus, to an entity to pay specified portion of its net profit for the year to employee who served throughout the year. If employee serves throughout the year, company will pay bonus. If no employee leaves during the year, the total profit sharing for the year will be how much, sir? 5% of net profit. The entity estimates that some of the staff may leave during the year and therefore not entitled for profit sharing. This will reduce the payment of profit sharing from 5 to 4%. Advise the company. Now you tell me, will you take 5% or 4%? 4%. I told you, when you are calculating bonus, you need to consider expectations. So these questions, because see, in this standard, sir, whatever the questions are there in the study material, they are only asking, sir. No, nothing new questions they are asking. Just examination questions if you observe also. See this. Just now we solved one question, na, illustration 4. Same question they asked in the examination, that bonus. Number of employees 450, turnover rate 8%. Bonus paid to each employee 3 lakhs. Increase in bonus 6%. They are asking us how much is the liability expenses. Simple. Number of employees expected to meet the condition, 450 minus 8%, 414. Bonus 3 lakhs plus 6%, 3 lakhs 18,000. So total this one. Provision for bonus will create. This question they asked, sir. See this. This is the concept. Okay. So we have completed what? Actually, I told you as per AS 19, employee benefits are 4 categories. What is the first one? Short-term employee benefits. What is the accounting treatment for short-term employee benefits? Simple. Short-term employee benefits will be recognized the moment those expenses are accrued. We will recognize in the books. Short-term employee benefits are 3 categories. What are those? Salaries and wages, bonus, leave compensation. We discussed everything. Hello. Next, the most important is post-employment benefits. Post-employment benefits. Listen to me carefully. Here, I am explaining purely from examination point of view. No need to go in detail. Okay, examination perspective, to the extent required, I will tell you. Post-employment benefit. What is post-employment benefit? Employment benefits payable to the employee on retirement. Correct? See, they have divided these post-employment benefits into 2 categories. One is defined contribution plan, another one is defined benefit plan. Defined contribution plan, defined benefit plan. Defined contribution plan means employer every year or periodically contribute some amount. That's it. For example, PF is the best example. PF. Company deposit into PF account for the benefit of employee. Now, employee on retirement, he will get PF. This is called what? Defined contribution plan. Defined contribution plan. So company makes specific amount of contribution to the fund. Company obligation is over after making the contribution to PF fund. Once the contribution is made, company obligation is over. So what is the entry company will write? Whenever any PF contribution is accrued, every month, suppose every year we need to contribute. Now when the date occurs, what is the entry? Defined contribution expenses to defined contribution payable. Defined contribution expenses to defined contribution payable. That means expenses to liability appa. Expenses and liability. Or we can write PF expenses to PF contribution. Hello. When we pay defined contribution payable to cash or bank account. Correct? Next. So post-employment benefits are two categories. One is defined contribution plan. Defined contribution plan is very straightforward. Whenever contribution is due, you write the due entry. PF contribution, PF expenses to PF contribution. When you pay, PF contribution to cash or bank. And the moment you deposit, your job is over. Your risk is over as an employer. Now come to the defined benefit plan. In defined benefit plan, sir, as an employer, I am giving guarantee to my employee that you are going to get this much amount. I am giving assurance. In defined contribution plan, I am not giving any assurance to you. I will contribute every month out of your salary 15% to PF account, 10% or this much amount I will contribute. At the time of retirement, how much you are going to get, it is not my headache. That is defined contribution plan. But in defined benefit plan, in this plan, employer defined the benefit, employee is going to get at the time of retirement. For example, it is like this. Benefit is last drawn salary into some percentage, benefit percentage into number of years of service. For example, sir, what is your last drawn salary at the time of retirement? On that 25% you are going to get for every completed year of service. Suppose his last drawn salary is 24 lakhs. 25% for 5 years he serviced. Therefore, he is going to get 30 lakhs. Now, it is the responsibility of whom? Employer, to make sure that employee is going to get 30 lakhs. So, therefore, every year what he has to do is, this 30 lakhs will be divided into number of years of service. So, every year how much? 6 lakhs. For 6 lakhs, he has to create a provision. He has to create a provision. But the problem is, this 6 lakhs is what? Future amount. He is going to pay at the time of retirement. Now I am at the end of the first year. Therefore, this 6 lakhs I will convert into present value. The 6 lakhs I will convert into present value. That amount, that liability I converted into present value is called current service cost. What is that? Current service cost. So their entry is current service cost account debit to defined benefit obligation account. Defined benefit obligation is basically what? My liability. Hello. So therefore, sir, in defined benefit plan, as an employer, every year I will in my books create a liability, expense as well as liability based on present value. Based on present value. So therefore, see, as an employer in my books, what is there? As an employer in my books, I created what? Liability. What is my liability? DBO, defined benefit obligation. Defined benefit obligation. This benefit I need to pay to whom? Employees. When? At the time of retirement. Now to pay that liability, I will save some investments. Those are called plan assets. I will save some investments. Suppose I know that I need to pay this much amount to employees at the time of retirement. So what I will do is I will save some investments. I will make some investments. So those are called what? Plan assets. What is plan asset? It is a planned investment for meeting what? Defined benefit obligation. And every year make sure that it is recognized at what value? Fair value. This plan assets will be recognized at fair value. Now sir, relating to this fair value, sir, important sir, listen. They may ask a question relating to this plan assets, sir. First of all, you understand what is plan assets? What is plan assets? Savings done by the employer to meet future liability. Which liability? DBO, defined benefit obligation. defined benefit obligation. Because in DBO, I am giving responsible. I am assuring the employee that he is going to get this much amount. But in DCO, defined contribution plan, DCB, I am just contributing. They will make. I am not responsible. So in DBO, it is my responsibility. Therefore, in my books, I will create a liability. And this liability will be discharged at the retirement, right? So this DBO will be there as liability in my books. First thing. Now to meet this obligation, what I create? Asset. Those assets are called plan assets. Hello. So therefore, whenever I made investment, the entry is plan assets to bank. And from these plan assets, I can expect some return. Sir, I will invest in shares, debentures, bonds. Correct? Now, see, they may ask a question that how this plan assets, how to calculate the actual return, expected return. See this, everybody. First to take the opening fair value of the plan assets. Opening fair value of the plan assets. Add contribution to plan assets. Any contribution you are making to the plan assets, add. Because if you make contribution, your assets value will increase. Any benefits paid. Benefits paid means from this plan assets, any amount paid to employees, deduct. Correct? And now you will get one amount, right? Compare this with the closing fair value of assets. The difference is nothing but what? Your actual return. Your actual return. For example, you see, your opening fair value is how much? 8 lakhs. During their contribution, 80. And how much you paid? 2 lakhs. How much is balance? 8 lakh 80. But your closing fair value? 11 lakh 40. How much increase? That is called actual return. That is called actual return. They will ask you to calculate actual return. They will ask you to calculate actual return of the plan assets. Trust me guys, only this much is more than sufficient. You see this question. Following information applies to the company's defined benefit pension plan. See this. Fair market value of the assets at the beginning, how much? At the end? Employer contribution? Benefits paid? Calculate actual return. How to calculate actual return? Tell me. First you need to take opening 2 lakhs. Plus contribution made during the year? 70. How much benefit paid? Minus. Common sense, sir. At the beginning, how much you have? 2 lakhs. How much contributed? 70. How much paid? 50. What is the amount? 2 lakhs 20. What will be the closing balance? 2 lakh 85. So what is the difference? 65,000. This is what? Actual return. See this 65,000 is the actual return. This question they will ask for 7 marks. Trust me. Only problem with the student is that he doesn't know what is plan assets. If you know this much simple, opening plan assets, contribution minus benefits paid. Compare with closing. The difference is nothing but actual return. Or else we can compute this in another manner also. Another manner is this one. Yeah, this one I told you actual return. This one. This is how we calculate. I told this. Follow this simple one. Opening, contribution, benefits paid. Compare with closing. The difference is 65. Hello? Or else you can calculate like this also. First to take the change in plan assets, 85. That means the difference between opening and closing. Adjustment. Employer contribution how much? 70. How much benefits you paid? 50. 70 minus 50. 20 is the net contribution. 85, 20. So actual return is 65. This is the change. In this change contribution 20. Net contribution. So 65 you generated actual return. This is also UA. So my method is good. This one. Opening plus contribution minus benefits paid. Compare with closing. The difference is actual. Or else you can prepare just plan assets account also. Account. Opening balance 2 lakhs. Closing balance 2 lakh 85,000. Benefits paid 70,000. 50,000 credit. Automatically you will get actual return. Hello. Next. Next one, sir. See. So you have now 2 things. What are the 2 things? Tell me. On one hand you have DBO. On one hand you have DBO. DBO is what? Liability. On the other hand you have plan assets. What you need to do is, you need to set off both assets, liability. Net amount you will show. Net defined benefit obligation you need to show in the books. Everybody, see this. Plan assets DBO are netted off and shown in balance sheet. If plan asset is higher than DBO, net defined benefit assets will come. If DBO is higher than plan assets, net defined benefit liability will come, which will be shown in non-current liability. If it is an asset, it will be shown in non-current assets. Abba, simple way appa. So tell me, post-employment benefits, 2 plans I told, tell me. Post-employment benefits, 2 categories. What are those? Defined contribution, defined benefit. Contribution you ignore. Simply due date come, you paid, that's it. Defined benefit I am talking. Defined benefit obligation, you create a liability in your books. That is called DBO. DBO. In respect of DBO, you created asset, plan assets. How to calculate actual written of plan assets also I told. So on the balance sheet, both will be netted off. Assets is more than liability, non-current, net defined benefit asset. If liability is more, net defined benefit obligation, liability you will show. There is one concept called asset ceiling here. There is one concept called asset ceiling. What is this asset ceiling? I tell you. This question is also there in the study material. But before that, you see illustration number 6. You see illustration number 6. Consider the following information. PV of the defined contribution plan is how much? 15. PV, present value. Defined contribution obligation. This is not defined contribution. This is defined benefit. Fair value of the plan assets 4.12. How will you treat the above for presentation in the balance sheet? Tell me. So your asset is how much? 14.12. Your liability 15. Both will be set off. Hello. So difference is how much? 0.88. What is this? This is net defined benefit liability. Where will you show? Non-current liabilities. Non-current liabilities you will show. Net defined liability. Everybody. Next. There is one concept called asset ceiling, sir. Sir, what is this asset ceiling? Very simple, sir. See this. Sir, see, you are comparing two things, na, sir. What are the? You are comparing plan assets DBO. Suppose your plan assets 140, DBO 110. So plan assets is more. How much? 30. But sometimes they will put a ceiling. The authorities will put a ceiling. The authorities which will provide post-employment benefits will put a ceiling. That as a company you have to take this much only. Suppose they put a ceiling of 20, asset ceiling. That means you need to take only 20. That 10 is nothing but is your loss. Hello. Therefore in the balance sheet your asset will be only 20. That's it. So relating to this one question there. See this. See this. Suppose consider the following information. Present value of defined contribution obligation is how much? 15. Fair value of the plan assets. Compare these two. 0.22 is what? Net defined asset. But ceiling 0.1. So asset will be shown at 0.1. That's it. Lower of the 0.1 is surplus, which is treated as net defined benefit. So all 7 questions I completed, sir. And this question is nothing but, see, examination question similar to illustration 5. Same, actual written on plan assets. Actual written I told na, opening 2,80,000 plus contribution minus benefits paid, compare with closing. You will get actual written. That's it. All questions completed. My gut feeling is out of this one question will come. See how easy it is. Hello. Next, other employment benefits. Next one is, I told you 4 types of employment benefits. First, short-term employment benefits. Next, post-employment benefits. Next, other long-term employment benefits. Other long-term employment benefits accounting treatment is similar to defined benefit obligation. Just now we discussed in the same manner we have to do. And termination benefits. Same. If termination benefits like VRS, voluntary retirement service, if it is to be paid within next 12 months, treated as short-term employment benefits. When the amount is accrued, you pay, you recognize and pay it within the next 12 months, treated as short-term employment benefits. Otherwise treated as long-term employment benefits. So therefore you learn only 2 things, sir, that will be more than sufficient. This is Ind AS 19 we completed, sir. Okay, sir. Next we are going to cover Ind AS 33 EPS. Core part of EPS I am going to cover, sir. When it comes to EPS, sir, you know there are 2 categories: basic, diluted EPS. And we have discussed in financial statements also. When you are preparing P&L account, last item is what, sir? EPS, basic as well as diluted EPS. So this Ind AS basically providing you the methodology for computation of EPS. Computation methodology they will tell you. First we will see basic EPS. How to calculate basic EPS? The formula to calculate basic EPS is net profit or loss for the period attributable to equity shareholders divided by weighted average number of equity shares outstanding during the period. So numerator, denominator, sir. Net profit or loss for the period attributable to equity shareholders is 1. Weighted average number of equity shares during the period is 1. These 2 things you need to determine. First we will see net profit or loss for the period to equity shareholders. What is the net profit or loss attributable to equity shareholders? Simple, sir. PAT minus preference dividend. PAT minus preference dividend. PBT they will give, tax expenses you deduct, you will get PAT. From that preference dividend you deduct. Then automatically the balance left is amount net profit attributable to equity shareholders. Now in respect of preference shares, sir, they can be cumulative, non-cumulative. If the preference shares are cumulative, even though they have not provided, you need to take preference dividend. In case of non-cumulative, only if they provide preference dividend, you need to consider. In respect of preference shares, there is a preference dividend, na? The dividend will be considered in case of cumulative, whether given or not. In case of non-cumulative, only provided we need to consider. Now how to calculate this weighted average number of equity shares? Simple. Number of shares outstanding at the beginning of the period, add number of shares issued during the year minus shares bought back, multiplied with time weight factor. Multiplied with time weight factor. So see this. Suppose the number of shares outstanding at the beginning of the period, multiply with time weight factor. That means how much period in the year they are outstanding. Number of shares issued during the period, multiply with time weight factor. That means from which day these shares are coming to effect. How many months divided by 12 you will do. Next, number of shares bought back. Because of bought back, your shares will decrease, sir, outstanding, minus it. For example, you take this, sir. Suppose financial year 24-25, sir. At the beginning, 1800 shares are there. On 1/9/2024, company issued 600 shares. On 1/2/2025, company bought back 300 shares. Hello? Now you see, how to calculate weighted average number of shares? 1800 into 12 by 12, because they are there from the beginning. Next, 600 into they are there from September. Hello? September, October, November, December, January, February, March. How many months? 7 months you take. And these are 300 shares on 1st February. That means February, March. 2 by 12. Minus it. So see this. 1800 into 12 by 12. 600 into 7 by 12. 300 into 2 by 12. So you will get what? 2100. This is how you will calculate weighted average number of equity shares. For example, you see here, same question, I think, illustration number 2. This question, you see, this company has 3600 shares. On 31st August 2023, it issued 1200. On 31st January 2023, it bought back 600. Calculate weighted average number of shares. So 3600 into 12 by 12, correct? Because they are there from the beginning. 1200 into when they issued 31st August. That means September, October, November, December, January, February, March. So how many months? 7 months. Minus 600 into February, March, 2 months. 4200. This is how we need to calculate weighted average number of equity shares, sir. Very simple. Now come to bonus shares, sir. Important. Sir, what is basically bonus shares? Any shares which is given free of cost. That means in case of bonus issue, there is no inflow of funds, but our number of shares will increase. For example, there is a company A Limited, sir. 2024-2025. Last year net profit 10 lakhs, current year also net profit 10 lakhs. But last year number of shares 1 lakh, sir. This year number of shares 2 lakhs. So therefore, you see, because of the bonus issue, what happens? Number of shares doubled. Now basic EPS last year 10, this year 5. That means 50% down EPS. Now anybody who sees this, what they feel about company performance? Performance is bad because EPS is decreasing. But it is not the case. In fact, our profit is same. Now why this decrease happened? Because of increase in number of shares. This increase has the potential to affect my earnings? No. Because it is a bonus issue. Bonus issue does not affect my earnings because no new funds are coming to the organization. So therefore, in this situation, what standard says is, you need to restate the last year EPS. As if this bonus is there from the beginning of the last year. So therefore, if bonus shares are there from the beginning of the last year, your number of shares will be 2 lakhs. So therefore, last year EPS is 10 lakhs divided by 2, 5. So current year EPS 5, previous year basic EPS 10, restated EPS 5. This is what we need to do, sir, in case of bonus issue. For example, see this question. Illustration number 9, you see. C Limited had 10 lakhs ordinary shares outstanding on 1/4/2022. On 1/1/2023, it issued 2 ordinary shares bonus for each outstanding on 31st December 2022. Profit for the year 21-22 was 9 lakhs. Profit for 22-23 is 30 lakhs. Compute basic EPS and adjusted EPS for 21-22. Sir, in this case, you need to understand, sir. First of all, what is the basic EPS? What is the current year profit, sir? 30 lakhs. Divided by number of shares 10 lakhs outstanding. Bonus shares, sir, 2 ordinary shares for each share. That means it will become 10 lakhs plus 20 lakhs bonus shares. So total 30 lakhs. So 30 lakhs divided by 30, 1. So basic EPS is 1. Now in the current year, if there is a bonus issue, what we need to do? We need to restate the last year EPS. Because of the bonus issue, there is no inflow of funds. So we need to make sure that this bonus is there from the beginning of the last year. Accordingly, we need to recalculate it. If you recalculate the last year EPS, what is the last year profit? 9 lakhs given. 9 lakhs divided by last year number of shares 10 plus 20. So 9 lakhs divided by 30. 0.3. So this is the restated EPS. This is what you need to do in case of bonus issue. In case of bonus issue, sir. Next. Now the most important topic in this chapter is right issue. Listen. See, right shares means what, sir? The shares which is offered by the company to the existing shareholders at concessional price, not free of cost. Bonus shares are given free of cost. But right shares, concession price. Suppose for example, market price 20, they offered at 15. So how much is the concession? 5. So there is a bonus element in right issue. There is a bonus element in right issue. So like in case of bonus shares, because of the bonus issue, our number of shares are increasing without corresponding impact on my earnings. So therefore last year EPS I was restating. Similarly, whenever company issued right shares, in the right shares I know there is a bonus element. When there is a bonus element, what I need to do? I need to find out that bonus element and I need to apply this bonus element on the last year shares, and last year EPS I need to restate. Now how to calculate this bonus element? They have given a formula. The formula is fair value of the shares before right issue. Before right issue, what is the fair value of the share? Divided by theoretical ex-right fair value per share. TERP. Theoretical ex-right fair value per share. How to find out theoretical ex-right fair value per share? What is the aggregate market value of the shares immediately prior to exercising of rights plus proceeds from exercising of rights divided by number of shares outstanding immediately after the right issue. Today I think we discussed valuation of right. Valuation of right. How to find out value of right? Market price minus average price. Average price how to find out? Market price of the existing shares plus proceeds from right issue divided by Number of shares plus right shares, same formula, TERP. So aggregate market value of the shares immediately prior to exercising of rights plus proceeds from exercising of rights divided by number of shares immediately after right issue. Suppose see, fair value of the shares given 25. Theoretical ex-right fair value given 24. So 25 divided by 24, 1.04. This 1.04 is what? Bonus element. This bonus element multiplied with number of shares of the last year, you will get number of shares including bonus element. And accordingly, last year EPS will be restated. Last year EPS will be restated. For example, 10,000 shares are there in the last year. Multiplied with bonus element, 1.04. The shares will be 10,400. That means what? 400 shares are the bonus element in the right shares. Bonus shares are in the right shares. In the right issue, bonus element is 400 shares. Now we'll solve one question, sir. Illustration number 8. Important question this is. They may test this in exams. See this question. Y Limited supplied the following information, sir. Net profit for the year 21-22, 10 lakhs. 22-23, 15 lakhs. So current year 22-23, 21-22 last year. Number of shares prior to right issue, 5 lakhs. Terms of right issue, 1 new share for every 4. Right issue price is 20 rupees. Here one point they missed, sir. Last date to exercise the rights is 30th June 2022. They missed this. Last date to exercise the rights is 30th June 2022. Fair value of 1 share immediately before right issue is how much? 25. Calculate basic EPS. Tell me what is the current year here? 22-23. Last year 21-22. First we need to calculate basic EPS. Then we'll think about the restated EPS. Basic EPS, how you are going to calculate? Tell me. See, your net profit is 15. Agreed? Basic EPS, see this. Your net profit is 15. Number of shares outstanding. See this. Already how many shares you had? 5 lakhs. And current year what happened? Right issue. In case of right issue, what I told? There is a bonus element. This bonus is there from the beginning of the last year. So therefore, beginning of the last year means from the beginning of the current year also that bonus is there. Hello. So therefore, I need to find out the bonus element first. How to find out bonus element? Fair value before right issue. How much is the fair value before right issue? 25. Divided by theoretical ex-right fair value per share, I need to find out. Theoretical ex-right fair value per share. Number of shares immediately before right issue, how many? 5 lakhs, say this. Into market value, 25. Plus number of right shares. Right shares, how many, sir? 4 for 1 share. 1 new share for every 4. 5 lakhs divided by 4. 1,25,000 into excise price 20 divided by number of shares after right issue 5 plus 1. It got 40. 20. See this 25 divided by 24 1.04. This is called what? Bonus element 1.04. See this I need to apply on the number of shares outstanding 5 lakhs into 1.04 into 3 by 12 because in the question when the bonus when the right shares will be exercised, sir? 30th June 2022. That means April, May, June. First 3 months. Outstanding 3 by 12. Next onwards 6 lakhs 25 into 9 by 12. Why 6 lakhs 25,000? 5 lakhs plus right shares 1 lakh 25. Total 6 lakhs 25 for 9 months. That means indirectly what I have done is 5 lakhs into 1.04. 5 lakhs 20,000. First 3 months. Next 6 lakhs 25 into 9 by 12. Because the assumption is what? This bonus is there from the beginning of the last year means it is there from the beginning of the current year. That's why 5 lakhs is multiplied with bonus factor outstanding for first 3 months. Then after right issue it becomes 6 lakhs 25 for 9 months. So that means total bonus, total right shares 1 lakh 25. In that 1 lakh 25,000, 20,000 is what? Bonus. How? 5 lakhs into 1.04 you apply. How much we got? 5 lakh 20 we got. 5 lakh 20 means 20,000 shares. That means in this 1 lakh 25,000, 20,000 shares are there from the beginning of the last year. Therefore, it is there from the beginning of the current year also. That means first 3 months, our outstanding shares is 5 lakh 20 into 3 by 12. 5 lakh 20 into 3 by 12. Next 6 lakhs 25 into 9 by 12. Therefore, number of shares, 5,98,750. Correct? So therefore basic EPS 15 divided by 5,98,750. It was 2.5. Now I need to restate the last year EPS. What is my last year profit? 10 lakhs pa. Divided by last year shares 5 lakhs multiplied with bonus factor. So therefore you got 1.92. See this. This you need to compare. These two you need to compare. You understand this? This is the right shares concept, sir. This is the right states concept. Next, diluted EPS. Another concept is what? Diluted EPS. Basic EPS we have seen. Next, diluted EPS. What is diluted EPS? See, there are some potential equity shares. Potential equity shares means they are not equity shares. In future, they may become equity shares. They are called potential equity shares. Like convertible bonds, convertible debentures. Okay, these are options. These are all ESOPs. These are all what? Potential equity shares. If these potential equity shares really get converted into equity shares, what is the effect on EPS? If the EPS is decreasing, then that is called diluted EPS. Whether the potential equity shares will have dilution effect or not. Dilution effect means your basic EPS should come down. Then we say they have dilution effect. If there is a dilution effect, then only we consider. If they are not diluted, if they are not have dilution effect, ignore. Hello. So what is the formula for diluted EPS? Net profit or loss for the period attributable to equity shareholders after considering the effect of conversion of potential equity shares. After considering the effect of potential equity shares, what will be the effect on my net profit? Divided by weighted average number of equity shares outstanding during the period after considering the effect of conversion of potential equity shares. For example, convertible debentures you take. Convertible debentures is what? Potential equity shares. Suppose this company is having 10% debentures of 10 lakhs, sir. If they get converted into equity shares, what is the effect? Tell me. First, interest cost will be saved. Sir, if debentures is converted into equity shares, on this 10 lakhs, 10%, 1 lakh interest cost will be saved. That means to that extent my profit will increase. But on this increased profit, I need to pay tax. 30%, 30,000. So therefore, my net profit, interest cost saved will be added, tax expenses will be deducted. Then I will get this one. Net profit or loss for the period attributable to equity shareholders divided by weighted average number of equity shares. Similarly, convertible bonds. Everybody. For example, I will show you one question. Yeah, see this question. D Limited had outstanding ordinary shares 10 lakhs. Ordinary shares means equity shares on 1/4/2022. Profit for the year is how much? 20 lakhs. D Limited had 12%, 20,000 convertible debentures outstanding of 100 each to be converted into 10 ordinary shares. Tax rate 30. Calculate basic and diluted EPS. Come on, tell me. Basic EPS 20 lakhs divided by 10 lakhs. Profit is 20. Number of shares outstanding 10. So basic EPS 2. Very simple. Hello. Now compute diluted EPS. Here we need to compute diluted EPS. Why we need to compute? Because convertible debentures is there. Convertible debentures is what? Potential equity shares. Now see, if this 20,000 convertible debentures of 100 each is converted into equity shares, what will be the effect on profit? Tell me. 20,000 into 100 into 12%. Interest cost will be saved na. How much interest cost will be saved? 2,40,000. 2,40,000. And tax 72,000 will come. What is the net impact? See this. 20 lakhs plus 2,40,000 minus 72 divided by outstanding shares 10 lakhs plus you convert another 2 lakhs will come. So therefore your diluted EPS is 1.81. Your basic EPS, your diluted EPS, that means convertible debentures is having dilution effect. Hello. That's it. Like this you need to calculate, sir. And one more important point I will tell you, sir. Yeah, this one, sir. Illustration 6, you see. Illustration 6, they are talking about options. They are talking about what? Options. See, E Limited had 10 lakhs ordinary shares outstanding on 1/4/2022. Profit for the year is how much? 24 lakhs. So basic EPS 24 divided by 10, 2.4. Now, Average fair value per share during 22-23 is how much? 20. What is this? Average fair value per share. Fair value per share is 20. E Limited has given a share option to its employees. Share option to employees. How many? 2 lakh shares at the option price of 15. Now you tell me, company giving option to employees, ESOP, employee stock option, whether these options are potential equity shares? Yes. When employees satisfy the condition, exercise the options, we have to issue shares. So these are potential equity shares. But the point is whether these potential equity shares fully can dilute the EPS. The answer is no, because here what is the fair value? 20. Company is giving it 15. That means how many shares, how many options company is issuing without taking, how much is the discount? 5 rupees. 5 rupees. Therefore here you need to see here, see this, 2 lakh options into 15 rupees company collecting, divided by 20 you do 1 lakh 50. That means full consideration is received for only 1 lakh 50. But we are issuing, that means only 50,000 options are dilution effect. Hello. So therefore when you are finding the diluted EPS, what you need to do is your profit 24 lakhs divided by outstanding shares 10 lakhs plus out of the EPS how many shares will have dilution effect? 50,000. You take it. So therefore 24 lakhs divided by 10 lakh 50. How much, sir? 2.29. This is the answer. See this. Very good sum this is actually. Why I consider like this, you understood? Huh? Because in case of options, fair value is 20, you are giving at 15. How many shares are issued without consideration? 50,000. Only those shares will have dilution effect. That is what they given. Number of shares that would have been issued at fair value is only 1 lakh 50. But we are issuing how many? 2 lakhs. That means how many shares are issued without consideration? I can say 50,000. Only those shares will have dilution effect. Only those shares will have the dilution effect. That means they can capability to reduce the basic EPS. Hello?